honored to be starting off this morning. I didn't realize it actually started at 10. And I assume, are you, David, on the East Coast?
Oh, okay. Um, yeah, my internet glitched for a second there. Louisville, Kentucky, so Eastern time. Um,
Gotcha.
where where were you located again?
I'm in Southern Oregon, but I used to
Oh yeah.
speak all over the country, and it was really fun to travel to Kentucky and Tennessee. And my little joke about those two states is in Kentucky, they're into horses and whiskey, and in Tennessee, they're into whiskey and horses.
Yeah. Yeah. Yeah, exactly. Um,
You
yeah.
know, those aren't bad things, by the way.
No, great. Derby was just a couple days ago, so
Oh, that's
yeah,
awesome.
lots of horses and whiskey.
Did you drink a mint julep while you were watching it on
Um,
TV?
yeah, I did. I normally that's more of a touristy kind of thing, but um my my girlfriend wanted one, so we got uh we got the mix and everything and had a couple. So
Well, I hope she wore a
I got
big hat as well.
um yeah, she has them. She's actually been involved in the horse industry her whole life and in dressage and eventing, so she
Well, it's
has
a good thing you're rich because that's an expensive hobby.
yeah. Um yeah, but she it's 10 o'clock now. So um all right, are you ready to start?
I am ready, ready, ready.
Okay.
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 Um, you let me know when you
Okay.
want to go.
Yeah, I'm going to start my recording and then do a quick introduction and then turn it over to you.
Alrighty, sounds good.
Right. Oh, and okay. All right. All right. I am recording now. All right. Hi, everyone. Welcome to day 3 of the Synergy Traders number 63 Active Traders Playbook event brought to you by TradeOutloud.com and TimingResearch.com. And just a quick reminder, all of these presentations are for educational purposes only. Trading is not suitable for all people. And please consult a financial advisor and only trade with money you can afford to lose. All of the sessions are being recorded individually, and those will be available as soon as I can get them processed. Um, Also, we are live streaming onto YouTube, so the entire unedited day is being archived instantly for you to review at any time as well. On If you just search for Timing Research on YouTube. So to start out the day for us is Peter Schultz, and I'm going to go ahead and turn it over to him.
Thank you, David. I appreciate being here. And if you're listening and watching right now, I really appreciate you being here. And the title of this presentation is How to Create a True Automatic Money Machine Set to Profit No Matter What Kind of Luck You've Had in the Past. And if you're looking at that right now and you're thinking, well, this is a bit of hyperbole, this sounds like one of those too good to be true kind of promises. I just want you to stick with me and we're going to go through it. We're going to go through the probabilities and the math and just how this works. And I think you're going to be really inspired by the end of this. And I hope that's the case. I've got some tremendous information for you, and we're going to pack a lot into the next hour. So let's get going. I want to introduce myself. My name is Peter Schultz. I've been trading every day for over 30 years, and I'm the chief strategist of the Winning Secret. And that's a way to create generous weekly income from a relatively small account. And I found that that appeals to a lot of people, and it's very helpful. It's very useful. I think there's a lot of aspects of trading, particularly with options that are highly leveraged, where people kind of feel like they want to hit the lottery. You know, they want to knock it out of the park and make millions of dollars. And I get that sentiment. I've had that sentiment myself. But I found what's more useful for people is just to have a fairly big chunk of cash flow coming in on a pretty regular basis. And that really tends to change our lives. And there are ways to do that fairly safely and reliably. And that's what we're going to get into and talk about. So there's two problems for most people when they try and make consistent profits in the market. The first one is they don't trade with a true advantage. And by that, I mean a built-in mathematical edge. Now, when I started off trading, I thought my big advantage was how smart I was, how clever I was, how I was going to get one over on the next guy. And the problem with trading and options in particular is it's kind of a magnification of all your good traits and all your bad traits. So your some of your bad traits can kill you. And for some of us guys, that's like a big ego and thinking we're really good. And one of the things that the market is so darn good at, maybe we should thank it for that, is creating humbling experiences. So we're not quite as big a stuff as we thought. And you can validate that and verify that by looking at your account balance. So I don't know too many options traders that haven't blown up their account once, twice, or three times before they start figuring things out. That's what happened to me, fortunately, many, many, many years ago. Once I did get things figured out, they've gone a lot better. And that is because I trade with a true mathematical edge. That's what I want to provide for you. And it makes it so it's really kind of nice because it makes it so you don't have to be so good because the strategy's good. So we're going to spend a good amount of time on that. And then the second one that we're all sort of subject to is we're subject to trading our own bias and emotions. So, you know, I think some of the biggest losers that I've had are trades that I've gotten into where I said, this absolutely cannot lose. This is 100% gold lock. I'd put my grandmother's entire retirement fund on this one trade right now. This is the easiest money I'm ever going to make. And a strange thing happens on the way to depositing your millions in the bank. That 1 in a million occurrence takes place, and you lose on that trade. And if you overbet on it and really put too much money on it, it's pretty sobering. And so we all have to deal with that. And I think trading is just the most fascinating thing in the world because it teaches us so much about ourselves. So these are two really enormous challenges that we all have to overcome. So how can we overcome these two universal problems? And we see, I don't know if you can see this guy's face in the background, but he's seen something he doesn't like on the screen and sort of responding to that. So I kind of got a kick out of this one. So the traditional approach that pretty much everybody's talking about over this 3-day event and that you've seen so many times in all your education is a fundamental and technical analysis approach to the markets, and especially technical. If we're any kind of a short-term trader, day trader, swing trader, any of that, we're looking for charts for short-term trading. We're looking at charts. We learn technical analysis, we learn a few patterns, and that's fantastic. That definitely increases your odds because these patterns are identifiable for a reason. But even then, we can still lose too much and too often. I've seen this to be the case in short-term stock trading and also, of course, with options trading. Options give you a lot of leverage, but they're also a lot less forgiving. Things happen really fast. Sometimes the value of your position can disappear before you really actually have a chance to do much about it. So these are real problems that we run into. And if you're a trader in Forex or cryptocurrency or anything else, you run into these same situations. It's the same patterns. And the reason is because humans don't change. So there's a lot of things that change. Technology changes. There's a lot going on in our world right now. But human emotions kind of don't change, and they haven't for a long time. So what's the solution? What do we do about it? It's always great to identify a problem, but it's always nice to actually see what we can do to overcome that. So the trick to making money dependably over the long run is to use a strategy that stacks the deck overwhelmingly in your favor on every trade automatically. And I'm talking about putting an overwhelming probability of winning on your side. Now, you can still lose with this, of course, but if you have an overwhelming probability of winning, you're going to win most of the time. And you can actually depend on that math. And before any of you, if you're listening right now, if you think I'm some kind of math savant genius, that's deciphered the Black-Scholes model and can recite it to you forwards and backwards. I just want to let you know that I couldn't make any sense out of numbers at all until they started putting dollar signs in front of them. And then all of a sudden, they started making all kinds of sense. And I have this tremendous motivation to figure numbers out. And it's actually been kind of fun ever since that. Aside from making any money, it's really fun to try and figure out how systems work and how you can sort of tilt them in your favor. And when you do figure that out, it's quite a victory. It's quite wonderful. So the way we'll do that is to use options. And the reason I love options is because of their built-in probabilities that are based on a mathematical formula. That mathematical formula is actually a work of genius. If you know anything about options, you know that we really didn't have an options market until 1973. And that is when three mathematicians at the university level created this formula, the Black-Scholes formula. Black and Scholes were two of the mathematicians. And then in 1997, they got the Nobel Prize in economics for creating this formula. And it's made the modern options market possible. And there was actually three mathematicians, and one of them had died, and they don't give the Nobel Prize posthumously. So just the two mathematicians got it, but it's created this incredible way for us to trade. And I'm very appreciative of what they were able to do. And what's kind of funny about this formula is I'll lay in bed at night trying to game it and figure something out. I've done this for years. And I figured out some foolproof way to take advantage of the formula, so I always win. And then I come out and I take a look at the options chains the next morning and I go, oh my gosh, I guess my foolproof plan doesn't work because the formula is so good. And we actually want that. We want a really fair, really even, really great formula for pricing these things. So because of options built-in probabilities, by switching to be a seller most of the time, not all the time, there's situations we don't want to be a seller of options, but most of the time, and that's selling to open a position. But by switching to be a seller most of the time and a buyer some of the time, you'll trade with the highest odds on the probability curve. And the really amazing and cool thing about being a seller, an option seller, is you'll instantly stack the deck by over 80% on every trade, completely removing yourself from the equation. So once again, you don't have to be fantastic because the probabilities are fantastic. So let me kind of give you a graphic example of how that might work in the real world. So you go over to your friend's house, and your friend is rich and he likes to play fun games. So he takes you out into the backyard and he says, listen, I've got this coin and I got it from the novelty store and it comes up heads 80% of the time. And I'm going to flip this coin and I'm going to let you call heads every time. And every time it is heads, I'm going to hand you $1,000. How does that sound? And I'm going to show you what you can lose when you lose that coin toss. But I'm just asking you right now, if you can imagine the scenario, how long you would stay out in that backyard flipping that coin that's coming up in your favor 80% of the time. And every time you win that coin toss, you get $1,000. And I would suggest that you would stand out there until it got so dark outside that you couldn't see the coin, because trading with 80% odds is really awesome. So why does this work so well? So the biggest factor separating stock trading from options trading is options have a limited lifespan. They expire, and if they're out of the money at expiration, they expire worthless. When you're an options buyer, time decay works against you. And most people, frankly, are options buyers. Why? They want to buy those lottery tickets, knock it out of the park, be able to brag to their friends that they doubled or tripled their money. I get that. I understand the attraction. The problem is they're taking very, very low odds bets. So when I first started trading, my big question was, how much can I make? After I traded it for several years, that question started to shift to, what is my probability of winning and what is my probability of losing? And that's when I switched positions. So when you're an options seller, time decay works for you. And this is a really good time to break out my little pen and I'm going to make it red so that you can see it. So one of the things I want to point out about this options decay curve is, let's just say this is 4 months. So for the first, gosh, I'm going to say 3 months. Let's say this is the last month right here. The options time decay curve is very slow. It's almost flat. It's going down a little bit. And then when you start getting in that 1 week before the front month, it starts going down much quicker. And then in this front month, you have all this time decay. So I've done a lot of experiments about when to place our trades. And we place them, this perfect time is 17 to 10 days out before expiration. And most of the time, if the premiums are there for us, we do 10 days. Well, 10 days is pretty quick, and you take out the weekend, and that's actually 8 days and not a ton of time. And then when you place a trade in this time period, the time decay is very, very rapid. And so this has been our edge. So not only do we have an 80% probability of winning going in, and I'm going to show you where that comes from, but we also have this really tremendous aspect of options working for us, and that's time decay. Now, if you're an options trader and you know all this already, and you're thinking, God, could you just get to the good stuff? I know all this. I'm an expert on it. Just tell me something I don't know. Well, stick around because things are going to get good here. Things are going to get pretty exciting. But if you don't know a lot about this time decay curve is such a definitive aspect of options. And I would say with some authority, with some confidence, that more money has been lost in options trading due to the option running out of time than any other factor. And what you thought was going to happen actually did happen. Your hypothesis was correct. And it happens the day after options expiration. So this is so typical. You lose all your money on a Friday, and then that following Monday, the stock or the index did exactly what you thought it was going to do. And this causes you to kick things, use foul language, be in a bad mood, and just generally not have a good life. So this is something we really want to avoid. When I started selling options, I was sort of on the beneficial end of that, and I got in a much better mood. So this is sort of one of the big bases of our advantage, our probability of winning. So let's see how this plays out in the real world. So the trick for us is we're actually most of the time directional traders on this. And the trick is to sell your spread in the opposite direction of the underlying to create an overall probability of overwhelming probability of winning. So I just want to point a trade out here that we just did this week. And everything I'm going to show you is really recent. I'm not going to pull up stuff from the past, and I want to make this as relevant as possible. So this is the Russell 2000. The symbol is the RUT, the RUT. And as you can see, it's just absolutely blasting off of support here. So this is what happened on Tuesday. We saw this big up leg, and we had been trading the SPX. The SPX, the S&P 500, is getting pretty overextended. It's pretty wild what's happening right now. So I saw this. It looks like the RUT is getting ready to play catch up to the SPX. And so we looked at our different possibilities here. And let me see if I can move this. Yeah, there we go. And we saw where we could sell this 27.75. And we're going to put an S on here for sell. And then, so we have a hedge, so we don't have a liability all the way down to zero. We buy the 27.70. So this is a $5 spread. And look what's going on. So if you're watching this right now, you're an active trader, you know probably a fair amount about technical analysis. And I don't make the technical analysis too complicated. So many webinars I've seen and so much instruction I've seen, they have so many lines on a chart. Fibonacci analysis is one of those where there's so many lines on there, the stock is bound to hit one of them. And then when it does, they look back and they say, oh, look, it hit this so-and-so line and then it bounced. Well, that's a little too complicated for me and I can't rely on it. So for technical analysis, I've learned to keep things really, really simple. You use charts that everybody kind of agrees on. So here's one right here. When you have some horizontal resistance here, and the Stalker index keeps bouncing up against it, and then it breaks through, and then it pulls back a little bit. What I would like to refer to this horizontal resistance that now turns into horizontal support is it's like a launching pad for the stock or the index. So when it surpasses that, it doesn't take much of a good piece of news to just launch this thing higher. So chances are good we're going to get a little bit more movement out of this. And so this commentary that you're seeing up here on the chart, the rut just broke above horizontal resistance in a big decisive move that foretells another strong leg to the upside. We'll be selling below both uptrend, this uptrend right here, and horizontal support for a high probability outcome. And that's exactly what we did. So we sold here. We're well under this horizontal support. We're under uptrend support, and we take in a nice credit on this. So here's the thing, and this is really what I want you to keep in mind about the probabilities, is when you do this, when you sell this, in this case at 27.75 on the rut, and you look at the options chain and the formula and the probability of being out of the money, which is what we want, it shows you where we trade is we are trading, we're selling about a 20 delta. And so the inverse of that is an 80% probability of winning. So we're back to our coin in the backyard with our good buddy that likes to play games. And we have this 80% probability of winning. But the important thing that I want to point out to you is that is completely in a vacuum. That's just based on the math. That's based on historical probability and implied volatility. It does not take the chart into account. It does not take the news in the Iran war into account. It does not take market sentiment into account. It doesn't take any of that into account. It just freezes the numbers at that particular point in time for the mathematical formula, and you have an 80% chance of winning. So here's my question to you. If that's the case, and we incorporate technical analysis, which we just did, which you already know, you've already studied, you already know some really good things about charts and pattern recognition. If we add that into the mix and a little bit of the fundamentals about what's going on in the world, now what is our probability of winning? So what I call this is stacking the deck in your favor. You are really stacking the deck in your favor. And this is what I love about this type of trading. Well, let's see what happened the next day. So I'm going to show you charts where we got into the trade, and then I'm going to show you what happened. And all of these are very, very recent. This is what's going on now. And these are all typical of what typically goes on. So the very next day, that happens to be yesterday, we got a nice gap up and then a big move. And then today we're kind of consolidating a little bit, but I don't care because look how much higher we are from what we sold. So the credit we got on this on a $5 spread, and this is typically what we're going for, is we got $1 when we put on this trade right here. And by the end of the day, yesterday, actually we did it at the opening right here. At the end of the day yesterday, this thing was only worth 65 cents. So here's the thing. We typically sell 10 days at a time. So we'll take our positions on a Wednesday and they expire the following Friday. So you can see that on that Wednesday, we've got what, 3 days in that week, 5 days in the next week. So that's 8 days. And people say, well, 8 days. I mean, if you're used to being a day trader or getting in and out of things really quick, you think, well, I can't be hanging around for 8 days. That's forever. It's awful darn quick in the stock trading world, but let's just say that's your attitude. Look at what can happen in one day. We've already gotten 35% of the total credit available on this trade, and it's probably just going to be getting better. And keep in mind, on the point of the time decay curve that we're selling, which is super, super steep, is every single day puts money in your account. The time decay on that is huge. So we're really benefiting as an option seller from this time decay. So here's another one that we just did. So this is the actual commentary from our subscription service. The subscription service is like the best deal in the world. I knocked myself out on this thing. I spend 9 hours every Tuesday writing it, researching it, finding the highest probability trades. These are a little tougher to find than you might think because you have to have a lot going for you for the right kind of a trade. Well, this is one that I found. I think you'll love the subscription. So in addition to what you get on the chart, we also do a lot of commentary. I do a huge write-up. So, but this is the commentary on the chart. This has to do with Lowe's, the big home improvement retailer. So the commentary here is no rate cuts will hammer the housing sector, and by association, the home improvement stocks. As you can see, Lowe's has been falling hard and just broke below critical horizontal support. So that is this line right here is this critical horizontal support. Um, this stock is heading lower and will be selling well above both downtrend and horizontal support, and that's what we like to do. So we have this break. We have other, other indicators working for us. The MACD is heading lower. The on-balance volume is heading lower. This just really lines up. It's kind of perfect. So we sell this a call. We buy this call. They're 250 apart. In this case, it's the 250 to 5250. We got our target 50 cents, and that means we have $2 of risk on this with a potential 50-cent profit. And that gives us a, if expired worthless, maximum profitability, that gives us a 25% return, very passive return in just 8 days. And I don't know what kind of trading you do. I don't know if you like to double, triple, quadruple your money. In order to do that, you have to take an inordinate amount of risk. I've gone down that road, very, very tough. But if you're making a dependable 25% every 8 days, some incredible things are going to happen to your brokerage account. We're going to take a look at that as well. So once again, I want to show you what happens with these trades. This is just my analysis, my supposition. We're seeing some very clear downtrend, some very simple technical analysis. We've broken support, things in a downtrend. So let's see what happened since we put this trade on. Oh my goodness. So here we go. The stock dropped quite a bit. In fact, it dropped so much. What we had to do the next day is actually adjust our spread. So we sold the 245, 247.50. We still got our 50 cents. We're still doing the same thing we were before. And this one still has another day to trade. So we're not even done with it yet. But what do you think, just in your mind, looking at this chart, what do you think the probabilities are of this thing doing a sudden rebound and going through our spread? Not so great. So once again, we're trading with some tremendous probabilities on our side. And I just love that because it means that I don't have to be a genius because the strategy is really doing the heavy lifting for you. And we're really taking advantage of the mathematics in that options pricing model. And I love that. So here's another one. A lot of people trade Tesla, still a big sweetheart stock for a lot of people. Elon Musk is an amazing human being, doing some incredible things, but that doesn't mean that Tesla can't go down. And so everybody's concerned, about the electric car incentives going away. They're concerned about diminishing demand. They're concerned about BYD over in China taking over the world. And here we have a downtrend, a pretty marked identifiable downtrend on Tesla. Okay. One of the coolest things about Tesla is you get really great premiums because of the volatility of it. So look how far out of the money we can sell. I mean, this distance here gives you a really, really nice cushion. That's kind of what helps you sleep at night. So we're selling the 410 call and we're buying the 412.50 call. And so that's a 250 spread. What we're hoping to get on that, our target and our minimum target is on this, and we don't want to get less than this or we're not going to do the trade. We want to get paid for taking risk. So our target is 50% on a 250 spread. We just took a look at that math. So that makes your actual risk down to $2 because once you get that 50 cents, nobody can take it away from you no matter what happens. That's yours to keep. So ideally, I mean, the stock is way down here. We can still get a 50-cent credit. That's great. Ideally, what would happen is the stock would bounce up here closer to the trend line, so we get a little bit more money, but we're not depending on that. If it just stays anywhere around where it is, we can still collect the credit that we need. So let's see what happened. So the very next day, so if you look at it, these two bars that we looked at, these two green candles, were what we were looking at in the chart before, and the thing did oblige us. It popped up the next morning, instead of getting 50 cents, we got 61 cents. And that gives us only $1.89 in risk. And this is pretty cool because on a 250 spread, this 61 cents, instead of a 25% return, turns into a 32% return. So I just want you to know 25% is kind of our minimum. If something's really good and the probabilities are fantastic, sometimes I'll go down to as low as 20%. But really, I like to stick to that 25%. That's our standard. And then occasionally we get to do better than that. And look how this trade turned out. So it went up here, touched the trend line, obliged us by immediately falling. This trend line turned out to be very, very solid resistance. Pops up here again, makes another little attempt, doesn't quite touch the trend line. And then here we are heading lower right through our expiration. Now, this is another thing I want to point out to you. We always have an expiration. We have a finish line. The reason I love this is because I know that I never have to make a decision on when to exit a trade. You have no idea how luxurious that is. Or maybe if you're an active trader, you do know how luxurious that is. It's always this big debate you have inside of yourself. I have some profits on the table. Do I take them now? Or do I wait for more profits? Or do I put a trailing stop underneath it? Or what do I do to try and maximize my gains here? Well, with this style of trading, you never have to make that decision. Expiration is going to come and go with or without you. And by expiration, all the time value in that option is gone and it just completely evaporates. And our plan is to have it evaporate right into our accounts. So if you'll notice here, all we're ever selling is time value. We never have any intrinsic value in these trades. And so time decay makes a huge difference. If you combine that with the underlying stock going away from your position, the accelerated decay, another way to look at that is the accelerated profit going into your account really gets exaggerated. It really gets cool. And even if the underlying starts heading towards your position a little bit, you still have that time decay working for you. And that's an incredible advantage to have in your pocket. So this is one of my favorite trades I've done for a long time. And I just stumbled across this right before we did our update. I could not believe it. These short squeezes happen once in a while. They're usually completely engineered. They're manufactured. They have nothing to do with the fundamentals of the company. So this is CAR. This is Avis Budget Group. Here, they have a horrible business model, by the way. If you do the fundamental analysis on Avis, you're going to see it's just a horrible business proposition. They're getting this. They buy these cars new. They get this incredible depreciation that they can never recover. They try to recover more of that by having their own car lots. Still not working very well. But here's the base of this thing. It's $100 a share, which in my opinion is still massively overpriced for their prospects. So here's an interesting fundamental stat on Avis is they haven't had a positive cash flow quarter in 8 quarters. They haven't had positive cash flow. I mean, this is a horrible business model. I think they're going to actually eventually go out of business. And this is not something you want to be involved in. So I'm not the only one that feels this way. I've been kind of following them for several years now. I kind of like great shorts because they can drop so fast. Well, here's what happened in a nutshell is there was 2 massive holders of the stock, both hedge funds. And they started seeing this incredible short position on the stock. So everybody acknowledges what a horrible business model is. Everybody acknowledges that Avis should really go down. And you can see that they did. At their last earnings, the thing dropped like a rock. Everybody can see how bad it is. At this earnings, they dropped like a rock. Not a good business. So anytime there's this huge short position, what they can do is actually manipulate that. And that is what there's one major hedge fund that did this. They went into the market for the first thing they did is they made all their holdings, which were substantial, where the broker was unable to borrow their shares. So this is something that you can do too. You can give the broker written notice that you do not want your shares to be able to borrow. That's where margin comes from. So people cannot short stock without having margin available, without having short shares to borrow. So they made their huge position not marginable, and then they went into the market and started buying huge quantities of stock. And this is what ignited the short squeeze, and this is what happened. Now, we saw this back in 2021 with GameStop and AMC and these kind of garbage stocks that were on the verge of bankruptcy suddenly flying to the moon. So this is what happens whenever you see this curve. When you see a curve that's shaped like this, where it starts off very steep and then it keeps getting steeper and steeper. And finally, it's going up what I refer to as an exponential increase. It's going up exponentially. Anytime you see this, you are guaranteed of something is the thing is going to come down just as fast as it went up. That is an unsustainable move. Frankly, it's kind of what we're seeing in the SPX right now. So traders take note. Yeah, it's fun to chase all that stuff, but man, have some good stops in place. I'm just waiting to wake up one morning to see this big gap down on the SPX, and it's going to get pretty ugly pretty fast. But for right now, the thing's still skyrocketing. But boy, I think this turn is coming quickly. So just a warning to the wise here. So this is Carr, this is Avis. And so I saw this and I said, we really need to take advantage of this. So if you look at the options on something like this that's just going absolutely haywire, they're too expensive to buy. You can't really buy puts. It's just crazy. The bid-ask spreads are super wide. But what you can do, and what I love doing, is selling a credit spread. This is where credit spreads really come in handy. So I put out to my subscribers, I said, we're going to sell the 715. We are going to buy the 720. So this is just a 5-point spread. The beauty of it is you get paid right away. Here's my commentary from the subscription. It says Carr is demonstrating a classic example of a short squeeze, a situation that never lasts. So something I want you to keep in mind on a short squeeze is every one of these big green candles going up means somebody out there is covering. They're buying their shorts that they originally sold. They're covering their position. And here's something to keep in mind. Once that position is covered, whoever did that, whether it be an institution, an individual, whoever, they got burned, they lost money, but they're now out of the trade, and they actually never want to hear this ticker mentioned to them again. So they're out. So there's only so much fuel in the bonfire. Even if you stacked up a big pile of wood, there's only so much fuel there. And once that fuel is exhausted, the thing reverses very quickly. And that is why I'm telling everyone this situation never lasts. We'll be selling just above its current price with over 2 weeks of time for a high probability outcome on a very juicy spread. So how juicy was this? Well, the other thing I like about this is our timing doesn't have to be perfect. So I didn't know when it was going to reverse. I just knew it was going to reverse. So normally we sell 10 days at a time. On this deal, we sold, I think it came out to 17 days. It's actually expiring tomorrow. So this is a very timely position. So let's see what happened. This is when I did the analysis, the big write-up. I told everybody about it, wrote all about it just to give them some confidence in the trade. And so this is what we put on. And we put these on usually with automatic orders. So let's see what happened the very next day. This is going to kind of blow your mind. So the thing we put on the trade here, this is our 715 and 720. And that morning, the stock shot up to over $800 a share. Have you ever seen anything like this in your life? And, I figured sometime certainly in the next 2 weeks, but probably in the next week, this thing would reverse. It didn't even wait around that long. It reversed immediately. Look at this. It fell from over $800. The first day it finished at around, I don't know, 445, something like that. This thing lost close to $400 in one day. The next day it gapped lower from like 445 all the way down to 400. And then people could not sell this thing fast enough. This is when market orders are hitting the market. Like they're saying, get out of my position. I don't care what I get. I just want to get out of this thing. The next day, the thing closed around $230. And then it's been going down ever since. By the way, when you see a deal like this, you can go back and milk it several times. So in another account, I have a trust account that happens to have options trading capability. I've been going in there and I've just recently sold a huge number of contracts. When this thing popped a little bit higher at about the 210 level. And you can see that people are still not quite as quick, not quite as dramatic, but that makes the options premiums a little more reasonable. And I've just been selling calls against this thing, and you can go back to the well. But let's see what we did on this thing. So, and this is a little flukish, so don't expect this all the time, but this is what you can do. So this is actually, erase that. This is a $5 spread. And typically on a $5 spread, we want to get a dollar. And a dollar from $5 is $4. So getting a dollar on a $4 risk is a 25% return. But what do we get on this one? And this blows me away. And the reason is because it gapped up so high right when we were doing the spread. We should have actually gotten more than this. It's sort of unfair that we just got this amount of money. I'm not really complaining. We got a 250 credit, which leaves us a 250 risk. So what are we going to get tomorrow when this thing expires worthless? By the way, our spread is way up here. What are the chances of this thing recovering and going up and threatening our spread? Not much. Why have we hung on to it without closing it already? Is because the bid-ask spreads are so wide, the premiums are so wide. It's not giving it. It's not worth our while to close it. So we're just going to let the whole thing expire worthless tomorrow. And if that happens, this will result a 250 credit with 250 risk results in a 100% return. This is outrageous for a credit spread. You'll probably very rarely, if ever, get this. But I think it's pretty darn exciting when people say, well, credit spreads are boring. It's like watching ice melt. Well, actually, I beg to differ. Making money is never boring. And winning on trades is never boring. And if you're trying to get your excitement in life by losing huge amounts of money, I'm thinking, well, that's just, fantastic if that's what you like to do. But that's actually not a really good way to get your kicks. There's a lot more constructive ways. And I think this is exciting to take advantage of something like this. Now, we would have still won even if the thing bobbled along for a while and then dropped. But I think it's cool that it just kind of happened the very next day. So it's a rare situation, but it's one that's happening right now. I wanted to point it out. And anytime you see this, boy, it's fun to take advantage of it. And I've sold these credit spreads on these kind of things. I think I did GameStop or AMC back in the day, and things got so wild with those. So I sold my spread. I collected all this money, and then you have a certain amount of risk while you're waiting for the thing to play out. But like the very next day after I did that, they halted options trading on those stocks because they were trying to limit the speculation. They came in, they halted options trading on it. I'm thinking, hey, fantastic. I got my credit. I got paid. The person that they're screwing on that deal is the guy that bought the options, that bought what I was selling. I had this also happen with a Russian ETF when the Ukraine war broke out. I did some speculation on that, and I sold a really fat credit spread on that, and I was really excited about it. And like 1 or 2 days later, the US government said, okay, no more trading in Russian assets. We're getting rid of the Russian ETF. You can't trade that anymore. And I'd already collected all this money. So being a collector and a credit spread seller stacks the deck in your favor on more ways than you can imagine. So we not only have time decay and probability working for us, but direction and momentum as well. And we can kind of see that. So you sell the close option and buy the further option to hedge immediately, creating a credit in your account, and you get paid the moment you make the trade. And we've seen that. So that's pretty exciting. And keep in mind, there's 5 things and only 5 things the stock can do, and you'll win on 4 out of 5 of them. So let's just take a quick look. This is kind of a fun thing. If you haven't been exposed to this before and you really are still trying to grasp the concept, this is a really easy way to look at it. So when we put on this trade, we put on this trade right here at this point in time, and we sold this position right here. So what can this stock do? So it can only do 5 things. It can go up dramatically. You can kind of go straight up. And we saw that. This happens to be the S&P 500. And the very next day, the S&P 500 gapped up again. So it's this scenario where the thing just goes straight up. And what happens to our credit spread that we sold down here, this put spread, is we make money. Awesome. Or it can just kind of follow the line that it's on right now, and it can go up a little bit. That's okay. In that scenario, we make money. Or it can lose momentum and digest the previous move and just kind of bobble along sideways. What happens in that situation? We make money. Or it can even go against us and start to go down a little bit and fade a little bit. But if it doesn't go down enough and it crosses this finish line, in this case, it was just a 3-day trade. We just put it on like, gosh, I think like Wednesday or so, yesterday or the day before. We did a little switchy. Actually, it was on Tuesday. So this is going to expire really quickly. And even if the SPX went down a little bit, we're still going to make a maximum profit on this position. So how do we lose? The only way we can lose is if the thing suddenly drops out of sight with a big gap like this. That's probably not going to happen. But if it did happen, what happens to our profit? That turns into a loss. I'm going to talk about what kind of loss. But look at your probabilities. So without analyzing the options pricing model or all the probabilities or the Black-Scholes model or getting into any kind of complicated math, look what happens. You have automatically a 4 out of 5 times chance of winning, or stated in percentage terms, an 80% chance of winning. And that's what we go for. So with these spreads, there's certain characteristics to look for. So we want to see weekly options expirations, and we want to see that so we can get on that perfect point in the time decay curve. So we can sell that about 10 days, and that's available to us every single week with options that have weekly options expirations. A lot of stocks still have monthly options expirations, and some don't have options on them at all. So we want to get these popularly traded stocks. They really have the volume and the liquidity that we need to make this work. So that's a good criteria. Weekly options expirations. We want fairly tight spreads. We make more money on that. A $5 spread's the most we ever do. We also like 250 spreads. And if we get dollar strikes, a really fun one to trade that I really like is $2 spreads. So we want these spreads fairly close together. We get a higher rate of return when we do that. And we want narrow bid-ask spreads to make this work. And the bid-ask spread, of course, is like it's, say the option is 50 cents by 55 cents. We can live with that. We'd rather have it be 54 cents, 53 cents. That's kind of what you lose. That middle is kind of what you lose to the market maker down on the floor. And we want those as narrow as possible. And we get those through trading, underlying stocks and indices that are really popular. So the best spreads out there are on the SPX, and that's because it's traded so frequently and so much volume. So we want these spreads to actually be heading our spread is in the opposite direction, or actually, this is on the stock that we're picking. We want the stock to be heading in the same direction as the overall market for confirmation. If the overall market's going up and that particular stock is going up, we know that we want to sell a put spread underneath that for the probability, the maximum probability and the minimum risk. And we want a credit spread that yields at least 25%. And as we've seen, we can sometimes get a lot more. So if you're taking notes, that's really good criteria, and you can write these down. And I think David is also recording this so that you can go back. So how much can you make and how much can you lose? And that's always a good relevant question. I think one of the mistakes people make when they're presenting is they talk about all the money you can make, and it just sounds like you're going to win the lottery and just have this cash machine. But I think a prudent investor is always going to ask, okay, your program sounds good, but what can I lose? So let's take a look at this. If we're doing, in this case, a 250 spread, and that's the width between these strikes, what we're selling and what we're buying. And in this particular case, we're targeting 50 cents. So once again, this 50 cents is yours. You get to keep it no matter what. So just to put it in real money terms, 10 contracts is $500 hits your account immediately. 20 contracts is $1,000 hits your contract, your account immediately. Those numbers can add up. We do every Tuesday night, I present 2 trades, one very conservative trade that you can do in a Roth account, one more aggressive trade. And the conservative trade is almost always on an index because you're not subject to single stock news risk or earnings risk. And so I like those more conservative trades. So if you're doing this twice a week and you're bringing in 500 to 1,000 on each trade, so 1,000 to 2,000 extra dollars per week comes in pretty handy. So on this, with a 250 spread, we're getting a 50-cent credit. That gives us a $2 risk on this trade. And so what happens if like the impossible occurs, or not the impossible, but the improbable, and this thing, something comes out and low suddenly shoots all the way up here and through both of our strikes, and this is a big disaster. Oh my gosh, what happened? And when you look at this, you go, well, if you have $2 at risk, that means you can lose $2. So I don't like the idea of losing $2 with only a 50-cent upside. That's not very cool. I don't like that. So here's what we do. We enter an automatic stop right at our sold strike. I'm going to say SS for short, our sold strike, and we're going to put a stop right here. And my writing isn't super good because I'm doing it with a mouse, so you're just going to have to interpret here. So we have a stop. So what happens? Well, according to options theory, and this is pretty cool, and this is how it usually plays out, is if you get stopped right here, your cost to close is going to be half the distance of your spread. So now your real risk is only $1.25. So if you got 50 cents and this spread gets stopped out and it gets closed at $1.25, your real loss is only 75 cents. So 50 cents from $1.25 is a 75 cents. And if you're making 50 cents, but you're losing 75 cents, one way to look at it is it only takes 1.5 trades to make up a loss, yet you're winning 80% of the time. So you don't have to be an advanced mathematician to know that that is a system that you can trade over and over and over again and have a mathematical expectation of making money. And I love that. And I love looking the bugaboo, the scary thing right in the eye and seeing kind of what your bad case scenario is, so you can really have a handle on what your risk is. I think that's super, super important when you're thinking about trading something. So we target 25% per trade, but what is an attainable return you can expect over time? Because you're not going to win on every trade. Not only that, we don't use our entire account to trade. We want to hold a little bit of cash back for cash holds, for buybacks. A lot of the time we'll buy back a position to make it better. Just did that with the SPX this week. We had a call spread on it because the SPX can't go any higher, right? Well, you get proven wrong all the time in the market. So we just did a switcheroo on Tuesday, turned that into a put spread, but we needed some money to do that. So you have to have a little cash set aside in your account. And of course, you always want to take a look at losses. So if we're targeting 25% and we're getting 25% or more, what can you really expect? With losses and everything, can you maybe get 20%? Can you maybe get 15%? How about we really cut it down and make it 10%? So I think 10% is really, really reasonable, a really reasonable expectation. If you're doing that every 2 weeks, you're gonna get very wealthy. But I want to cut this back to something that I know anybody can do. And so let's cut this all the way back to 5%. Now, keep in mind, we're targeting 25, but we're only going to really reasonably expect to make 5. I know you can do more than that. I know it's going to be closer to 10, but this is an amount I really know anybody can make based on the probabilities here. And the key is you're turning your money over 2 weeks. It's really about 8 days. Well, let's just call it 2 weeks to make it even a worst case scenario. Let's see what that looks like starting with just a $10,000 account. And I think this is going to kind of blow you away. So this is 5% compounded every 2 weeks for 2 years. And your 10,000 in 2 years has grown to 104,000, and you're bringing in over 10,000 a month. And obviously you're doing more contracts at this point. And what does this chart look like? It looks very much like those exponential returns. And you can see this thing going straight up. Now, if you're looking at this right now and you're saying, Peter, that is one of the most wonderful, beautiful mathematical fairy tales I've ever seen in my entire life. I've traded in the markets. I'm out there every day. I know the market doesn't work like this. You just don't do that. It doesn't work like that. You're right. You are absolutely correct. What it actually looks like is something like this, is it's going up because the probabilities tell us it's going to, but it does so in a very ragged pattern, but you actually end up at the same place. If you use the stops that I show you, and if you take advantage of all of the things that I've learned about selling credit spreads, when to do them, what kind of markets to do them, I can tell you that you're going to have this kind of advantage. so fun because I've got subscribers that have been with me for like 20 years. I mean, these are like old friends. They wouldn't go anywhere else because I take all the work out of it for them. I serve it to them every Tuesday night on a silver platter. They have plenty of time to place the trades the next morning and just works out for people. So we don't really lose people much. And I love it because I love making our subscribers money. That's how we all get along and do well. So you can try the strategy for yourself, starting with as little as $200 per trade. It's really easy. You don't need a ton of money. There's just one problem, and that is if you don't do well right off the bat, you might get discouraged and quit. And that would be a shame because this really is the best way to trade because of your high likelihood of winning, the hands-free nature of the trading, and the tremendous compounded returns over time. So to make sure you start off profitably and stay that way, I put together an educational package that's the best anywhere for this strategy. This is what I've been doing. This is what I concentrate. I get into the science of it. I get into the math of it. And I really try and deliver that message and that information in a way anyone can understand. And I used to sell this originally when I came out with this about 20 years ago. I used to sell it for $2,500. I'd give seminars on cruise ships all over the world, all these interesting places. People would come on board. I still get emails from them. They really appreciate it. The 2,500 they feel is like the best money they've ever spent on their education. That's not a problem, but I have reduced it so much and added so much. It's better now than it ever has been. The whole system, it's called the Winning Secret. It includes this starting off little webinar that's so darn cute. It's how to trade credit spreads for fun and profit. It shows you step by step how to create spreads, why they work so well, how they can work for you. I think you're going to love it. Very entertaining. Making money should be fun. If you want to really dig into it, I've got a 161 page downloadable ebook, complete with charts, graphs, pictures, everything you need. And I've also consolidated that into a 10 chapter video series where you can see and hear exactly what to do to start generating income. Think you're going to love that. That's fairly new. I delivered it quickly in an excited way and in a way that I think you're going to grasp and understand really quickly. It's got forward and reverse controls so you can go back over something. I show you a lot of pictures, graphs, make it really easy to learn. I've got archived webinars inside the site that you're going to love. Every time I do a new one, I add them. And you get all new additions for life as an owner of this package. You spend it's a one-time fee. It's really low. I think it's going to blow you away what we're charging for all of this. There's a lot more, but that's the educational package. And what I've done is I've combined that with our subscription. You get the first month free. So I always want the market to pay for your subscription. I don't want you to. You get 2 high probability trades every week. I'll show you exactly where your spreads, how to sell them for maximum gains with minimum risk. I think you're going to love it. It's a very stress-free way to trade. In addition, the best way to learn is through one-on-one instruction. I'm going to have one of our gals walk you through exactly how to get the most out of the website, what to take advantage of, where to look. It's going to be really easy. I'm not going to leave that up to you to try and figure it out on your own. So we do a walkthrough, and it's just really fun and really cool. And my gals that work for me are so awesome. I absolutely love them, and I think you will too. And this is the part of the package that's going to blow you away. You get a 45-minute personal coaching session with my absolute genius in options trading. This is Alicia. She graduated in finance from the university in our town here. She is so darn good with numbers. She's analyzing our data right now. She's going to blow you away, and her whole purpose is to make you money. Her coaching sessions, you're going to want to get more. We've got 3 package coaching sessions and 8 package sessions or 8 session packages, but you're going to get this first one for free. I think you're going to fall in love with her, and she's so brilliant with this math and trading. It's really going to make a difference for you. That's all included. And I'm also going to include the greatest option strategy on earth. This is what got me retired back in the 90s in the big .com boom. It's the most incredible strategy I've ever seen. I used to sell this separately. I'm going to include it all in this package. It's amazing what you get. We can get rich in just 12 to 24 months or less with the right strategy. It provides capital appreciation and cash flow. And then this part is probably the most exciting part. What we spent over the last year doing is automating all of this. We've got a training program that has been making so much money. We put, after proving it to ourselves at the beginning of the year, we started putting our own money into it. Everybody in the company is actively trading. It puts on the trades for you. This is all done with the SPX with 0 days to expiration. We're using the same strategies that I just showed you, but it's all automated. It takes place in the background. It is truly an automatic money machine, unlike anything I've ever seen. And with it, we haven't rolled this out yet, but we have to do it with a relatively small subscribership. So we're only going to offer it to the people that are already subscribers. So this is a bonus. We're looking to roll this out in the next 2 months, and this makes money in the background without you having to do a thing. You're never clicking a mouse. You're never looking at a chart. It's what everybody's been looking for all these years, and we finally put it together. So just for that alone, I hope you come on board. Everything that you've seen here is at thewinningsecret.com. You're going to want to look at this ticker. I hope we can post it in the notes here. And this is where you'll go to get the deal that I just talked about. It includes absolutely everything: your coaching, the educational package, your first month subscription, and it's at a price I know anybody can afford. You can make it back on one trade easily. And I'm really looking forward to seeing you inside the site. You're going to love having these odds stacked in your favor, and it's a tremendous way to trade. And pretty soon, it's
Hey,
all going to be automatic. So
hey
anyway,
Peter,
thank you,
sorry, I
David.
gotta cut you
Yeah,
off.
I'm done. I'm finished. I wish I had time to answer questions, but
Yeah,
we need to get on to our next speaker.
yeah, that sounds yeah, that sounds like a great offer. So hit that link in the chat, and thank you, Peter, for opening the day for us.
Yeah, thank you. I appreciate you having me on, David. Always.
Yeah, great having you here. So um, all right. And Russell is up next. Russell, are you there?
Right, yep, I'm here.
Okay. You should be able to share your screen and get set up now.
Okay. Okay, how's that?
Looks good.
Okay, sounds good.
All right.
All right, thank you very much, David. Hope you guys are enjoying the conference so far. I'm excited to tell you a little bit today about zero DTE trading with SPY. Before we get started, though, just wanted to go through a quick risk disclaimer. Make sure that you guys know that by attending this webinar, you fully understand and accept the financial risks involved in trading. The risk of loss can be substantial, as we all know. You should be very careful when you consider trading in light of your personal investment objectives and financial resources. And it's important to know that you're not receiving any advice today from me on this. It's just for educational purposes only. And any decisions concerning a trade are solely your own and should meet your own personal objectives. And one important aspect today is I'm going to be showing you some past performance results. And I think it's very important that you understand that this is not necessarily what to expect going forward. Trading can change, the market can change, and it's important to realize that past performance does not guarantee future results. So what are we going to cover today? Well, I'm going to talk about the service that I run called SPY ATM Alerts and what drove 2 consecutive years of 100% plus account growth using just zero DTE SPY options on once a day with a 78% win rate. So I'm going to show you some data on that. We're going to talk about how timing, consistency, and position sizing do play a huge role in zero DTE option strategy. It's not just about being right, it's about being consistent, making sure your timing is proper, and that your position sizes are appropriate for your account size. So I'm going to also talk about how we have a rules-based approach that can reduce mistakes that really are common in zero DTE trading. And like I said, I run a service called SPY ATM Alerts. So if you stay to the end, we have a special offer for you for people that are watching this today. So I mentioned that I'm going to show you some results, and this is the results that I want to show you. So we have multiple years of results trading zero DTE SPY just once a day at 10:30 every single day. And I wanted to show you that we grew an account in 2024 by 124%, just taking this single trade on zero DTE SPY options every day at 10:30. You can see along the x-axis, we have number of trades for the year of 2024. You can see it was about 240 trades or so. You can see the profit and loss curve on a small account starting with zero profit. This was a $2,000 account. So you can see that we went from zero profits up the y-axis to $2,500 in profits in 2024. So this was using a small account. Of course, you can scale that to any account size that you want. This was 2025. It wasn't a fluke that we did well in 2024. This was a growth of 102% using an account of about $2,000, grew it to about $4,000 or so over the course of about 240 trades. So this is using the SPY ATM alert service that I help run. So a little bit about me before I get started on the actual talk here. Just want to tell you a little bit about my trading journey. So I started trading in 2014. I was married, I had a lot of student loan debt. My wife had a lot of student loan debt as well. And I started trading on the side. I was living in Seattle, Washington. I had to get up at the crack of dawn, 6:30 in the morning for the market opening. And I started trading penny stocks. And very quickly, I lost any savings that we had, which was, we had about $30,000 in savings. And I basically lost about 20,000 of that in the market. Basically trying to get big results on things like crazy little penny stocks. It really didn't work well for me at all. So that was kind of my rough start. I spent years chasing strategies. So I spent probably 5 to 10 years basically chasing strategies, over trading, using much too large position sizes. Pretty much every mistake that a beginner trader makes, I made it early on. Really had a lot of difficulty. It's not a good time to start trading when you actually need money, right? When you're actually in debt, you're trying to pay off that debt, you're trying to make ends meet. I was a research scientist in Seattle, so I had very little time to trade before my pretty stressful job started in the morning. So basically, that was a huge mistake that I made. And over the years, I met one of my friends who we actually started this business together with SPY ATM Alert. So he taught me everything that I needed to know in order to trade zero DTE SPY options every single day. And it was really through this approach that changed my trading for the better. So I really realized consistency. We use mechanical rules and position sizing. We'll talk about that in today's talk. And I found out that a lot of these things, these mindset things, these more intangible things that are not just related to what the win rate is or the position, whether it goes up or down, depending on what you're looking for. But really, these mechanical rules and position sizing changed me from a non-profitable trader to a very profitable trader in a very short amount of time. So we're going to talk about that a little bit more. And like I said, I'm focusing solely on just one trade a day, so very high quality trade over quantity, which is really nice because you're not spending all day looking at charts, scanning. You're basically trading one ticker, in this case, SPY, and you're trading zero DTE options on it. So you're only in this trade for a short period of time. So the focus for me was to stop basically being what I call a crackhead day trader, where you're basically just trading nonstop, trying to make that money. Just to get that one high quality trade every day at the same time. So I know when I'm taking that trade every single day. Very easy. Like I said, I'm the co-founder of the trade alert service called SPY ATM Alerts. We're going to talk about that a little bit more in the talk here. Let's get started talking about zero DTE. And basically, zero DTE can be a huge challenge for some people, but we've tried to make it simple. We're going to talk about why zero DTE contracts are so popular. We're going to talk about the benefits and the risks to trading zero DTE and how to manage these trades. We're going to talk about the key emotions and mindset aspects of trading zero DTE. This is very particular to zero DTE in particular, just because there's a lot of emotional and psychological factors come in when you're trading on a short time frame like zero DTE, where you have that time pressure that you've got to deal with psychologically as well, as the difficulties of predicting which direction the market's going to go. So I'm going to talk about why I trade zero DTE SPY in particular, and why our SPY ATM alerts work so well to make us money. So for completeness, I just wanted to cover what zero DTE options actually are. They're extremely popular. So since about 2021 or 2022, this new type of trading strategy has really caught the attention of many active investors, zero DTE options. So this really came out of COVID. Nowadays, there's actually zero DTE just a couple of months ago came out in some of the Magnificent Five stocks. But for a long time, zero DTE options were only available in things like SPY every day. So it's going to be interesting to see where zero DTE goes now that other tickers are getting almost everyday contracts for zero DTE options. So What are they? Well, they're simply contracts that only have 0 days to expiration. So that's what DTE is, days to expiration, right? So they expire the same day. And because of this, you're really looking at very short time frames. So obviously you're not holding these things overnight, like leaps. On the right there, you can see 365 days plus or leaps. Monthly, which a lot of people trade, is 30 days expiration. 0 DTE being the same day, you really have to look at things like minute-to-minute performance of the underlying. You can't even work on things like the 15-minute chart or so. From my experience, it's like you've really got to do these trades quickly. Otherwise, theta decay starts to really eat into your potential profits, even if you're right with the direction. So why are they so popular? Well, there's quite a few reasons. They're a lot cheaper than longer dated options. There's really no time value left, so these 0 DT options often cost a lot less than longer term ones. We're going to look at how much less in just a few slides here as well. Contracts can be as low as $100 depending on the volatility that day. Sometimes on SPY they'll be $200 or $300 depending on the volatility, but they can be as low as $100 or $150. So that's really appealing for people with small accounts or people that just want to trade small amounts of money on these, not take huge gambles on it. One of the main reasons people love these is that there's very rapid price changes. The price is really sensitive, so they can rise or fall in price really dramatically, often within minutes or certainly within hours. And this can get really quite risky when you're near market close hours. You risk losing pretty much the whole position if you're wrong. So you've got to be really careful with these rapid price changes. It's a double-edged sword. You can make a lot of money quickly, or if you don't time the market properly, you can lose a lot of money very quickly. So there are daily trading opportunities. The Chicago Board Options Exchange introduced daily expirations on SPY in 2022. And like I said, there's a lot more tickers starting to introduce CODTE strategies going forward here as well. And with the day trading rule disappearing, this is going to become exponentially more popular to trade these daily 0 DTE strategies, I think. So the next thing is there's no overnight risk, right? So sure, you've got these very sensitive option contracts, but you're not putting yourself at the mercy of too much. Obviously, you have to be careful about the economic calendar and people making announcements or the president making an announcement or the war escalating or de-escalating really quickly. There's a lot of things to consider, and it does still make these 0 DTE contracts pretty risky. But at least you don't have any overnight risk where you're gapping down massively and losing your position very quickly without any ability to really manage that position. So these obviously are very fast day trades, not overnight swing trades. So there are a lot of risks, and I think this puts off a lot of people. But in today's talk, I hope I can kind of convince you that if you're a bit hesitant with 0 DTE, if you do it the right way, the risks can be mitigated pretty well. So the first one I mentioned just there was time decay, so theta. This eats away at the value of the contracts quickly. So that's what I was saying. Like you've got to be right, and you've got to be right quickly. Otherwise, you can end up like not actually making any money or losing money, even if you're right in the right direction because of time decay. And we'll talk a little bit more about that in a few slides. The high sensitivity is a huge risk as well. It's gamma. This basically makes them react, these contracts react both up and down really, really quickly. And if you're not on the ball, you don't have the right orders in, which we'll talk about as well, then you can end up basically losing money faster than you can blink. So you got to be very, very careful with this. And we'll talk about how we can mitigate that a little bit as well. Execution challenges, sometimes people don't think about this, but the price is moving really, really fast. You might have your ideal entry, and by the time you place your order, the price has already moved significantly in your favor, but unfortunately, you're not actually in the trade to take advantage of it. So execution challenges, especially on less liquid tickers. Luckily, 0 DTE tends to be very liquid, which is nice as well. But you also have to make sure that you're putting in the right orders as quickly as possible. So knowing when you're going to do that is extremely important. And that's one of the benefits that I'm going to talk about in a little bit here, where basically you're able to trade at a very fixed time so you can be ready to go and you know what you're doing. So really in short, 0 DTE options, they're fast to move, they're cheap to buy, but they can be really risky if you don't use the right strategy. And this is a mix that appeals to some people. So the people that are chasing quick gains, 20%, 50%, even 100% gains on your position very quickly, this can be really appealing. but it's not suitable for many traders just because the psychological aspects make it very difficult. Can make it very hard to actually even pull the trigger on some of these options um, because of the time constraints as well. So you have to really make up your mind whether you're looking to make money quickly or if maybe it's just too stressful to do. So hopefully I can convince you in this talk that it's worth taking these strategies if you do it the right way. So I mentioned time decay, and really this is a huge factor. There's nothing worse than sitting there watching the underlying go sideways and your options losing money as time goes on. And this is really because there's no time left on these contracts. They lose their value extremely quickly. An hour goes by and you've lost some of your contract value. So unless the market moves in the right direction when you want it, fairly quickly after you want it to do it, the option premium can shrink to zero depending on the price of the underlying and the strike price of the option. So what you really need to do to mitigate time decay, right? You need a fast strategy, so something that moves quickly, sometimes in less than 20 minutes or so. You want a high win rate, so obviously you want to be right as much as possible. That's the case with all trading, and you don't want to be waiting all day for the market to move in the right direction. That's going to be a big problem. And the number of traders I've seen that are in the trade, but the trade doesn't move fast enough for them, and it ends up they end up stopping out, even though it's moving in the right direction, end up stopping out and losing the trade or break even on it, where it should have been a winner if it moved much quicker. So here's a good illustration of time decay for people that aren't super familiar with it. It's a pretty classic graph here, right? So on the x-axis, we have days to expiration. So we have 0, 30 days, 60 days, and 90 days. If you look on the left there, the time decay, what the time value does is a function of time. When you're at 90 days, the gradient on that slope is pretty flat, right? So basically, you can sit in these trades for days and not much happens in terms of theta decay. You're pretty solid for even like multiple day swing trades on that. But you can see as we move to the right here, we get this almost exponential decay in terms or slope in terms of the time value. So as you start to go to 60 days, you can start to see there is significant time decay, time value decay. The slope is no longer flat. It's started to trend down a little bit. But look what it does on the right. Look how steep the slope gets on the right there as you approach the 0 DTE contracts where the 0 is. It becomes really steep. And this is the big problem with theta decay, right? So this is definitely a huge disadvantage to doing these 0 DTE options compared to 30 days, 60 days, or 90 days out. So this is a nice illustration of why you need to be worried about theta decay for these 0 DTE options. So we talked about gamma a little bit, this extreme price movement. So this is an interesting plot here. It's basically, imagine you've got some at the money contracts. The green is the 0 DTE gamma. So obviously the higher the gamma, the more sensitive to prices it is. So you can see kind of the differences as you go out and in contract length here, you go to 10 DTE or 20 DTE, which is the orange. You can see that we have much higher gamma for the 0 DTE compared to the 20-day. It's almost 2.5 times less sensitive for the 20-day contract. So this gamma makes these options basically respond very sharply to the price changes compared to these longer dated options. And this is something that you have to be very careful about. The rapid price swings can really work for you. You can get out the trade in 10 minutes or 20 minutes, or you can sit there worrying that the price has quickly gone against you and time decay is going against you as well. So this adds a whole psychological aspect to trading these fast moving contracts. So there's a lot of key emotional aspects to 0 DTE trading. So these 0 days to expiration options really forces your emotional strength, right? You've got to really have a good, solid psychological or emotional reservoir here to actually handle these extremely fast-paced, high-pressure options contracts that have this potential for massive gains or losses very quickly. And we'll talk a little bit about why you might not want to hold for too long and try and get massive gains. What I do with SPY ATM alerts is just go for base hits over and over again. And they can happen very, very quickly. And basically, the high stress and pressure can really force you to make some really simple mistakes, basic mistakes that most traders would make. But with zero DTE, because of this time constraint, basically it can force you to make very bad decisions. You can exit the trade way too quickly. Maybe you've got 5% profit and you're getting a bit nervous, or 10% profit and you just want to lock that in. Well, with a strategy with an edge that really works out over hundreds of trades or dozens of trades, you've got to be very careful about when you take your profits, like any trading really, but it's definitely amplified in zero DTE trading. Very high stakes decisions, you can lose a lot of money very quickly. This all puts stress and pressure on you as a trader. The fear of loss is also really real with zero DTE trading. You really don't want to exit early just because like you're trying to cut your losses. You want to stick with the plan, and we're going to talk about what the plan is later on in this talk. But basically, the fear of losing 50% of your position, which is very common with zero DTE trading losses, 50% or more, can cause you to hesitate or take these early exits, which really hurt and can actually skew your strategy from being a profitable strategy if you'd stuck with the rules to being a losing strategy. So this fear of loss is a huge problem with trading, but with zero DTE, it's worse. Of course, the other side of that is greed and overconfidence. This is actually where a lot of traders get burned with zero DTE. They want those 50%, 100% moves, and these can happen really early in your zero DTE career, right? Like you can get some big wins very quickly, and this can lead to like really overconfidence. So really thinking that you've got a winning strategy that's going to work, and so you see a few wins, 50% wins, 100% wins, and then you decide to scale up, right? So I see this over and over again. People will try and scale up because they won their first couple of trades with their strategy, and of course, this leads to over risking your account. And often that then messes you up completely, right? You'll hold losing trades too long, you'll deviate from your plan. And it's really not a good thing. We'll talk a little bit more about that in a few slides as well. Impulsive trading, this kind of ties in with the greed, overconfidence, and fear of loss. The emotional driven decisions just replace your plan. And as you know, as traders, we have to stick to a plan. If you don't have a plan, you're basically planning to fail at zero DTE trading. And this is one of the most important aspects of zero DTE trading, in my opinion. But of course, you get the adrenaline junkies. So again, this can override risk management. You just are so obsessed with seeing that big gain. You double your position in 20 minutes. You're like, this is fantastic. But adrenaline trading never works for people. So those are kind of like the key emotional aspects of zero DTE trading. I just wanted to show you a slide here about the options costs. I mentioned that they're a lot cheaper than longer term options. So the longer term options are more expensive, but how much more expensive are they? If you've ever compared the options chains, you'll know they're significantly more expensive. So here's an example on the Qs. And so imagine the Q's price is 349.2. And so if you're buying 350 calls, so at the money calls for zero DTE, you'll pay about $1.10 often if the volatility is not too high, which obviously is a cost of $110 per zero DTE contract. Comparing that to the 18 days to expiration 350 calls, or even the 81-day calls that are at the money as well, look at how quickly the price jumps up. So just 18 days out, and we've gone from $110 to $730 for the cost of these contracts. So it gets even worse as you go further out. So you're thinking that you'll minimize the decay and you'll start buying the longer dated calls. It's just becomes unmanageable for people with small accounts because look at the cost, $1,600 for the 81 DTE 350 calls compared to 110. So 7 times more for the 18-day and 16 times more for the 81 days. So this really hurts if you have a small account. If you have a $2,000 account, you can't be spending $730 on a position, or certainly not $1,600 on a position either. So the next thing is this gives you an opportunity for small account traders to actually buy these contracts and make money. So it's quite remarkable the difference in the prices. Here's another example. Imagine you bought ATM call options on the queues again. This is really showing what happens with delta. And so imagine again the queues are at 350 and that they move up by $1. So this would correspond to the zero DTE contracts going from 110 from that previous example to up by 45%. So if you go up by 50 um, on the queues, go up to 45% profit. So that's an amazing profit on the zero DTE. 45%, I'll take that any day. It's fantastic. But look what happens with the same move in the queues. So the queues still move by $1, corresponding to a 50-cent increase in the options price. Well, obviously with the 18-day contracts, you bought them for 730, 7 times more than the zero DTE. So the proportional amount that these move is much, much smaller. So you're only going to get 7% gains on these 18-day to expiration contracts, which is pretty bad for a day trade at least. 7%, we're definitely going for a little bit more than that. But the situation gets even worse. So not only are you paying 16 times more for the 81 DTE contracts, you're only getting a 3% move for $1 move on the queues. 3% is very low and not something you really be looking at for this type of intraday trading. So maybe you do better with swing trading with these, but if you're looking to day trade, really the best option is these zero DTE calls. We don't go for as high as 45% in SPY ATM alerts. That's still considered a pretty large gain. It's easier to get smaller amounts, as we'll talk about in a few slides here. So just to kind of summarize, long dated zero DTE options, versus zero DTE. So long dated and zero DTE. The pros of zero DTE is you do get these quick potential returns, very satisfying, and keep you motivated to keep trading. The lower costs are fantastic, especially if you have a small account. But even if you don't have a small account, being able to take more contracts and be able to scale in and out is really, really important. It means that you can manage the positions more carefully. You can manage your risk by scaling out and then putting a stop at break even or something like that. With, if you have 10 contracts instead of 2, you can scale out more efficiently. So even with larger accounts, these zero DTE contracts are superb. And so the high sensitivity to price movements, very important for those quick potential returns. Now, like we talked about here, the cons are rapid time decay. So this is something that you're always going to be fighting against with zero DTE. The extreme price sensitivity is a double-edged sword. So obviously you can take losses very, very quickly. And because of this, the execution risks are definitely real. And so I'll show you what we do in a few slides here to reduce the time decay, to minimize the potential for a large loss from the price sensitivity, and also what we do to make sure we get a good fill in these contracts as well. And so the big question is, why trade zero DTE SPY options in particular? Well, SPY is one of the most heavily traded securities, obviously, in the world. And this allows, because the zero DTE has such high volume in the contracts, it's very easy just to use market orders to buy into this. And so that mitigates some of the potential execution problems. This liquidity is extremely important for trading these. The spreads are really, really tight, and the high liquidity means that basically you don't have to worry too much about getting filled quickly and efficiently. And so for SPY, we have zero DTE options every single day. Many tickers don't. Like I mentioned before, there are more tickers coming out with zero DTE options. So far, they're not every day, though. I think they're Monday, Wednesday, and Friday on a lot of these other tickers. So if you're looking to trade every day like I do, then it's something that you might want to look at for trading SPY. It makes things really simple as well, right? So if you have one ticker that just follows the market, and basically you're not exposing yourself to a lot of other risks apart from things like economic announcements and things. So basically that's one of the main reasons for trading SPY for me. Simple, easy, don't have to scan for a lot of different stocks, anything like that. And of course, because they're cheap, so you can use a small amount of capital, which is really nice because that defines your risk really well, right? You don't have to use tens of thousands of dollars. You can if you want, but you can use just a few $100s if you want. And so SPY is really not just popular by accident. Its liquidity really matters. And the tight spreads and deep volume make SPY ideal for these intraday options, but only if you approach it correctly. And that's a big if. I've talked to many traders over the years that trade 0DTE options, and it's really something you have to be careful about. And I hope that when you see some more of the results from our system, that you'll be interested in joining us, because really, once you master these 0DTE options, there's nothing more fun than entering a trade, waiting 5, 10, 15 minutes, and then exiting for profit 80% of the time, which is it's a phenomenal feeling, and it really changed the way that I trade. So let's talk a little bit more about SPY ATM, why it works, what the strategy is, why it works when other strategies fail, and what we do differently from most strategies out there. A lot of people just really don't have a plan when they enter these trades. They might just be looking at something simple like EMA crossovers, RSI, some lagging indicator. And that really doesn't, it's been kind of shown that over a lot of different trades over long periods of time, that a lot of these lagging indicators and things just simply don't give you the edge that you need. And so the SPY ATM strategy gets around a lot of problems here. It's very simple, it's very fast, it's very accurate, and the trades are executed very mechanically using OCO orders. So this is really important. A lot of the problem comes when you're basically looking for too many individual tickers, right? So SPY ATM obviously focuses on the SPY, although we do alerts for the futures as well. So MES, there's also alerts for those. So people that are looking to do prop firm stuff can also benefit from this, and it's something that I'm working on at the moment as well. So when you're trading too many individual tickers, it's a lot of work. There's earning surprises. There's halts sometimes, company-specific news that can really destroy your 0DTE options very quickly. And so focusing just solely on SPY options with a very mechanical approach is what we found works very well for the SPY ATM strategy. And so why do most traders fail? Well, the biggest mistake that I've seen over the years of doing this is that they don't use a mechanical system. They'll often just market order in, sit there and watch their position the whole time, and then market out. A lot of people, it's kind of crazy, but a lot of people don't put in things like OCO orders, and that's absolutely critical for these emotional decisions that you're making. You want to place those orders before, as part of your trading plan. You don't want to be just reliant on your emotions, because 0DTE will shake you out like nobody's business. So you want to place these orders using an OCO order so that you have your predefined take profit. You want your stop loss already in there. The number of times I've seen people lose money because they just keep moving their stop loss because they're sure that it's going to work out eventually. So you place the stop loss and take profits beforehand, and before you can actually get into any problems with the trade. Position sizing is another huge aspect that I've seen a lot of people failing on. Again, this comes down to things like desperation. So desperately trying to grow your account, trying to use too big position sizes because you want to make $200 a day or $500 or $1,000. And so these mechanical rules, by placing OCO orders, simplify decision making, they remove overthinking. It makes things life so much easier. So basically, this is a huge problem. It's something that we address, and we really drill it into new subscribers, especially new traders, to place these OCO orders. And I'll show you an example of what that looks like in a few minutes here as well. And so doing this enables this flawless execution without fear or second guessing. And it really is your edge in a lot of ways. So I was talking to somebody recently, a very successful trader, and they were actually testing a strategy where there really was no strategy. So all they did was enter almost at random times, which is absolutely unheard of, right? It seems absolutely ludicrous. But they would place their orders at random times, so the entry didn't matter. And then what they would do is manage the trade with very effective stop loss and take profits. And what they found is, and this is crazy, it's the first time I've heard of it. What they found is they could be very profitable by doing this. So not even bothering to time an entry, which is absolutely crazy, but it shows how important this trade management with these take profit and stop loss orders actually is. It can really make or break your trading strategy, is what you guys probably know. But it's important to kind of re-emphasize that. It's one of the main things we do at SPY ATM Alerts is try and encourage people to do this properly. And the results are very obvious. When people actually place OCO orders, they're profitable with the system. And when they don't, they often get shaken out and then actually end up losing money. So let's talk about timing. So why do we do the trades when we do them on these 0DTE SPY trades? This is really important. Timing matters more than direction does. So you can have the same setup as somebody who's trading. You can take the same entry, and you won't get the same result a lot of times. You do if you use an OCO order. If you both use the same OCO order, you get very similar results. But a lot of times, people don't get the same results, and it can often come down to when your timing is. So timing really does affect your risk in the market with 0DTE, and we're going to talk a little bit about when the best time, in my opinion, and experience is to enter these 0DTE trades. What time of day do you want to be doing these? And it's important to remember again that options pricing is time sensitive with these. So two traders can be right on the direction, even if they're hours apart. Maybe it's a bullish market for that day, but they can still have opposite outcomes when they're trading 0DTE because of things like timing, decay, volatility, and execution quality. So one of the mistakes I made early on with those penny stocks is started trading at market open. I'm not a fan of market open trading. I know some people are because the volatility can really help. But I always found that my psychological makeup basically isn't suited for the chaos that can be the market open. So that's one of the reasons we designed SPY ATM alerts to be done a little bit later than market open. Mid-morning is when we do the trades because there's a lot of structure. Volatility is calmed down. And you don't have to worry about buying when the volatility is really high and then the volatility crushes you as it calms down after the market opens. So that's one of the reasons I avoid market open as well, is the volatility. A lot of newer 0DTE traders will try and trade the open. And in my experience, it's not been the best way to do things. Midday, you have compression, and then in the afternoon, you have positioning, institutions positioning things later on. 0DTE trading doesn't work great in the afternoon, from my experience, because the time pressure just becomes even worse, and things can get quite crazy. Some people have success with it, but after lots of testing, we found with SPY ATM alerts that the best time is mid-morning, where we have that structure. And so it's important that you remember that the market has this rhythm, and that understanding when to trade is often more important than what you're trading and how you're trading it. The timing is really important. Again, the market open was when I found I'm not a good trader at market open. The high volatility, the wide spreads, like we're still trying to find the right price, so you can often have wide spreads. You got a lot of false breakouts. This is what would always kill me, is these false breakouts. And where you get shaken out, you have a selling and then it just whips back and rallies for the day. I just couldn't handle that, and I think a lot of people are the same. There's a lot of emotion from retail traders at the market open, and I was one of them, for sure. So even though the first 30 minutes might look exciting with 0DTE trading, in my opinion, they're often a trap. Price discovery is still happening at this point, and liquidity hasn't fully settled, so it can definitely be a problem. The high volatility is what would always get me, so it's got to be very careful at market open. And talk a little bit about position sizing. This has been critical to my recent success. Basically, the risk per trade really matters, and you want consistency over confidence. So you want to take a lot of little base hits over and over. Just build your confidence, keeps you motivated to keep trading, and it'll save your account eventually. So you want to size based on your loss tolerance, is what we kind of preach in SPY ATM alerts. And this is smaller than a lot of people think. So typically about 5% of your account, just to keep you in the game, keeps you coming back to keep trading. If you want to grow your account fast, it's a false economy to overposition. And that's what I've seen over the years, is most blowups happen when people are oversizing, not when they have bad analysis. Often it's just when they're oversizing, and it becomes a game. of being able to stay long enough for that edge that you have in your strategy. Hopefully you have an edge. We do with SPY ATM alerts. Hopefully you have an edge, and that takes dozens of trades to work out. One of the big things I see people doing is oversizing, taking a couple of losses, and then they just go, oh, this strategy sucks, and moving on to something else. I played that game for a long time, and it's not a fun game to play. You just lose money, turn to another strategy, lose money again, over positions to try and make back what you lost, and it just goes downhill from there. So we preach these proper position sizing and small base hits over and over and over. So we've discussed why zero DTE is so popular. We've talked about the risks of zero DTE trading, why most zero DTE strategies will fail, why a lot of people are very worried about zero DTE trading. Basically talked about the market timing as well, why we go for the market structure approach. It's just fairly soon after the market settles down after market opening. We talked a little bit there about position sizing and risk mitigation as well. So I keep talking about SPY ATM alerts. Well, I just wanted to kind of formally introduce it and tell you a little bit more about the service. And so I've actually spent a lot of time testing and reviewing systems, and I can confidently say that this is one of the best systems for zero DTE trading out there. And so imagine that all you needed to do was place the trade. So you're given the trade, you're given the stop loss, you're given the profit target every day inside a Discord channel, and all you have to do is place one order for the day, and then you're done. So you just sit there, and you don't even have to watch it. In fact, we tell people not to watch the trades a lot of time, just because you just want that edge to work out each time. So the system is really simple. It's a single rule-based SPY zero DTE trade every day at 10:30 a.m. Eastern time. So you know when the trade's going to come out. You can be sitting at your computer 5 minutes before, ready to go. When it pops up on the Discord channel, you can execute it in seconds. You're in and out within 20 minutes usually. Sometimes it's 5 minutes, sometimes it's 40 minutes. But the average is about 20 minutes. So that's what I plan on during the day. You get these exact entries, exits, and even a risk plan laid out for you as well. So it's very helpful if you're a new trader. So here's an example of one of our SPY ATM alerts from the Discord. You can see it on the left there. So this is back from January. And so it was a call alert at 10:30 Eastern time. SPY was at 693. You get the strike price of the options. Obviously, there's zero DTE, so you don't have to worry about what option to buy. It's just the 693 calls in this case. You're given the entry price, so you go to use OCO order, put the entry price in, you put your take profit price in, and then you put your stop loss in. The stop loss is quite loose for these zero DT options. It has to be. We tested this over years of data. And basically, you want a loose stop so that you don't get shaken out by this high price sensitivity that we talked about early on. You need to give them room to work. So it's very important to put these OCO orders in as they come out in the alert like this. So this is an example of the daily alert. You do get a lot of bonuses as part of the system as well. We're very aware that we get a lot of new traders with small accounts. So we try and make it as easy as possible to reach your financial goals. And the alerts alone are generally enough, especially if you listen to some of the advice from more experienced traders. And we like to go above and beyond for subscribers. So we include a bunch of onboarding so that if you're not very familiar with how to place trades, you can learn how to do that very easily. We have some tools we'll talk about in a few slides here. We have some education as well for people that like to learn a little bit more about how the system works. And we have a really nice community as well where people discuss these trades and share their profits and losses in the system. So the active Discord community is really, really important. This is where you can chat with hundreds of traders that follow the same alerts. You can see an example down at the bottom here. This is the SPY ATM chat for people that are in this. And you can see that often within a minute or so, people are posting in at 125 and at 126. And then very quickly here, this is a quick trade. You can see that just a minute later, Dr. Ninja here was out at the take profit. Which is nice. So Martin got out at 152. So we're not looking for 50% gains here. We're actually looking for 20% gains. If you noticed on that previous slide, we're not looking for huge wins here. This was a quick one. As Stockmeister saying, it was a quick one today. And people are getting in within a few cents of each other. So 125, 126, 129. Not sure if these people are placing the OC orders and just not getting filled at the same prices, but generally the entries and exits are very close together. I think a lot of people listen to the advice. And so you can learn a lot from these guys who've been doing it for a while. A lot of them have their own systems as well and are very successful traders. They're just using this as a way to supplement their trading strategies. And so this chat room is open to people that buy the quarterly and VIP annual subscribers as well. So part of the bonuses is we give attendee quick start guide. So this teaches you how to set up the OC orders if you don't know already. Gives you a video guided tour of the Discord, what we have in there. Basically a lot of advice on how to size positions effectively, how to get started with SPY ATM alerts video guide, how to place these OC orders. It's amazing how many people don't do this. If you do it, you probably think this is very basic, but a lot of people, a lot of new traders especially, don't really think about doing this. And so we really focus on this and teach people in Thinkorswim and Webull and other brokerages as well how to place these orders effectively before they get started with the SPY ATM system. We do a lot of planning with people for account scaling. So another bonus for joining as well as the alerts here is sample scaling paths to, if you're using a $2,000 account, 5,000 or 10,000, we map out the exact compounding scenarios and ways to scale up and go through the different tiers of when you're trying to grow these accounts, specifically with SPY ATM alerts. So we talk about the max daily loss rules, compounding scenarios, when not to scale. It's important that you don't scale too quickly, for example. We talk about the common pitfalls for small accounts and how to avoid them. So there's separate guides for scaling these small accounts. And if your account lies somewhere between these or higher, you can often use the rules and setups that we found to be really effective as well. So there's another bonus as well as the alerts. We do a weekly debrief. So we do a weekly video going over what trades we did. Sometimes there's skips, so it's not every single day. The algo that does all this, very sophisticated algorithm. And basically, it'll skip low probability days. So that's a mistake I see a lot of people doing is they'll force trades for these zero DTE SPY trades. Well, the system that we use figures that out and skips days that would be a little bit lower probability. And that's probably one of the reasons why we end up with nearly an 80% win rate on these trades. And so we go through what we learned that week. People ask questions in the Discord. Sometimes they're still struggling to get set up and everything. So we go through and we guide them. I'll answer questions on that and making sure that everybody's prepared for the next week as well. We also give as a bonus a performance tracker. This is really nice. Really, if you're not doing this, it's something that we found to be absolutely critical for trading zero DTE SPY in particular. You've got to make sure that you're calculating your win rate, that you're documenting your trades, that you're taking notes about what you did wrong and did right. So this performance tracker really helps with that. It's really essential for small account growth in particular. You can uncover patterns in your trading. Maybe you've got some problem with placing the orders, and you notice that when you place an order with an OC order, you get better results than just manually going in and out. You can monitor your consistency. It can help improve your decision making. It's really more than just a tool. It's really a strategic asset that helps you stay on top of your game. So I also mentioned that we do prop firm stuff as well. So this has become very popular. So because we're basically predicting the market with our algo, you can directly or very closely relate that to MES. So we teach how to mirror these alerts from SPY on MES. The alerts are also given as well in a separate channel. I didn't show you that, but they do. We also we have a lot of experience with prop firms. So basically, there's a lot of risk-specific rules to trading with prop firms. So we have a guide all about how to do that properly. The props firm sizing rules for the alerts to make sure that alerts follow the rules of the prop firms. We talk about the advantages of trading MES over SPY. For example, no time decay, which is really nice. So if the trade's lasting a bit longer, you can often get a better result with MES over SPY. We also have a guide on how to avoid common prop firm pitfalls with the system as well. So it's a fantastic ability to actually pick trades on the futures as well. And we have a lot of members doing that as well. So what is SPY ATM alerts for? It's for people that really want to change their trading for the better, really want to follow a mechanical rule-based approach. People who want to make money, especially at a specific time around 10:30 Eastern time, rather than watching charts all day. This is really good for busy professionals who don't want to be glued to the screen all day, or anybody who doesn't want to be glued to a screen all day. It's really for people that are looking for single trades, not all day scalping, people that really value defined risks, clear exits, and consistency. Like I said, there's an 80% win rate on this. It's very consistent. And if you only have 20 minutes a day and you just want to focus on a single trade, that's what you want to be doing. So we have a lot of testimonials and things. Zig Price was a struggling trader, very new trader, and this is what he had to say about the strategy. I don't agree with all of it. Some of it goes against what we preach, but each to their own. He says SPY ATM is easy enough to grasp, but open enough to tailor to your own strategy. I don't recommend that. The strategy has been fully tested, forward, backwards, every sort of test that you can do to work as a mechanical system. He says if you want a set and forget alert every day at the same time with a high success rate, this will fill that easily. If you want something that you can develop a strategy around to adjust to your own risk level, make your own, this can definitely fill that as well. It is scalable. It has 18 months of back tested proof. It is a lot more than that, forward tested as well, and real life trades. It's a couple of years of data, 2 or 3 years. And he says it just works. It does. And he's tried half a dozen services over the past few years. This one's been the most competitive and easy to implement. Show up, place your money, place your order, and make money. So yeah. Investing Teacher has a really good success rate with this. He started with $10,000 and made 78% on his account in 6 months using the SPY ATM alert service. He took out profits, he says, and he still has a really nice balance here. He made 78% or $7,778 in 6 months, which is really fantastic. The ease of entering alerts and having set time come in is really important. He highly recommends it. This is actually his account growth. So he actually sent this to me, a spreadsheet. So I plotted out here almost an 80% account growth since May in 2025. So this was last year. And you can see that we had this really nice profit loss curve over the 6 months, which is really, really nice. Just to put that into perspective, this is some of the results that we had. If you were to average profit of 20%, which is what the OC orders are set to, if you're using $10,000 positions, so a bit larger account here, this would be $2,000 in profits every winning day. And they're not all winning days, 2 out of 10 or so will be losing days. There are some skip days. So you can't count on that $2,000 every day. But imagine what it'd feel like to be taking these positions and making $2,000 with this system for 20 minutes of work, even though it's really only a couple of minutes of placing an order. And so Lance started with 2,000, or not Lance, but one of the guys started with 2,000, ended up with 4,000. So really, the service is phenomenal. And Lance grew his account by $8,000 in 6 months. So really, I've seen a lot of services that charge a lot more than we do, that don't have the proven track record and stuff. So I've seen people selling much worse services for $2,000, $3,000, $5,000. And so we wanted to keep this easy and accessible for people. So we don't charge anything like that. Basically, we charge quarterly access for $300. So $300 is very low. For that, you get the daily alerts on the 0DTE SPY options at 10:30 every day. You get all those bonuses that I was just talking about, the quick start guide, the active Discord community. You get the account scaling blueprints. You get the weekly debriefs, the performance tracker, and also help with trading prop firms as well with MES or ES. And so the link to join us, and I hope you come and join us. I think you'll really find this a really fun system, is at the bottom of the screen there. So tradethirsty.com /SPY. You can also scan the QR code up the top right as well. And so one of the best things about this system is all the help that you get. So there's a lot of moderators, and a lot of them are trading this every day as well, and they really give out advice for people that are maybe struggling. It's very simple though, so it's something that I highly recommend, and something that changed my trading for the better as well. And so with that, I'm open to any questions. So any questions from anybody? If not, think the link's just been posted in the chat here.
Are you able
No
to see the
question.
chat? There was a few random comments, so I don't know if they're
Oh, do you think you could read them out for me? I'm having a hard time finding them on the thing here.
um okay. Yeah, it looks like it was just reactions to what you were saying earlier in the
Yeah,
presentation.
yeah. So
Um
no questions, I guess.
Not seeing any yet. Um yeah, we have a few more minutes with Russell. If anyone has any questions, go ahead and post them.
Yeah. I mean, it's a fantastic system. I really love it. I think it really sums up everything I'm looking for in a trading strategy. Uh, for sure. Yeah.
Yeah, sounds good.
Have you ever tried trading zero DTE, David?
Um let's see. Not no. Not yet. I have, like 1 or 2 day time horizons for options, but yeah, not the zero DT yet. Um, but I have, I have watched, you know, the options at that scale and how they move,
How
and
they move,
yeah,
yeah.
it's
Yes.
when there's a really big move on, or like when silver was going crazy a few months ago, I would, watch, open
Watching,
my
yeah.
account and watch how they were moving.
Yeah.
But
Yeah.
yeah, it's really interesting. I might have to give it a try now.
Yeah, yeah, definitely, yeah, for sure.
All right.
Good.
All right. So yeah, everyone hit Russell's link there and check out his offer.
Great. Thank you very much for your time, and hopefully you guys enjoy the rest of the day's talks.
All right. Thanks, Russell.
Thanks. Have a good day.
All right. All right. So Simon Klein is up next. And this is day 3, final day of this event. Um, so just a reminder, I am recording each of the presentations individually, and I'm getting those processed. I'm also live streaming to YouTube. There's several people on YouTube listening right now, so welcome to you too, of course. Um, and yeah, so the entire presentation, the entire day is being archived instantly to YouTube for you to review at any time, and then I will have the individual days, um, or the individual presentations posted as well soon. And I don't have it ready yet, but there will be a page on Timing Research that has the full archive for the whole day. Um, all right, so we have a couple minutes here before, um, you know, while we're waiting for Simon to join us. Um, so, just a couple other things I can share with you that I think you'll like. Jeff Tompkins is doing a session tonight at 7 p.m. Eastern time, so it'll be after this event is over. If you hit that link, you can get access to his PDF, his new report about his one-day options trade, and then a session tonight. Um, that's that's his take on zero DT options. So, If you're interested in that topic, check that out. Also, our friends at NetPicks has a new report about iron Condor options. Oh, and here's Simon. Hey, Simon, you there?
Hi, David. Hey, how you doing?
I'm good. How have you been?
Yeah, good.
All right. Um, all right. Well, happy to have you here. So you should be able to share your screen and get set up.
Okay, let's do that. Share. Let's get the right one. I think it's this one. It's telling me it's screen 4, but it's really screen 3. Funny order. Okay, let's see. You
Oh,
can
okay.
see this?
Yeah, looks good.
Right, I can see the chat as well. We can just close everything else down.
Okay. Are you ready to start?
Yeah, pretty much.
All right. I'm going to start my recording again in just a second, and then you can start your presentation. So I'm just double checking everything. Looks good. Okay. I am recording again now.
Okay, hi everybody, and welcome. What we're going to discuss today is how professional traders read price without indicators. We're also going to do a live market analysis as well. We're going to jump in, I'm going to teach you something, and then we're going to jump into the live markets as they are right now and apply exactly what we're going to learn during this session. So, a quick disclaimer before we begin. And here's our agenda. So, this session is about how professionals read price, not trade signals or shortcuts. We're going to ask the question, why am I always wrong? We're going to go into professional chart reading. And again, you won't find this in any book. It's based on over 20 years of in the market experience. We'll look at supply and demand as one of the main areas of focus when reading charts, and then we'll take that into the live markets and we'll open up to audience questions and answers at the end. So here's a picture of me giving a live presentation at the New York Traders Expo, and plus I was also invited to speak at the Bogu Investment Forum in China. And you may notice some of the speakers below. There's Jack Schwager, author of the Market Wizard series, and various other ministers of finance in China, and I guess in that area of the world that you probably wouldn't know. Anyway, here's a little bit about me as well. A little bit about TradeSmart. We're a trading education business, and we focus primarily on teaching you how to read the market professionally. That's the framework, the foundation of reading any chart, doesn't matter what sector it's in, whether you're trading the stock market, forex market, futures, chart's a chart. And then how to run a successful trading business. Knowing how to read a chart is not enough. How do you take that and develop for yourself your own trading plan and strategies which fit your personality and lifestyle? Again, it's very important that it fits you. You can't trade someone else's strategy or way of trading unless it fits your personality and lifestyle. So here's the first question. Why am I always wrong? Now, the reason why this is very important is about 20 years ago, a bit over when I started to trade on a professional trading floor, there were two traders on the floor who were always on the opposite side of my trades. As a beginning trader, I was always on the wrong side of the market at the beginning. Didn't take long to learn, but I was the counter indicator. So if I used to call out I was trading New York Stock Exchange stocks at that point in time. That's all we traded. And if I would call out a stock to trade and say I'm going long, I would walk past their desk and look over the shoulder and see they were on the short side. Now, it is possible that you can both make money in that scenario as well. If I was trading a small pullback on the short side and they were going long and holding for a bigger move, it's possible that we're both right, but this wasn't the case in this scenario. It's easy to think inconsistency comes from not knowing enough, but in practice, it usually shows up when decisions are made under pressure without structure. That's why a framework matters. And this is why I developed a framework many years ago now. And I use that framework to read any market. Doesn't matter what the market is. I've used this in even the residential market, real estate as well. So you can literally use it in any market as long as you can chart it. You can look at the charts and understand where price is, understand where price is likely to go and what the probabilities are as well. I've taught over the past 20 years, thousands of traders, and both I used to teach also institutionally as well as in the retail world. Today I primarily focus on the retail world. So let's have a look at the first problem. And this was me at the beginning. And if you can relate to this as well, let me know. So you see the market going up and maybe using moving averages and you see, oh, this is an uptrend. And you take your first trade on the long side over here and it moves in your favor and you're like, okay, great, I'm making money. And then all of a sudden the market turns, goes down, and maybe you don't have a stop because obviously it's going to work. It's your first trade. And you look at the screen and you see a P&L that's getting more and more negative until usually you take an emotional decision now to get you out of flight or fright, the nervous response. And in order to get back to safety, you need to cut the trade. So you take a short, you close the trade by selling it. But now what's happening to a lot of people is like you're down and you want to make that money back. And now you say, okay, the market's going down. I made the wrong decision. So I'm going to go on the short side now. I'm going to double up and make that money back. And if I double up, it will happen a bit quicker. Yeah. So you take your second trade on the short side over here and it goes a bit in your favor and you think, okay, I'm making it back almost. And then all of a sudden the market turns around again and you look at the P&L and it's getting bigger and bigger negative. You sit there and you're frozen and you're like, until you're in that flight or fright state again, and you need to get out of danger. The body is now, it's a physiological response and you're in survival mode and you need to get yourself out of danger. So what happens is you take the second losing trade, you close out and now you're not in danger anymore, but you've taken your second loss and you're not feeling so good about it. So you think, okay, great. So maybe the market really is going up. So you take your third trade over here and what happens is it turns around and you are down quite a bit now. So you're like, okay, this trend thing doesn't seem to be working for me. I spot a trend and it's going up. I get on the buy side, and then it changes and then it goes to the downside. So you think, okay, well, maybe this market's sideways. So every time it comes up here, I'm buying. Maybe I should be selling. So what happens next is you think, okay, I learn about, support and resistance, and this is resistance. So I'm going to take a sell as the market comes up here. I'm going to put everything on it because I need to make that money back for whatever reason. I don't like being wrong and losing money. And how am I going to explain it to my spouse that we're down today quite a lot? Doesn't feel good. So you take your fourth trade and you think this is going to work because every time it came up here, it went down. But what happens this time is the market continues going and you close out and you almost, you're down 50% on your account. Not very good, not great risk management, but that's what happened. And you throw your arms up in the air in dismay. You don't know how you're going to move forward. And guess what? You come back tomorrow and you do the same thing again. It may be a slightly different scenario, but that seems to be what happens. So what you need to do is take a step back and understand these areas on the market, and they're called supply and demand. Now, support and resistance is abstract. Supply and demand is really what's happening in terms of order flow, in terms of orders sitting in the market. Unfilled buy orders is demand, unfilled sell orders is supply. And you want to know where institutions, which big money, are placing their orders. And if you learn how to read the charts well, you can do a pretty good job. And I'm going to show you how to start to do that. Again, it does take a bit of practice, and not every level is a good level. But what I've done is I've used these principles over the past 20 years plus and taught thousands of traders how to do this. And again, if you apply this to your trading, you'll be amazed how the markets go to these levels and turn from these levels. And again, it works on every single time frame. Doesn't matter if you want to do it on the smaller time frame, then you're going to be in and out of trades quicker, as opposed to the larger time frames when you can actually catch bigger moves. So as we said before, what's important is the framework. Most traders aren't trading the market. They're trading interpretations, indicators, patterns, opinions. Professionals strip that away and focus on one thing, where real buying and selling must occur. And this is why this is so important. When I first started to learn how to trade, as I said, I was on a trading floor with quite a large number of traders, and I was mentored by two traders, the two top traders on the trading floor. And we were taught how to trade the specialist system of the New York Stock Exchange. So we would spot what the specialist was doing, and we would do the same. So if the specialist was on the buy side, we'd be buying. And likewise, if the specialist was selling, we were on the sell side. We were taught to read the time and sales and the order book, the open book of the specialist, and look at the prints going off in the market, yeah? And we were able to interpret exactly what the specialist was doing based on that. There were certain patterns that we would watch for. And a print basically is when a trade is done, it basically says the time, the number of shares, and the price. And you're asking, well, was it a buy or a sell? Well, every transaction in the market is obviously a buy and a sell. There has to be a match on the buy side and sell side. Whether price goes up afterwards or go down will tell you which side of the market is winning at that point in time. If it goes up afterwards, then obviously there's more demand than supply and prices go higher. And we're going to go a little bit more into detail with that shortly. But let's, for now, talk about this. So this is the framework that I came up with. And again, it's a multi-dimensional framework. It's very, very simple. The pivot analysis is what teaches you, or what you use to look at the market and tell what trend is the market in. Is the market trending up, down, sideways, or in between trends? Remember, there are states, for example, we just broke the uptrend. It's not in any trend at the moment, it's trendless. But if that happens, and that happens to take place at a certain location in the market, remember location's key, and this is what supply and demand is very important, then it has much more weight on it than if it happens just in the middle of nowhere. So location is very, very important. Just like in property, we say location, location, location. Same thing in the markets. Location, location, location. Where is this price action happening? Where is this pattern happening? Is it happening in a relevant place, in a place that I care about or not? So pivot analysis will teach you how to read the trend. Supply and demand analysis is going to show you where those levels of institutional buy and sell orders, where those unfilled orders sitting in the market, that the price almost has to go to those levels. Remember, when business is to be done in any business, the salespeople usually go to where the most business is to be done, where the most orders are waiting to be filled. So the market is no different. Whether there is a large number of orders to be filled, the market will end up going to that place. And your job is to figure out where that is, because that's usually where those turning points are in the market. And price direction is everything you need to know about Japanese candlesticks taught in one quick way that you can determine exactly when you look at the market, is price going up or going down? That's really what's the most important thing of every single pattern in Japanese candlesticks is what's going to happen next. What are the odds? Is the market going up or down? So price direction tells you what's the current direction of the market. And the multiple time frame analysis gives us time. We're able to zoom in and zoom out to see the context of where this price is taking place. Is it happening within the larger time frame supply area, demand area? Is it an uptrend, say on the weekly chart, and we're trading in a downtrend on the daily chart? But what happens if the downtrend in the daily chart ends? Maybe that's the place where the weekly uptrend continues. So it's all about putting it together. So we have a three-prong approach. Remember, if you have a table or a chair and you put one leg on it, it could wobble over. If you put two legs on, also. Once you've put three, it becomes stable. Each one of these alone, you can build a whole trading system. You don't even need all three, but the magic happens when you put all three together. It increases the odds of your trades substantially, of actually understanding what's happening in the market. And multiple time frame analysis will help you give you context. So you usually want to look at the higher time frame than you're actually taking trades in to see the context in which you're trading in, and the lower time frames to actually enter trades and manage risk. And this is the key. And this is where you can actually, you don't need anything else. The charts will teach you all you need to know once you have a framework for reading them. And again, this is the first foundation, especially if you're chart reading, if you're using charts to become a trader, this is a good place to start. And even if you've got, most people start on strategies, but they haven't got the foundation of how to read the market. It's much like driving a car without understanding road conditions. So the strategy is, how do I drive the car? But if you don't understand road conditions, you won't understand if the traffic light's red, you need to stop. But you never learnt road conditions, so you're driving the car and you know, doing your strategy all over the place in the wrong conditions. So you need to understand the context of the market in order to know when your strategy is likely to play out with the highest odds. So this is the key. Again, once you have this framework, you'll be able to read any market. You won't need to rely on anyone apart from yourself and your own judgment once you get good at this. And again, this is a process that you go through as you trade, but you can use this as a foundation in which to grow as a trader. So let's show you a few ideas and a few examples to really drive this home. So let's go back to basics. And I'm assuming most people here are not just beginners, but if you are, we have two candlestick patterns here, two candlesticks, basically, a hammer and a shooting star. Now, let's focus on this candlestick. If you saw this candle on a chart, what would it tell you? You can type in the chat area now. Would this tell you, you know, the market's going to go down the next bar or go up? Is this bullish or bearish? And let's see, for those of you here live, just type it in the chat. If you're not here live and you're watching the replay, and again, just write it down for yourself. See this candle, is it bullish or bearish? Now, let's take a look at an example. And this is an example from our trading room a number of years ago. And I took pictures as it played out, and we explained it as it was happening, not after the fact. You see, nothing's happened on the right of it yet. This is the picture, and this is what I explained in the trading room. I said, is this bar, remember, we've got 1, 2, 3, 4, 5, and the sixth bar we get, after a big move up in price, we get a candlestick like this. Is this bearish? For those of you who are answering, that's great. Maybe some of you have heard this before. But again, it depends. In this context, let's have a look and see what happens. Now, I asked this question, and the first time I gave this presentation was at the Traders Expo in New York, in person. This was before COVID. And now we're going back to in-person events as well, which is good. But I asked this, and I said, is this bar bearish or bullish? Now, most people put their hand up and they said bearish. Now, let's see what happens next. The market continues to go up, and you're thinking, what's going on? And then you take a look and you say, well, actually, it's a bullish bar. Now, why is that? And you can see what happens next. And we take a look at it over here. So most people, when they see this bar, they think it's going down. But what does the market actually do? Remember, we learn from real world examples, from actually seeing what happens in the real world. A lot of trading books will say maybe this is a bearish bar. Yes, but it depends on the context. In this context, this is bullish. Now let's go back to our structure. Remember, we've got a three-prong approach. Remember, we're on one time frame at the moment. So we have pivot analysis, the way of reading the trend. supply and demand, and price direction. So let's have a look at this bar over here. What is the current trend of the market? Well, if you look, we made a higher low and higher high. So the market is currently trending from a pivot perspective to the upside as this bar closes. Now, the next thing, in terms of supply and demand, you can see I've got zones marked out between these two lines. So this is a supply zone. We just blasted through the supply zone. So is there supply here? Resistance, if you want to say. That's going to push price down. No, we just broke through the barrier. So most likely, if the market's going up and it's broken through one barrier, it's going to go to the next one, which is here. And then it goes down, and then it goes to the next one, which is what happens in an uptrend. The market, even though we went sideways here, but the market continued. We never broke back down through this area, go to the next barrier, come down, and the next barrier. And understanding supply and demand will tell you where those levels are, so you know ahead of time where the market's likely to pull back. So if you're in for a bigger move, you don't need to get scared out of the trade on a pullback. You can actually add to the trade on a pullback and continue going to the next target. So the first thing we said, it was trend, it's up. So we've got 3 questions to ask. What's the trend of the market? It's currently to the upside. What, in terms of supply and demand, we just broke through supply. So there's no supply here. The next level's here. So we're going to that next level. So we're bullish from that perspective. The next thing you need to ask is, what's the direction of the market? Well, you can look at this and you can say the direction is currently up. So we ask 3 questions and the answer is up, 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 bullish, bullish, bullish. So what's likely to happen to the market? You've got all 3 saying the market's going up. It's most likely going up. That is what you call probabilities. The probability at this stage, you don't know for certain until after the fact, but you can't trade after the fact. You can only trade with what you have. Most of the time, if you've got those 3 saying the market's going up, the market will go to the upside. So that's why having this framework is super powerful. We haven't even gone into how to trade it yet, but you have to understand how to read a market before you learn how to trade it. Yeah, the first stage is read it. What's happening? Which side of the market do I want to be on? Otherwise, you're going to be on the wrong side of the market most of the time. So here's an uncomfortable truth. Most traders know these patterns, and yet they still struggle. Why? Because patterns without context are meaningless, what we said. So let's go now over supply and demand and why that's really important. Again, people always ask the question, we've got a lot of AI now and there's automated When I worked at Credit Suisse, which was in the late 90s, well, mid to late 90s, I worked on a trading floor and we had a lot of quantitative analysts. I actually worked with the quantitative analysts. A lot of smart people, physicists, mathematicians, and whatever, that had automated systems. We had automated systems way back then. This is nothing new. A lot of the banks trade with automation, and now we have AI. But that's never going to change supply and demand. That's a fundamental of that's a foundation of how any market in the world works. It doesn't even have to be a financial market. The property market works the same thing, the same way. So what is supply and demand? And why is it so important? Well, I never invented this. This is just one of those principles of how the world works, much like gravity. These are principles. And what we want to do is align our paradigms, the way we look at the world, with the principles. If we don't align our paradigms, the way we trade, with the way the market actually works, then we're going to be in for a big surprise. It's not going to work. So you want to make sure that the way you're trading is aligned with the way the markets actually work. Prices will always move higher when demand is greater than supply. That's a law. That is immutable. That's always going to be, and it's never going to change. AI will never change that, nor will any bank. Prices will always move lower where there's more supply than demand, and they'll move sideways when we have an equilibrium between supply and demand. So ask your question, what moves markets? Some people think it's the news. Some people think, well, it could be many different things that are catalysts for the market moves, but ultimately it's supply and demand. And people cause that based on whatever reason they want to trade. Mostly the institutions are where the markets move from and to, the institutional buy and sell orders. And the beauty of this is this will never change. Now, why is it so important? Remember the story when I started trading the specialist system? What happened was that the specialist system of the New York Stock Exchange, because of computerization and everything back then, it became part computer, part human. And the system I was taught to trade no longer worked. So I had to come up with another way of trading. That would never change. And this is it. And this is what I've been teaching traders for the past 20 years, how to read the market with a framework that will never change, no matter what happens technologically. So your job is to identify supply and demand on a chart. Once you can identify supply and demand on a chart, and you know how to do that, again, there's a number, and we teach in our training, there's a number of steps you go through and what you look at. But once you've trained yourself, you can literally look at the market and you can say, the market's going there, the market's going to turn here. And you can do it pretty accurately. If you come and join our live trading room, I'm going to share with you how you can do that. You'll see us do this every single day in the market. And you'll be amazed. We say the market's probably going to go, it's turning here, and this is where our likely target is, because we want to pick targets where the market's going to get to. So you have to pick good entry places on the chart and good targets as well. So having the context is very important. Understanding where supply and demand is, whatever time frame you're trading, is extremely important. And knowing that you can learn something that will never be changed by technology, and it will be like this forever. It's very reassuring, as opposed to what I did in the beginning, that I invested a lot of time learning a system because I didn't know any better at that point, that was disrupted by technology. That's what we call it, disruption. And if you don't move, then, if I carried on trading that, I would have wiped out everything because it no longer worked. It was based, remember, the actual way, the paradigm wasn't aligned with the way the market now moved. The principles of market movement change based on technology. So you need to basically align yourself with reality, with how the markets move. Not how you think they move, how they actually move. So let's go over a little bit about supply and demand, and then we'll jump into the live markets to illustrate this from today. So what you need to look at is areas where the market turns to the upside. We call these areas zones in the market demand, and areas where the market drops from is supply. And the theory is that, and the reality is, if you were to look behind the scenes and the market drops in a large way from here, for example, and you're looking at the orders that are left behind in the market, there are probably a lot of orders left behind. They're institutional. It means the market almost, as we said before, must go back there to fill those orders. That's why the market goes usually back to those areas. So your job as a trader is to identify high probability turning points in the market. I'm going to show you a little bit how to do that. And the best way to do that is to actually show you in the live market. So who's ready to go into the live markets now? Let me know in the chat area if you guys are ready. And then we'll pull up the charts. Okay, you ready? Good job. So let me pull up. And this is the dollar. Okay. Now you might notice I used to have different set out or layouts for swing trading, day trading, and long-term trading. And then what I did over the years is I just merged them all into one. So I can look up these time frames to see the bigger picture. This is the monthly, weekly, daily, 4 hour, 1 hour, 15, and 5. And if I want to go down to lower time frames, I just usually change it here. But most of the time, I'm not trading on time frames, not taking trades on the time frames less than the 5 minute. I used to trade on the 1 minute, and you can trade using tick charts as well if you wish. But you can see there's zones in the market, and you can see if we go to today, and let's have a look at what happened today and what's happening just now. This is this is a supply zone because price went from here. It's also a downtrend. At this point in time, went from here down. So look what happens. The market has to go back here. And look what's happening just now. We just hit this area. What happened off the bottom of this area? This is just right now. And you can go down to a small time frame and you can see what happened. the market's starting to go back down again because we just hit the outskirts of a zone. This is a reversal bar, by the way, so it means we're going to go down and seek the next demand area below. And we can go down to lower time frames. You want to see the pattern, we can look at this. Now you can see, how do I know it's the top of the market? Here's a change of trend. It's a lower high, lower low, lower high, lower low. We're in a downtrend now based on the 1 minute chart. And we're going to keep going down until we hit a demand area. That makes sense. Okay, so again, we're pulling back now because we just hit this area. Now we can go on larger time frames. It doesn't really matter. It works on every time frame. This is a supply area. This is now a supply area. We'll mark it now. We usually mark from the top of the, depending on, there's 3 different ways to do it. The top of the whole bar to the bottom of the bar, or the top of the bar to the bottom of the body. That's another way, or the top, or just the tail. So in this case, what I'm going to do is do it to the whole bar because it's got wicks on either side. And you can see we came down. So the market may come back up here, but look at this area. This is an area of demand. We already bounced off it. Imagine if you were trading here and the market's going down at this time on this day. Wouldn't it be a good idea to know that it may, maybe in a strong downtrend, but it may not continue? And likewise today. If you look at what the market, and not today, yesterday, when the market, and today, if we look at the market here, why did it stop? We hit demand. You're going down, 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 but it doesn't carry on forever. It bounced back. And you can see exactly where from here. There's a level here. This is supply. We've got, I love the 3-bar drop. You see these 1, 2, 3 bars, well, this time 4, when you're looking at this. If they're solid bars, it's even better. You can see the same pattern here, 1, 2, 3. You've got 3 bars, 3 bars. A lot of the times, this is supply. This is how I look for the areas. My eyes just see this. And again, there's a lot that goes into it besides that. We look at about 7 different aspects of supply and demand. We're looking at 7 different things, and I go through that in the training. I go through that also in the trading room when we're doing it. We look at how the market left this area, how long did it spend in this area, those sorts of things. Where did it start? Where did it get to? Where did it come from and to? And things like that. So, okay, so let's have a look at another market. And we'll look at a few other examples. So gold is a very interesting market. Now, if we look at gold, you can see I've marked also, it's the same structure. This is the top, by the way, when this happened, this was a change of trend. This was the top of the market. Look what happened afterwards, the week after. You want to be on the short side here to where? Till we hit the demand. Look what happens now. The market comes up and now we're coming down and this is not supply. Well, it kind of is, but it's not the strongest level. We did have a move down that broke below this area. And you can see it may have a problem going through this as a weekly chart. Now, go to a daily chart, you can see again, we've got this 1, 2, 3, 4 bar structure. Look what happens when the price comes down here a few days ago. Here the trend is down and then we reverse. We've changed trends now. And you can see where we're heading to. Where do we go from and where do we go to? And these are the levels on the market that we have. So you can actually start to understand where you are in the bigger picture. Now, let's look at oil. Oil's also been a very interesting market. We can understand this as well. You can see we came from here and we called this trade, by the way, before this happened. We said on this month, we said it's a buy. And if you go down the time frames, you can actually see, what's happening here. So you can be in this before it actually took off. And what we said as well, this area, if we look on the weekly chart, this is supply, the whole area. Now, if you look at what happened on this drop, the market came below here. So this move up is likely to make a lower high. So you can see that this week is probably a high probability sell so far. It may not continue, but one thing that you can know is if you go down the time frames, this is not a bad place to sell supply. So look what happens here. The market changes trend. And then yesterday was a sell. And you can see we came down. This is also demand. I've marked the level down here, but you can mark it up there as well. And you can see it. And also there's a level here that goes up to there. So sometimes I mark the lower level, but I'm aware of, how these levels pan out. So you can actually start to plan your trades based on what you're seeing happening in the market. Now let's look at the E-minis. This is a market that's clearly very, very strong at the moment and still moving up. The market is still uptrending here since down here. We had this move and we've been going up ever since. Notice I marked out a zone over here, marked out a zone here. The market's uptrending and it's going to keep going higher unless we break below here. We could pull back. The market could go down, have a number of days, just like we had a day down here and 2 days down here. But as long as we don't break below here, the market will continue moving higher unless it gets a bit away from itself. That doesn't mean intraday you're not going to get opportunities to sell. Again, you can look at the intraday supply and demand levels as well and start to take trades based on that. Let's look at another market, Bitcoin. Interesting to know, if we put everything together, what's happening today. Why is the market, you see, this is supply. We said we've got a pivot here and the market came all the way down to demand. Notice where the market's moving up. Now, if we know the trend of the market here is not up, so moves up in the market will likely turn unless we're going to break the trend in these areas or close to them. You can see, so this is a monthly chart. So if we go down a time frame to the weekly chart, this is the zone where you've got to be careful on the buy side because it may start turning down. Let's take it down to a daily. Here we've got an uptrend going on the daily, but notice where the market turned. Here, right on our level, we had it marked out. You don't want to buy up here, you want to buy down here. And then you could sell up here when you hit the next level, and you can see we're pulling back again. And if we look at this intraday, we can come down onto this time frame, and you can actually see, if we mark out the supply and demand zones, you'll actually see how this works. So if before this happened, yeah. So I'm looking for, particularly, there's a supply zone here. So this is the top, and this happened right in that upper higher level supply. But we also have a level, say, here. And you can see the market comes back into this area, and you're watching to see maybe it, you can see what it went too quickly. It doesn't matter. You can see the market turned. We went right here and the market turned. And then it put in a lower low, lower high. Here we've got the next level of supply now on the intraday time frame. This is on the hourly chart. So you can see what happens. So over here, you don't want to be on the buy side. If it breaks, then yes, but you've got to be careful here because of the bigger picture. And you can see how the market comes down. So if you know this, then you can make sure that most of the time you're on the right side of the market, or you're going with what's happening. You're aligning yourself with price action. Now, let's have a look at a few other markets. We said oil we looked at. We looked at gold briefly as well, which is what we just did. And you can see what's happening here. Anyone have any markets you'd like me to look at? We can look at stocks as well. It really doesn't matter. We can look at anything. Let's look at the pound. Now, here's another example of this. You see this market over here put in a higher high, went above here and here. This pullback, so we marked out, remember, 3 bars. What happens when the market comes back down here? So on this month, after the markets come into the area, you want to be thinking, this was last month in April, you want to be thinking buy. So if you come down on the weekly chart here and you look at April, we're down here. We start. Look what happens. You're thinking buy. Look what happens. The market goes all the way up. And if you go down to a smaller time frame, you'll see this. You'll see the market kind of bottoms here. And then we get the direction changes up and it stays up, 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 and up until here. And then we pull back again and we move up to the next level, pull back again. You see how we marked this level out? When we came back down here, also another opportunity. And we haven't marked this level out yet. And there's a reason for that. We have to make, this is not what I call a significant demand zone unless it takes out the previous high. Whereas if you look here, this took out the previous high. And this definitely did. You can see it took out this level, this as well. Why have we marked this? It took out this level and this level. So this is what I call significant pivots. Remember, not every pivot is equal. Not every demand and supply area is equal. Now, let's see what we have. Maybe we'll look at one more market. And again, I just want to show you it works with stocks. It works with absolutely anything. And we can look at other futures markets if you want. Someone type in a market. Should we look at Tesla? Let's look at Tesla. Now, what we can do again is let's go on. Okay. So if we were to go onto an hourly chart, we can start looking at where the zones are. For example, there's one here. So I usually mark it like that. And again, it goes all the way up, by the way, to there. So all this is in the demand zone. So when the market comes down here, it dips down and comes back, gives you a nice opportunity to go on the buy side. This is now supply. This is now the top. The market won't go higher unless it can take this area out. Moves up, may sell off at least intraday. We paused here. You can see what happened if we mark this area out. This is a supply area, but the market paused here and based here. And what we say from a supply demand perspective, basing in supply is bullish. We eventually break it. Once all those orders, if we stay here long enough, all the sell orders are eaten up. Once there's none left, we break through. So you can see, but initially, if you're coming up, this may be a good place to take something out because, you know, it may not go higher. And if it bases here, the odds are we are going to go higher. So again, we'll look at one more example. And we looked at Bitcoin, and we can see where we are, and we can see what's happening in this level, why the market's moving down. And let's look at the yen. This is also extremely interesting. Look at this. This is the all-time lows of the yen. What happens over here? Look what happened over here when the market hit the low. And we go down, we had, and you can see it here. Look at this. We hit the low, and I was saying to my traders, be careful because we may get an explosive move. Look what happens here. The market base is here above. And I said over here on this day, it's going to break below the base, but watch, this is a bear trap scenario where we break below the base into demand. Look what happens. We had a massive move and then a pullback and another big move. Now, this is the lowest risk, highest probability entry. You could get in with almost no stop, and then you get this massive move. So understanding these trades don't set up every single day. You have to wait a long time for this. This is this trade from here. Look at this move. This is massive. And if you were trade, and you can see again how we had the same thing happening here yesterday. The market shows you it's the bottom here. It pulls back into demand, giving you an opportunity to buy anywhere in here with a stop below, and then boom, almost into the next level. And now we're kind of in the middle. Okay, so just to let you know, I work with a trader who could identify supply perfectly, but still couldn't hold trades. The issue wasn't knowledge, it was decision-making under uncertainty. So once we gave him the trend framework that removed ambiguity, his behavior changed almost immediately. So the best investment you can make in your life is in yourself. I think Warren Buffett said that when he was interviewed. As Jim Rohn says, for things to change, you have to change. For things to get better, you have to get better, but you have to nothing's going to happen unless you take action. Let me pause here for a moment. Everything you've seen so far today is intentional. This isn't a strategy, and it's not something you memorize. It's a way of reading the market. And once you see it, you can't unsee it. But here's the part most people don't like hearing. Understanding this once isn't the same as being able to execute it consistently. Most traders on this call will get it. And then under pressure, they'll still hesitate, second guess, or revert to old habits. Not because they're incapable, but because this kind of clarity only becomes natural through repetition and exposure. That's why I don't just teach this in a single session. I trade it live, I explain what I'm seeing in real time, and I show you how decisions are made as the market unfolds again and again. If this way of reading the market resonates with you, the next step isn't to go and look for more information. The next step is to stay close to the process while it becomes natural. And that's exactly what I want to show you next. So take it a step further and learn how to read the trend using pivot analysis. And these are the benefits of knowing how to read the trend. And again, this is an approach to reading the market before you even trade a strategy. You want to make sure that you're trading in the direction of the trend because your trend is your friend. Remember, until the bend in the end. Once that bend in the end has happened, you're no longer trading against the trend. That's where you could actually, you're not bucking the trend's changed. So you'll know exactly when the trend begins and when it ends, and it's super powerful. Make sure you're never fighting the trend. Make sure you're on the right side of the market, and it's going to help you develop a profitable trading strategy or enhance an existing trading strategy. So here's my offer to everyone here. To join my How to Read the Trend training session, and trading room, and this is what you're going to learn. And again, this is not just teaching, this is actually transformational. You're going to learn how to identify the current trend of the market by actually doing it and seeing it be done. You're going to learn how to analyze the trend in multiple time frames. What do you do if the uptrend on the daily chart, but you're in a downtrend on an hourly chart? How do you reconcile that? You're going to know exactly when a trend begins and ends and how this knowledge will dramatically affect your bottom line. I do another presentation, which is called Market Tops and Bottoms, and we do that super accurately almost all the time. We're very, very accurate because we wait until the market's actually topped and bottom, and then we can actually go in the other direction. And here's the key. You're going to watch us analyze and trade in the live markets in real time. So here's what people are saying. Simon, this is phenomenal. I've been trading, studying for 3 years. Sadly, it's all been the wrong process. I've wasted tons of money, time, and effort. I've actively deleted all those programs and indicators, and now completely focus on what I've learned from your program. It's the only real way to trade, and it makes complete sense. Tom, I wanted to say that what you teach in How to Read the Trend training course is brilliant. Before that, I'd picked up bits and pieces from different traders, but it was never joined up. Your course brought it all together in a very structured and algorithmic way. No guessing needed. The facts jump off the chart. Wow. The trading room is very helpful in understanding how to go through the process. I've been trading for 11 years and I've not seen anything like what you do. Love how simple it is. I mainly trade options with trades that last 30 to 60 days. I've been looking for something I could use to day trade for 2 years now. I want to round out what I'm doing with another source of profits. I've not been able to find anything I could execute consistently. I'm just paper trading with your system. I've been doing it for a couple of weeks now, and I've had far better results than anything I have ever tried. So this isn't about learning more. It's about seeing the same information differently, consistently under pressure. The fastest way to do that is exposure, watching the process applied live repeatedly, and you actually doing it as well. And again, this is what you get in the training. It's an hour and a half. That's it. And you can, we had one of our top traders who went through the training, and 50 times she went through. Imagine how much is that? 50 times. 75 hours. She might have done it on double speed, but 50 times through the training until she really internalized it. That's dedication. Now she's one of the best traders I know. And this was like close to about probably 8 or 9 years ago now. And she's gone on to be super consistent, developed her own system, her own way of trading, and is doing really well. And has actually trained other traders as well. We have a number of traders like that. And again, it's all about building the right foundations. If you don't have the right foundations, doesn't matter how nice the building looks, it's not going to stand the test of time. It's on demand. You can watch it as many times as you want. And you also get personal access to me. You can ask me any questions you like. But more importantly, you're going to get 1 month access to our live trading room. And again, a subscription is $497 a month. That's what people pay. I'm not making that up. It's been like that for years. Yeah, we've had this trading room now for about 10 years. You have access to our online trading community 24/7 via our Discord server. You can connect with other traders. You can have a trading buddy if you wish. You can connect with anyone in the community. And this is what it looks like. And here's the offer for everyone here. So again, this is about building a skill you use for years, not a one-time trade idea. Okay, this is something that you're going to be able to use for the rest of your life. And I'll also show you how you go through the checkout process. So the actual link is, I haven't showed you the link yet, but it's my website /promo. Maybe, David, you can type it in and you guys can have a look at it. So basically the regular price, if you were to do them both separately, the trading room and this training, is $994, but I'm basically giving you the training for free or the trading room for free, whichever way you look at it. And again, test drive, learn it, learn something from the training. Even if you've been trading for many years, I've had many traders that run hedge funds that are successful traders come into the training to see how we do it. I've trained traders that work at some of the top institutions. They've gone through exactly the same training as what you'll go through here, exactly the same. You know, and they're managing, you know, massive portfolios in the billions, sometimes the billions of dollars, or multi-million, hundreds of millions of dollars. Okay, and they, you know, they're big traders for big institutions, and this is what helped them to trade better. So yeah, and okay, so if this way of reading the market resonates with you, don't sit with it. Understanding without reinforcement fades quickly. The people who get results are the ones who stay close to the process while it becomes natural. This is a link to go through. You can type this into your browser. And what I'll do is I'll show you the process quickly. Get the right screen up. I think it's this one. Okay, so that's my website, and the members come in through here, but you come to this page, and you just click on buy now, and you fill out the detail. Fill out your details. You don't need a PayPal account. It'll say PayPal email. You don't need a PayPal account. You just put in your email, and you've got a choice to, you know, check out with a credit card if you wish. You just, you know, make that choice. And just to let you know also, it's a subscription after the first month. You can cancel anytime. You can cancel immediately if you want, but even if you don't cancel and you forget about it and you tell me I don't want to be, you know, you know, if you're not getting benefit, I'll just refund you whatever, you know, whatever you paid after that. That's not a problem. If you're not in the trading room and you know, we were charged without that, that's not a problem. I want people in the trading room who are interested in learning and are benefiting from it. If you're not, then there's no point being there. And again, if this is not for you, that's fine as well. There's many different ways to trade, but I believe that you need to build solid foundations for whatever style of trading. Even if you trade a different, I mean, again, we haven't even gone into style of trading. That's the next stage. This is just reading the market. Stage one. Style of trading, that's much the same as how do you drive your car. There's, as you know, you've probably got friends that drive fast, and you've got people that are more defensive. Even on fast roads, they drive slow and they take hours to get places. You know, and there's people that drive fast where they shouldn't. You know, everyone's got their own style, but you have to still keep within the framework of, you know, the road conditions and the foundations of safe driving, so to say. And it's the same with the markets as well. You can build anything you want from this, but the foundations have to be strong. And the foundations, I believe, are the same no matter how you're trading. If you're trading using charts, you need to know how to read, you know, trend. You need to know about supply and demand. You can call it support and resistance if you wish. Yeah, you need to understand about what direction the market's going in and how to read the multiple time frames. That's the key, yeah? So you click here, and then you come into the education and training is in here. How to read the trend is session 1 of learn how to read or basically how to read the market professionally. It's a standalone as well because you can trade just with that. Our trading room's here. So this is what it looks like. You come in and you do the training here. And the trading room is a separate portal over here and separate membership site, so to say. And you come in and you've got the live trading room. You come in through here and you'll see the schedule. We have recordings if you can't make it live. A lot of people come and watch the recordings, have some because of the time differences maybe. And some people use them. I had one trader in the trading room for 3 years who used to watch the recordings and every day of, because we're talking about what's happening on the bigger picture as well, not just smaller picture. We're talking about big moves, catching the beginnings of big moves and holding for long-term positions. And we've had a lot of traders do that. They watch the recordings and they go along and they, see it for themselves in their own charts and they have a plan and they follow their plan and they do very well. And again, it's a learning process. It's not going to happen overnight. You have to put the effort in. It's not going to happen without you putting some effort in as well. So this is, again, the offer. If you join now, how to read the trend. Fundamental part of trading is $497. 1 month in the live trading room is $497. That's $994. This is the offer for everyone on this webinar. That's the price, $497. It's a small investment in your future, and it could potentially change your life. It's changed lives. I mean, I've been teaching this now. I actually taught traders before I even had a website, and then it got too many, and I had to kind of I couldn't take people on and more than a certain number of people one-on-one. I had a influx of people from all over the world. I had people that I trained, and then people traveled and talked, and then they wanted to learn, and and I was extremely busy, and then I had to have a way of doing one-to-many. So that's why I started everything. So it wouldn't be fair for people on waiting lists because I just couldn't take the amount of people that wanted to learn how to do that. Even from institutional traders, which was going back to the beginning of when I started this. So this is what it is. I run a trading room every day, and we have our weekly preparation session on Sunday. And again, that sets the tone. This is exactly what I do to prepare to trade. I'm just showing you exactly what I'm doing. You can mimic it. You can copy it. You can do your own preparation and compare it to what I do, and then go and see what the market does. And, if you set up the zones, for example, and the market turns there, you're doing it right. And if you do it again and it turns there, and 80% of the time it does, then you're onto something. If you do it and every time you put your zones and the market doesn't turn there, it goes straight through it, then you're doing something wrong. The market is the teacher. The market's going to teach you. You have to have the framework. Maybe you missed something. What did you miss? So you learn by actually doing it, and you learn more from when it doesn't work than when it does work. You learn what to adjust, how to change. Now, let me just go over this. So understanding is one thing. Execution is another. That's why the trading room exists, not to give you signals. I mean, you can follow my trades if you wish, and people do, but the idea is to build pattern recognition and decision confidence so you can actually do this yourself. The idea is not to build you to become dependent. All my traders become independent. They're able to stand on their own 2 feet, and they don't need me, ultimately, or anyone else. You don't want to trade in a way. You want to be autonomous. You want to be confident in your own abilities to do it, and you'll see from the results that you get. So what I'll do now, we've got a few minutes, I'll open up to questions. And again, if you have any questions and you don't get them answered here, you send me an email. I answer all my emails. We can always set up a time to chat as well. And at this point, very briefly, I want to say a huge thank you to David for putting this event on. Again, when I first started to trade, which was over 20 years ago, there wasn't any such thing. The education was almost nothing. There wasn't, there wasn't YouTube like it is today or anywhere else that you can learn. But if this resonated with you and you want to learn more, I also have a YouTube channel you can go to. I've not been super active. It does take a lot of work, as for those of you who know, to put videos out. But I used to run every week at the beginning of the week, I used to put a video out called Where's the Dollar Going Next? And I used to have people watch that before the week. And then the dollar used to do exactly what I said almost every time. I actually got audited by a postdoctoral research fellow at one of the Ivy League universities in the US. And he went through like almost, I think about 8 or 9 months of data, and the accuracy was very, very high. So yeah, that's how a lot of people came to me through the YouTube videos because it was done ahead of time. The market hadn't even played out yet. And I was going through exactly what the market setup was, what's likely to happen, the levels the market's likely to go to. And they go, oh, it did. It happened. Happened again. Happened again. How are you doing this? I need to learn this. And that's how it worked. So yeah. Anyway, let me see questions. How many trades do I take during the day? Anywhere between 1 to 3 depends. Depends on the day. Sometimes no trades. If the market's not doing anything that looks interesting, I only trade when my trade's set up, when it sets up exactly what I want. So it depends on the market, but usually 1 to 3. Yeah, we've got about a minute if you want, or you can send me an email. And those of you who joined, I look forward to welcoming you. Our next live session is on Sunday. We don't have a session on Friday. Friday's day off. And we go Sunday to Thursday. And you want me to look at a stock? We can do that. XOVR. Let's have a look. Okay. So we can start looking at levels. This is demand. Look where the market turned. Okay, this I would put in. I mean, you don't need this. This has happened already, yeah. But you'd put it on beforehand. This is also supply, which is where the market may struggle here going up. So this is, and this month, this was a high probability trade from here. This was last month to take the move up last month. You can see how the
Hey, Simon. Sorry, I got to cut you off there.
But again, if you want to come and join our live trading room, I can look at any stocks. We can mark it all up. You'll have it ahead of time, and then you can make your decisions based on that. Okay, David, thank you so much. Thanks everyone for watching, for being
Thanks,
here.
Simon.
And yeah, it's great to share with you. And I hope you took something useful away that will help you with your trading. Even if you decide not to join, that's fine.
Yeah, sounds good. Thanks for being here, Simon.
Thanks, David.
All right, Agnieszka is up next. Hey, how are you?
Doing well. How are you about yourself?
Good. We're having a great day here. So
awesome.
Thank you for joining us.
Absolutely, pleasure all mine, as always. Would you like me to record it as well?
Oh, sure. Yeah, if you want to. You should be able to now.
Yes. Okay, great. Yeah, perfect. All right.
Okay.
Let me know
and do you want to share your screen, or do you want to start talking?
I will share my screen in a minute. Yes.
Okay. Okay. All right. Let me fix my setup, and you're ready to start, right?
Yeah, I'm ready to start.
All right. I'm going to start my recording again, and then you can start your presentation. So
okay,
I am recording again now.
Okay, thank you. Well, first of all, I want to thank you, David and Anka as well, for inviting me again. This is always incredible honor for me to be able to present, not just because of presentation itself, but because every time that I talk to traders, I know that there are things shifting. There is always someone who hears what they need to hear at that particular time. And even if whatever I say today helps just one person, then I already consider this as a huge success. So welcome everyone, and I hope you had a great morning and you are excited about learning something about your mindset. So before we get into my presentation, I'm just curious, how many of you that are here are looking to become consistently profitable? If you could let me know in the chat. And if you are, let me know, what is your biggest struggle in that quest? What is it that you are fighting against every day, maybe every minute? Is it making the money? Is it keeping the profits? Is it trying to find the right setup? Consistency, hard time to committing to a trade? FOMO, moving stops? Okay. Well, then thank you for letting me know, because I think that, first of all, you are not alone in that struggle. So you will be having a lot of, I think, hopefully, get value from the presentation today. The reason why most traders struggle, and from what you already told me, is that the reason why most traders struggle is not that they cannot make money in trading, but it is because they cannot keep it. Making money is really not the hard part. And if you have traded for a while, then you already know it. Am I right? You know exactly how to make money, but somehow you might be giving it back to the market. Keeping the money, this is really where things start to break down. And let me know in a chat, how many times have you given back your profits that you already had? How often do you go and look back at your trading day and think, if I had just walked away before noon, I would have had a great day? Or maybe you even surprise yourself sometimes how much money you are actually able to make in the market, but also how quickly you can wipe it out. Can you relate to that? Can you sometimes look at your numbers at the end of the month and think, I cannot believe that I actually was able to make that much money, but then not keep chasing the end? I know definitely I've had this experience many, many times. If you can relate to that, then today's conversation is specifically for you. So I'm really happy you're here, because this conversation is around a skill that determines whether a trader can ever be consistently profitable. So let me share my screen. I have a few slides that hopefully will help you to guide the conversation. So for those of you who do not know me, I'm Agnieszka Wood. I'm the founder of A Head Coach and also a trading mindset coach. And I specialize in helping traders build the mindset and discipline to follow the plan with calm, confidence, and consistency. And I have been trading for over 15 years myself. So I know firsthand what it feels like to sit in front of the screen and battle fear, anxiety, hesitation, frustration, and all the emotional swings that trading can bring. Nowadays, I day trade, I also swing trade, and I manage my IRA accounts as well. And over the last 7 years, through my coaching work as a trading mindset coach, I have worked with hundreds of traders who knew what they should be doing, but struggled to actually do it consistently, especially when they were under pressure. When the heat was on, in the moment, things were breaking down. And one thing that I started noticing over and over again, both in my own trading and in the traders that I worked with was that the biggest problem usually wasn't the strategy, even though sometimes you hear yourself or maybe other traders saying, I need a different strategy because my strategy isn't working. But usually that's not the problem why traders struggle. The biggest problem was the inability to act in their own best interest consistently. And that's exactly what I want to talk with you about today. In the first years of my trading, I had many of those days that on paper, it should have been really good trading days. I would catch the move. I managed the risk really well. I did, let's say, everything right as it should be. And then at one point, when I was up nicely, I did not close. I just stayed a little longer and then a little longer because maybe there was something more. Maybe I could have made more money. Have you ever done that? You know, you have the profit, you're already up. You know you should probably take it. Everything in you is screaming, take the money. But then something inside you just keeps holding on. And then slowly you see the profit start shrinking. And I remember sitting there, watching it happen and not doing anything, just sitting there. Not because I didn't know what to do. I knew exactly what I should do. But because in that moment, I wasn't acting in my best interest. And what hit me later wasn't even the lost profit, which I know it's pretty bitter. But it was really something else. What I realized was that this wasn't just happening in my trading. I was doing the same thing in my life, doing something that I knew I shouldn't be doing, saying yes when I actually meant no, pushing when I needed rest, and then holding on to things when I actually should have let go. And that was the moment when something shifted for me. Because that was the moment when I stopped asking myself, what's wrong with me? What's wrong with my trading? What am I doing wrong? And then I started asking, why am I acting against myself? Why do I keep hurting myself? And that's a very different question. And if you are honest with yourself, just ask yourself, how often do you do that? How often do you act against yourself, despite knowing better? How often do you hurt your own interest, even though you don't have to? When you don't have to compromise, but somehow you still do that. Because the fact is that trading doesn't create your behavior. It doesn't make you do something. It doesn't make you something. Market doesn't make you do things. It just simply reflects. Your computer screens in front of you are like mirrors. And the market will reflect who you are. It will show you exactly the patterns that you have been repeating in your life every single day for years sometimes. And then when you come into trading, the market is gonna put it all in front of you and show you the mirror and show you one by one who you are. And the very normal reaction that we have to that is, that's not me. Defensiveness, rejection, resistance, because we don't like to see the things that we don't like. If the market is reflecting the truth, it says, hey, listen, you're not really taking care of yourself. You don't want to see that. If the market says, why are you lying to yourself? The first reaction is, I'm not lying. Because it's not easy to confront the truth. And now at first, I really thought when I started trading and I, followed a lot of different people and I've been to different chat rooms, I really thought that the formula for success in trading was very simple. I needed a strategy that, if I had a strategy and then we'll keep doing the same thing over and over again consistently, then I will eventually become profitable over time. So I had that notion of, I just need to trade longer. I just need to wait a little bit more. Somehow all these problems are going to solve by itself. I just need time. Because a lot of times in life, this is how things work, right? Just keep doing what you're doing and it's going to get better. Just be patient. Keep going. It's going to get better. But the problem was that in trading, it wasn't getting any better. In fact, the only thing that I was doing consistently was losing my profits and repeating the same mistakes over and over again. So I eventually realized that this formula is incomplete. This didn't work for me. And I wonder if this is working for you. How long have you been trading? And if just trying to do the same thing over and over again is actually making things better. So that's when I started seeing things differently. And I realized that making money consistently is absolutely not the same as keeping money consistently. There was this missing piece. And that missing piece is what I call now the profitability skill. So for me, the formula became the strategy, consistency, plus the profitability skill. And that is what gives consistent profit. And once I started seeing that, everything started to click. Things started to change because the biggest measurable shift in my trading and also later in my clients didn't come from repeating the same mistakes or changing the strategy and starting all over. It came from building this ability to stop acting against yourself. That's really the critical element. And it's going really quite deep. If you really think about it, acting in your best interest at all time sometimes sits in a very uncomfortable place for people. Because many times people who are givers, who are not comfortable taking care of themselves, it's because they feel like it makes them egoists, like they are not caring about others. But if you look closely, how you do one thing is how you do everything. How you treat yourself every day will be reflected in your trading, how you treat yourself in trading. And there is no one in trading that will take care of you and your interest. So if you don't have that skill, how to take care of yourself, you simply will be taken advantage of, so to say, or you will allow yourself to be taken advantage of. And I know that that's uncomfortable to hear sometimes, but it's also kind of freeing because now the problem becomes workable. So the profitability isn't just about strategy or execution, and it's definitely not something that automatically happens if you trade long enough. What actually allows someone to keep profits instead of giving them back is a skill that anyone can develop. And actually, it's not just one skill, but it's a set of skills. So what are those profitability skills exactly? When I started digging deeper into this, I realized that there were few things that I kept violating over and over again in my life. And then I started seeing it in my trading. So the first one, I was not respecting my own boundaries. I wasn't fully honest with myself in the moment. And I kept pushing past what I actually needed over the things that I needed that were good for me. I kept pushing the line and pushing myself. And every single time that I did that, it just showed up in my P&L. Let me know in a chat if you can see that in your own trading. Can you see any of these issues bleeding maybe from your life to your trading? Yeah, because it's how you live, that's how you trade. You're taking yourself with you no matter what the context is. So profitability isn't just about what you do in the market. It's not this one thing. Canceling myself, I'm always last. Exactly. And that's Orto is something that you take from your life and you bring that into your trading, because those things, they are part of our identity, is how we see ourselves, what we think we deserve or not deserve, what we think we are worth or not. And the crazy thing about trading is that somehow, especially people that have those issues, trading seems so attractive because maybe subconsciously we feel like we can finally let that go. Because trading is the domain that gives you unlimited potential. It gives you this possibility to expand, to let the boundaries go and actually allow yourself to be the best version of yourself without the limits, without the boxes. But if you have no boundaries at all, this is going to start working against you. Because total freedom, and that's why most traders are getting into trading, freedom without discipline, without rules, without boundaries is chaos. And that's where most traders are ending up in chaos. And that's why things become overwhelming, because there is no structure. So these three skills in particular, I believe that they determine whether you will act in your best interest or against it. Boundaries, self-honesty, and self-respect. So let's talk about boundaries. Boundaries basically means simply knowing when to stop and then actually stopping. Sounds simple, right? Just stop. How many times you know that you should stop, but then you continue trading anyway? That's why this is a skill that needs to be developed. This is not something that you can pressure yourself and push yourself, because, as you might know, trading is already high pressure environment, and if you add extra pressure to it, you simply are going to be reactive, because your nervous system is going to be reacting to this additional pressure. So setting your boundaries and knowing when to stop is a skill that you can learn. It also means saying no. How good are you in saying no? First of all, saying no to other people, but also saying no to yourself, and then sticking to this commitment, committing to something, having the integrity to say no to the things that are not good for you. And if you look in your life, you can easily see what are the things that are not good for you, but you do not say no to them. In trading, this could be trades you didn't plan. This could be not getting out of the trade in time, or trading instruments that are, for example, too volatile for your risk profile. You know you shouldn't be trading them, but then you still do. And then the last one is about the boundaries, is also about protecting your time, protecting your resources and your energy. And in the resources, there's also your capital in there, emotional capital, but also your financial capital. And for trader, protecting your resources and your energy and your time, it's such a key element, because you are the resource, you are the most important asset in your trading. So if you do not protect yourself, if you don't protect if you don't have a boundary, and you, for example, just simple thing of not getting enough sleep, this is going to affect your performance. So really creating clear boundaries that support you and your trading in your life. And that means respecting your rules, not just in trading, but also in your life, your routines, respecting your stops in trading, but also in your life, knowing when enough is enough. What is your enough? And protecting your exits in trades, but also when is the time to go? When is the time to stop? Not overstaying, not forcing. Have you ever had a passion that slowly became your obsession? I know I can talk from myself. I've had many passions that became my obsession, and in the end, they hurt me, because I was so driven, I became so driven in it, and I had no boundaries, that eventually I did not want to disappoint anyone. I couldn't say no, and I kept going. And finally, physically, my body said, stop. Here, not further. And I had to stop. And how many times does this happen in trading? That people who are passionate about trading, they start pushing, they have to make money, they push, and finally something happens with their health. They put so much stress on themselves, they couldn't take a break. It became an obsession, and it took over before they even realized it. because it can take over and negatively start affecting your life before you even know it. Trading can easily become that. And if you don't have clear set boundaries and you don't respect them, this is how this can happen, especially when your self-image, your self-worth, your goals, and your emotions become so attached to it that you don't even see another choice. Without boundaries, you will let the market consume you. It's very easy to do that. The second skill is self-honesty. This is about acknowledging what's actually happening. Like purely from the awareness perspective, like what is it that I am seeing without judging it, without justifying it. Just taking things for what they are. And maybe you have noticed yourself that when you're trading and you took a loss or made a mistake, that there is this whole internal conversation going on, trying to excuse you or find a reason, or maybe even judge you why you made these mistakes. So being honest with yourself is just calling for what it is, not trying to cover it up, not trying to look for the guilty ones. Yeah, but the markets. Yeah, but they told me. Yeah, they know where my stops are. How often do I hear that? They know. Like, who is they? It's also about confronting the truth. So stop distorting the image. You know, sometimes things are just as they just as they are, and trying to make them look better just is a waste of your energy. You don't need to do that, even if you don't like what you see. And sometimes when you take a big loss, it hurts already. But then by beating yourself up and calling yourself names, that doesn't make it any better, does it? And you can just simply be honest, you know, I made a mistake. That's okay. I'm not proud of it. But I'm not going to put energy into it of trying to, you know, kind of cover it up. This one is really uncomfortable because self-honesty means really catching yourself in the moment. And ideally in the moment, not when the damage is already done. It means things like noticing when you are getting tired, or maybe when you are getting triggered, and acknowledging it. It means noticing when you're getting emotional and not rejecting it, just acknowledging the emotions are there. Maybe you are frustrated. Maybe you are angry. Maybe you do feel greedy. Do not try to change it. Just acknowledge it. Confront what's there, even if you don't like it. It really means recognize the truth for whatever it is. And also admit when you are trying to bend the truth. We are really good liars. We know how to lie to ourselves. So catching yourself doing that is actually really refreshing. You don't have to put it on Facebook that you catch yourself lying. It's just for you. Being truly in integrity with yourself, just making the first step, just acknowledging it. If you cannot change it, if you're still doing it, it's fine. At least be honest about it. If you can give yourself a gift of honesty, just be honest with yourself. Start there. The moment when you can be honest with yourself, it will be easier to be honest with others as well. And that will also help you to accept when you are wrong. Because the reason why a lot of times we fight to prove something is because we don't want to admit we were wrong. So we are lying to ourselves and trying to cover it up. How many times you knew you should be doing something while you were doing it, knowing you shouldn't be doing it, and still continued? It's really hard to stop repeating the same mistakes if you keep lying to yourself, because you're just clouding the process. You're just playing tricks with yourself, playing games. And you need to realize that the reason why you do that, if you do that, is just to comfort yourself. And the market is there not to comfort you. You are not trading to fulfill your emotional needs. Well, most traders do, and that's the problem. But if you realize that, trading becomes so much easier and so much more fun if you don't bring your emotional needs into trading. And the last one I want to talk about today is self-respect. Self-respect is about detaching your self-worth from the outcome, not compromising yourself for outcomes. And honestly, this is where a lot of traders struggle, because many people tie their self-worth to performance. They make it mean something about them. Whether you lose or make money, you make it mean that you're successful, or that you're a failure, or that you're good enough. And if you keep attaching that identity, who you are, to how much you make, how will you still respect yourself on a red day? That's going to be really tough. And that's why a lot of traders are fighting their losses, because it's not just the loss. Many times it means I have just lost a piece of my own dignity, and I'm going to go there and fight back for it. It's about letting go of the need to prove something. Can you walk away from the market without the need to prove that you are good enough? Can you feel good enough without being a great trader? Do you have something else in your life that fulfills you, so that you don't need to look for that fulfillment from the market? Because if you attach yourself, if you attach your trading and your results, if you give the market the role to prove something to you about you, it's a very tricky game, because of the losses, because of the probability, because of the uncertainty. Your sense of self-worth will always be a whipsaw, depending on how you did today. And then the last but not least, can you be okay with a loss? Can you not let decide who you are? Because if you can't, if your loss decides who you are, then you will keep overriding your best interest and keep fighting. Just notice that the definition of your best interest in life is different than what your best interest in the market is. Even though many traders don't want to lose, taking calculated losses that are in your plan are in your best interest. It's a little bit like going to the dentist. Not everyone likes it. Most people don't, especially if you had a bad experience with a dentist. But you go. You know that this is good for you. So no matter how you feel about it, you will go because it's good for you. And in trading, because you have the freedom not to do it, you try to avoid losses as much as you can. So when you focus on building just these 3 skills, then you will notice that your emotional responsibility and self-trust, your confidence, will start growing naturally. But now, if this was so easy, then most traders would already be doing it, right? So what gets in the way? There are a few patterns that I see over and over again that stop traders from acting in their own best interest. These are the sabotaging patterns. The first one is lack of boundaries. You say yes when you mean no. You push when you should stop. You overwork. You ignore your own limits. And then you keep going along after you should have stepped away. So lack of boundaries really distort the balance between giving and taking. You might be someone who is a giver. And I know a lot of traders are, because many times when you step into trading, you're not thinking about yourself. You're thinking about generating wealth and abundance for your loved ones, maybe even for the world. You want to help people. I have traders who want to give back to charities, who want to make bigger impact. And trading gives you that opportunity. But now, when you are always giving and you don't have boundaries, you might also compromising yourself. And there might not be space for taking. And sometimes you might even let people walk over you and say, that's okay, that's all right, I can handle it, I'm strong. So just think about, how do you do that? And do you allow yourself to take as well? Do you give other people a chance to give by taking? And in trading, this can show up as staying too long in trades, cutting your profits short, or giving back your profits. Maybe pushing for more when you should stop. Generally ignoring your own limits, ignoring your own rules, ignoring the promises to yourself, even though you know you should stick to them. The second pattern is perfectionism. Anyone here recognize it? Anyone recognize perfectionism? Yeah. Arthur says yes. Nothing is ever quite good enough or quite right. Trading is a perfect environment for perfectionists, because in trading, nothing is ever perfect enough, right? It's just like the uncertainty, and it's just this environment, it's this tension, could be better. So you start overthinking your decisions because, in fact, you are constantly looking for certainty before you can act. And while you do that, it feels like you're doing the right thing, right? You want to make the most educated decision. You want to have all the information there. You want to have a certain certainty so that you don't make the mistake. Because the matter of fact is that perfectionists are actually looking for control. This is a form of control. So what you're really doing is trying to avoid the emotional discomfort of being wrong. So that costs you missed trades, not taking the profits in time, but also it costs you mental exhaustion because you're constantly second guessing yourself. And then eventually your confidence will suffer, because if you constantly question yourself, you will automatically kill your confidence just by introducing a doubt. It's a very normal thing. Just look in life. If someone would constantly question you, you would start questioning yourself too, right? And the third pattern is people pleasing and trying to prove something, trying to prove yourself. When you do that, when you have that pattern, you are basically acting based on how things look instead of what's actually right for you. What's the perception of what I'm doing? What will people say? What will they think about me? How does this make me look? So you operate from what other people expect from you, and you constantly look for approval. Exhausting. But this is because you don't want to disappoint anyone. So your intention is good, but you put yourself under pressure. So you start forcing. You start forcing trades. You start forcing yourself. You push through your boundaries. You start fighting the market because you need to prove that you are right. And then at some point, trading really stops being just trading, but it starts becoming about you. It's very personal because you're just trying to get it right, to show that you are someone. And that's where things really become dangerous, because now your decisions are no longer about what is the market doing. They are about what is it that you need emotionally. And what's important to understand is that these patterns rarely exist alone. They really feed each other. So it is not whether you have one or two. They exist in ecosystem. A people pleaser will often violate their own boundaries just to avoid disappointing others. A perfectionist keeps looking for certainty and then overcompensates emotionally when things don't go perfectly. And someone who is constantly looking to prove himself will often ignore their boundaries, their exhaustion. They will force trades. They will override their own limits. And eventually, all those patterns lead to the same outcome: acting against yourself. I talked more about these patterns in my latest podcast episode. So if this is something that resonates and you got interested, then I invite you to check it out. It's The Real Reason You Exit Trades Too Early or Give Profits Back. You can find my podcast on all major platforms or by going to confidenceinTrading.com. So my podcast, this is the name of my podcast, Confidence in Trading. And you can either scan the QR code or just go to confidenceinTrading.com. So the one thing that I see over and over again in our industry, most traders focus almost entirely on learning how to make money. True or false? Let me know. Is that your focus? Making money, at least at the beginning. And they spend most of their time developing the skills that will help them to do that, right? Yeah. Define the strategy, prepare the plan, execute the plan, even mindset skills, manage emotions, recover from losses, and everything is focused on how do I make money? I'm trading and I want to make money, and I'm seeing all these people making money. I want to make money. And all of those skills matters. All of those skills matter. They absolutely matter. because they do help you make money in the market. But what almost nobody talks about is the skill that actually helps you keep it. What do you do when you are in profit? That's the skill that you need in order to be constantly profitable. And maybe you have already experienced this yourself, that making money, it's not the hardest thing in trading, it's the making profit. That's the difference. And there is a gap in between. And that's the gap that I want you to start paying attention to. So you all go grocery shopping sometimes, right? That's probably the scenario that anyone can relate to, grocery shopping. I would assume, unless you're ordering your groceries online. If you think about it, you most likely would agree and assume that the store that you're going to is charging you more for the products that you're buying than they paid for them, correct? You would assume there is some margin on those products, right? That they can cover their costs. You also probably wouldn't find it strange that the employees get paid, that the lights stay on, and that the store eventually also closes in the evening so that everyone can go home and rest. You accept it, you understand it. Because the business is designed to make profit, right? So that's very normal. We accept that. So now think about your trading. How often do you treat it like a business that deserves profit? Are you running a 24/7 shop? Even when you walk away from the charts, is your mind still open for business? Overthinking, replaying trades, wondering what could have been, worrying about the losses, questioning whether you will ever make it? Never truly giving yourself the chance to rest. And just think about it for a moment. You are the biggest asset in your business. You are the business. You're the one-person show. So if you collapse, your trading business is done. It collapses with you. So if you want your trading business to become consistently profitable, you have no choice but start thinking through the profitability lens. And you can begin by just looking at how you live and which of these patterns we talked about today you see in your life, and how do they manifest in your trading. Because then you will understand how and why you trade like you do. And if you keep ignoring your needs, pushing past your limits, and trying to prove something, trading will reflect them back to you every single day. The skill that most traders miss is the profitability skill. The skill, the ability to act in your best interest. Not sometimes, consistently. Because the moment that you learn this skill and then truly also embody the importance of your role as a leader, your role in your trading business, that's when you will finally allow yourself to receive and accept what the market is giving you. Take it, but also keep it. So if what I presented today resonated with you, if you struggle with becoming consistently profitable, whether it's by cutting your winners short, giving your profits away, or taking big losses, I'm doing something special this year. This June, starting June 3rd, I will be working with traders who struggle exactly with these issues, with these patterns. at the summer bootcamp. And so we begin June 3rd, and access is by invite only. So if you are ready to break the patterns, if you are ready to stop acting against yourself, and then finally trade with your best interest at heart, then you can register for the priority list so that you can get your invite. And to do that, you can go to tradingmindsetjourney.com or simply scan the QR code. And I'm absolutely thrilled and excited to see you there. If you scan and when you register, you will hear from me shortly. We will be sending out the invites mid-May. So I'm very excited about it. This is something very special that I'm doing this year. And I can't wait to work with you guys at the summer bootcamp. Thank you so much for being here with me today. And I hope that this conversation gave you a different perspective on what profitability in trading actually requires and how easily, in fact, you can change your trading by looking at how you live and make some changes to the way that you approach yourself in trading. Thank you, Ortal. I really appreciate it. Yes, this is the QR code. Thank you so much, Ortal, for being here. Thank you, everyone, for being here. I always love to connect with traders, and if you have been in my environment for some time, you know that I always try to deliver the best of the best and organize events that help you guys to make differences to make changes in your trading, positive changes. So if today resonated with you, I would love to stay connected. So please feel free to connect with me on social media. And if you have any questions about what we discussed today, you can always reach out to me or send me an email. I read all my emails personally and respond to it as well. And we still have 5 minutes, so I would be happy to answer a few questions if you guys have some. Thank you again, and enjoy the rest of your afternoon. And thank you, David, again, and Anka for having me here. So if you guys have any questions, let me know in the chat. All right. No questions, guys? So if there are no questions, I'm curious, what is your biggest takeaway from today? And what is the one action that you are going to take in the next 3 days to implement some of the things that I have talked about? And maybe there's nothing that you say, well, I'm already doing all that. That could be also. Just think about it. One simple action that you can take in the next 3 days. Change my identity from P&L. Yes, so what would be the action that you can actually take to do that? Because it's a big task, right? To ask yourself to change the identity, disconnect and detach from that P&L. What could be that thing to do? For example, you could take the P&L off your screen when you trade, or look at your when you analyze your trades, really focus more on the process and look at what you did well instead of, oh, did I have a green or red day? That could be something really concrete action. That's how you could start disconnecting, detaching your identity from your P&L. Very good. Take care of myself outside of trading. Yes. Give yourself time for yourself. Beautiful. Not letting losses define me. That's fantastic. That's amazing. So Focus on how do you define your self-worth? What would that be that you will take the next 3 days, or even, like what will tell you that you are already a fantastic person, worthy of success? Cut back my hours on charts. Yes. Yes, because it's not about the quantity, it's about the quality. What do you do with the hours that you have? And how much time do you give yourself to reset? How much time, not just yourself, but your nervous system to reset and make sure that you can actually have the relaxation and come back with a clean slate the next day. Reminding myself my business is open, needs to be profitable. Don't give too much. Yes, treating your trading as a business is absolutely key. Absolutely key. Just remember, if you are here to make money, this is not just a hobby thing. If it's a hobby, it's a lot of time very costly hobby. You're supposed to have profit, not just make money, but profit. So think through the profitability lens. I'm a momentum trader. I trade breakouts. I trade reversals. Yes. Sorry if you mentioned that. I haven't. I'm a day trader and I trade momentum stocks, mostly tech, mostly tech. Oh, you too, Arto. Awesome. Yes, I have always been a momentum trader. That really suits my identity. I love that. And I trade high value stocks. I don't trade penny stocks or anything that is crazy. So I like, peaceful life, so to say. I like to sleep. And I'm very conscientious about how and to what kind of things I expose my nervous system, because the way that you treat yourself will show in your performance. So thank you so much, guys, for wonderful engagement. That's why I love doing this, because this is what truly matters. So thank you again, and thank you, David, and wishing you a wonderful rest of your day.
Thank you, Agnieszka. Thank you for being here. All right. Yes, lots of good information from Agnieszka. So I'm put all her links in here again. So be sure to check those out, her podcast and her offer, and her email address. All right. All right. So just a reminder. A slight schedule update. Harry Boxer was supposed to be here yesterday. He was not able to be here. So he had something come up, but he will be with us at 5 p.m. Eastern time today. So Jim Fink is up next, and then Sonny Harris, then AJ Brown at 4 p.m. And then Harry Boxer will close out the day for us at 5 p.m. Eastern time. So Jim, are you there?
Yes, hello. I'm here.
Hi. How are you?
I'm good. Thank you, David.
You should be able to share your screen and get set up now.
Okay.
And thank you for joining us for this event. Jim is a first-time presenter with Timing Research, so really happy to have him here with us.
Happy to be here. Are we ready to go, or?
You're still not sharing your screen yet.
Um,
You have to hit that green button and then select the window you want and then hit share. I think I think it's a blue button.
Blue button.
Well, first you have to hit the green share button.
Okay, let's see if I can.
Do you see the zoom menu?
I just see share. Let's see. Is that entire screen?
Okay, it's loading.
Is that working?
It's loading. Okay. Okay. Yeah, now I see your PowerPoint.
Yes.
So if you can just make the full screen. Okay. Okay. You ready to start?
Yes.
Okay, great. I'm going to start my recording again, and then you can start your presentation. So I'm recording again now.
Thank you, David. Hello, everyone. Thank you for joining me today. I'm going to be talking about the options miracle system, how to generate 30% annualized returns in a stagnant market with limited risk. My name is Jim Fink. My website is jimfinkinvesting.com, and I am associated with Eagle Financial Publications, a subsidiary of Salem Media Group. This is a picture of me. Maybe when I was slightly younger. I like to think of myself as younger than I am. My educational background is extensive. Yale, Harvard, Columbia, Virginia, CFA charter holder for 17 years. Some people say I am overeducated, but I think it gives me a little bit of a pedigree to talk to you today, and know that I seem to have some competence in this subject matter. This is my jimfinkinvesting.com website, and you see that I offer 4 services: seasonal stock alert, options for income, velocity trader, and Jim Fink's inner circle. Today I'm going to be talking primarily about options for income. And I would say that to believe what anyone tells you, it can't just be what they say, but actual results that they have generated. And so I'm just going to provide you with some of Option for Income's recently closed positions. This is from January of this year. I've been doing options for income for 16 years. It's not just a one-off where I had one good year or 2 good years out of the 16. I pretty much have a very consistent winning percentage. And I just wanted to show you some of these recently closed trades that I've done to show that what I offer consistently produces profits month after month. And a lot of these are, I mean, I'd say I average 30% on most of my trades, but as you can see from this, some of them are higher. Credo CRDO is 51%, some are a little lower. SkyWest was only 12%. When you combine all of these together and average them out, I'd say it comes to around 30%. Now, Options for Income is a stock enhancement service. I don't consider it a stock replacement service because options are derivatives of stock. They don't exist without stock. But what makes options so great is that they are much cheaper per share than stock, and options, therefore, because they are cheaper, provide leverage that can magnify a stock's tiny price move into a much larger percentage gain. Also, what's great about options is that you can sell them for income without actually owning them first. Most things you can only sell that you own, and with options, since there are derivative contracts, you can actually create an option contract and sell them without owning them first. And options can be combined mainly through spreads, where you buy one and sell another, that you can make money even without stock moving, and even if the stock moves opposite from your expected direction. And that's really the magic of what Options for Income provides. It provides you the chance to make 30% returns, even if the stock that you are betting on does not go up as anticipated. And actually, it could actually go against you a little bit, and you can still make 30%. That is something I have always been amazed about and keeps me excited about this service for 16 years and for as long as I'm going to do this service. That is the primary characteristic that excites me the most. Now, I think one of the reasons it's important to use options now, and especially that characteristic I just mentioned about how you can make money even if the stock does not move up, I think that's very important now, given the current market situation. I mean, for many years, buy and hold index funds were the way to go. And as of right now, with stocks at all-time highs, you could argue that it's still a good way to go. But you just have to be aware that it's a very risky market environment. Even though we're all making money with the stock market going up so high and at all-time highs, the risk is going higher as well. And there's a great website called advisorsperspectives.com. And it provides various market valuation methods for the stock market. And four of the most important ones are the Cressmont PE, the cyclical 10-year PE, the Q ratio, and the regression of the S&P above its regression. I mean, the S&P composite level compared to its regression line. And if you look at all of these, you see that the market is tremendously overvalued, regardless of which of these measures you look at. And if you average these four together, you get an average overvaluation of 160%. And as you can see from this chart, 160% is pretty much the highest overvaluation the stock market has ever had. And this goes all the way back to 1900. So this includes the 1929 crash, the Depression, the 1987 crash, the 2000 internet bubble crash, and the 2008 global financial crash. All of those crashes happened at overvaluations that were less than the overvaluation we are facing today. So that is quite a sobering realization. At the end of January, the average of these four valuations, as I said, was 160% overvaluation, one of the highest levels in history. And for the 8th straight month, the average is more than 3 standard deviations above its historical mean. 3 standard deviations is extremely rare and has only occurred 0.3% in the history of the stock market. And the historical precedent, whenever the market gets this overvalued at 3 standard deviations from its mean, is a very poor forward return profile. Average annual returns over the next 10 to 20 years, 0% to actually negative. And drawdowns of 50 to 90% are common before a recovery. Now, I have to say this is not a market timing signal. Markets can remain overvalued for years. For example, during the internet bubble in the late 1990s, the cyclically annual PE ratio stayed above 30, which is, a very high reading for like 5 years. So a 3 standard deviation overvaluation doesn't mean a crash tomorrow. It means very low expected future returns and elevated risk of major corrections. So yes, we can go higher in the short term, and we probably will go higher in the short term. But the risk you have to keep in mind, and you should start thinking now of ways to reduce your exposure to whenever this overvaluation resolves back to the downside. Warren Buffett has a famous market valuation technique where he looks at the percentage of total market cap of the stock market relative to U.S. gross domestic product. He thinks this is the single best measure of valuations at any given moment. And recently, the ratio has been a 64.3 trillion market cap to only a 31.1 trillion gross domestic product. That's a current ratio of 206.6%. The norm is only 105.5%. So the stocks are typically just slightly more than the GDP. Now they're double the GDP. And that is an extreme reading. And if you look at Warren Buffett's Berkshire Hathaway, its cash balance is one of the highest in history. So he is hoarding cash. He is not wanting to invest a lot of money in this overvalued market. Guru Focus is a good website, and it has its iteration of the Buffett indicator, and based on their calculation of the Buffett indicator, the stocks are likely to return actually a negative 0.5% a year from this level, including dividends. So over a 10-year time frame, you will not be able to earn a lot of money just from buying and holding an index fund. You got to do something else, and I think options are the way to go to bypass this lost decade that is coming up soon. So here's a chart again showing you this overvaluation of the Buffett indicator, highest in history. Howard Marks of Oaktree Capital back in December said whenever you buy the S&P 500 at a 23 times PE ratio, your 10-year annualized return has always fallen between negative 2% and 2%, basically no return in every case, every case. Grantham Mayer Van Otterloo, a Boston money manager, has a 7-year asset return forecast that comes out every quarter, and their latest one that came out on March 31st shows that they see the real return for U.S. stocks negative over the next 7 years, with large cap U.S. stocks the most negative of any of their asset classes, negative 5.7% per year. That's just insanely bad, right? Small caps are slightly better. I guess the best thing they view here is Japan, right? Japan's small value is the one they think will do the best. Second best would be international deep value. So GMO is saying to stay out of the US, go small, go Japan and international. Now, again, overvaluation is not a market timing tool. One-year returns can do anything when the market is extremely overvalued. As you can see, the x-axis here is the price to earnings ratio. And when we're up here in this elevated region of 22 or higher, the regression line shows that the forward returns are declining as your PE ratio gets higher. But you see that individual years, which are these gold diamonds, are both up above the regression line and below. So in any given year, you can still have very high returns despite overvaluation. But the trend is clear that on average, returns decline with higher price to earnings ratios. And again, this is a 10-year return. Now, even though the market is at all-time highs, we've had incredible dispersion under the surface between individual stocks, where most of the gains on the market cap weighted indices have been based on the mega cap tech stocks, and a lot of stocks, mostly because of artificial intelligence displacement, a lot of the big software stocks in particular have just been crushed. And this chart shows how there have been 115 or more stocks in the S&P 500 that have fallen at least 7% in a single day across a rolling 8-day window. This doesn't happen very often, but when the market is hitting new all-time highs, but you have a significant number of stocks crashing down at the same time, that is kind of not a healthy market. And it's what happens near the end of market rallies, not at the beginning, where some stocks are really starting to realize that, hey, this is an overvalued situation, whereas others continue to rise. And so this is a sign, the surge in blowups near market highs is a sign of increased risk. And you see from history, all of these red circles, which are times when this surge in blowups has occurred in the past, it has typically happened near market tops and riding the market back down. It happened in the internet bubble of 2000. It happened in the 2008 global financial crisis. It happened in the 2020 COVID crash. And it started to happen again now. Well, we're at the highs now. Will this lead to a similar type crash scenario. You can't be sure, but it definitely smells like it, and the risk is there that it could happen. Now, there are currently different opinions on where the stock market is going. I mean, obviously, we all know the market is hitting new all-time highs. So right now, things look good. But there are bears out there, very smart bears. Jeremy Grantham of GMO, Howard Marks of Oaktree, Michael Burry of the Big Short fame. They think the artificial intelligence bubble, which is the reason stocks have risen so much over the last few years, is already complete, and there is a risk of an immediate bear market. Then you have somebody like Mark Spitznagel of Universa. I think he worked with that guy, Fooled by Randomest guy. Anyways, he thinks the AI CapEx blow off top is near an end, but not here yet. So we could have several more months of gains before the bear. And then there's Uber optimists like Elon Musk of SpaceX and Tesla, who says there is no artificial intelligence bubble. We're entering an age of abundance where artificial intelligence and robotics are simply going to collapse labor costs to zero. Living costs are going to collapse as well. Housing, food, goods, and services will all become extremely cheap, if not free, thanks to AI. We'll all be able to provide everybody with a universal high income. It's really a nirvana situation. And Elon Musk is the main proponent of that. So there's definitely a wide divergence of opinion where the market is going next. But what is not in dispute is that the U.S. market is heavily concentrated in just a few stocks. As you can see, the weight of the 10 largest stocks in the S&P 500 is currently near 40%, the highest in history. Even during the internet bubble of 2000, it was only around 26%. And back in 1979, 80, it was at 26%. So everything is really at extreme levels. Okay, right now it's the top 10 stocks make up 39.8% of the S&P 500. These are the 11th to 50th largest stocks in the S&P 500 make up just 22.5%. These are both historic extremes similar to the 1960s Nifty 50 era, right around 66 to 68. And that was obviously a market top before the crash in 69 and 70. And again, here you see the weight of the largest stocks is at the highest level in history, even higher than it was during the 1960s Nifty 50 era, and obviously much higher than during internet bubble, global financial crisis. Jason Gopher, founder of SentimentTrader.com, was quoted a couple days ago, or I guess it was yesterday, saying May 6th was the second consecutive day that the S&P 500 closed at a record high, but with more than 4% of its stocks hitting 52-week lows. This is that dispersion I was talking about, where the market cap weighted index continues to hit highs, but a significant number of stocks are doing very poorly. What is the only other time in 100 years where this combination of market highs with 4% of stocks hitting 52-week lows, when was the only other time this happened? 1929, and I'm sure everybody knows that 1929 was the great financial crash. It happened starting in early September and crashed into October. Again, I'm not saying that's going to happen this year. It probably won't happen this year, but it's never good when the only analogy to the current situation is a crash year like 1929. Here's an interesting chart from Schroders from a few months back. They have a very nice website where you can get all this information for free. So it's in the public domain. And as you can see, all markets are now in expensive territory, with the U.S. market the most expensive. Dark red means the most overvalued or most expensive. And based on all these valuation measures, U.S. stocks are extremely overvalued. The ones that are less overvalued, I would say, well, they're all overvalued, right? I guess Europe, ex-United Kingdom, and Japan maybe have the least number of dark red squares, but none of them are green or gold colored, which are cheap or neutral. The only stocks really anywhere in the world that are not extended and cheap are small cap stocks. And as you can see, even outside of the United States, large caps are pretty much overvalued. It's only when you get to the small caps in either the United States or outside of the United States that you see any, nothing's cheap, but at least you see some gold colored here in the small caps, which is a neutral or fairly valued reading. And small caps are cheap versus large. Here's it's not really a regression line, but it is a trend line showing the ratio of small caps divided by large caps, and small caps have been getting cheaper and cheaper and cheaper over the past decade. And so this is really, if you're not going to try to do options, which I recommend, you just want to stay in stocks. This is why I'm bringing this up, that if I'm trying to help you out here, if you just want to still be a stocks only investor, small caps are the only really part of the market that makes sense right now. Another reason stocks could be in trouble is U.S. government debt is starting to spiral, according to the Congressional Budget Office. Publicly held debt is currently $31 trillion. It's about 100% of GDP by fiscal year 2030. Debt is expected to exceed the 106% record set after World War II and then surge as high as 120% by 2036. Now, all of this debt is increasing annual debt interest costs. In fact, these debt interest costs are expected to double by 2036, which will reduce the amount of discretionary spending available for everything else. You have to pay the interest on your debt, and it's crowding out everything else, and that is going to force the government to reduce government spending on other things, which will probably result in higher inflation, and even could it be stagflation, where you have high inflation and low to negative economic growth, all because our debt is too high. U.S. Treasury bonds are no longer acting as diversifiers for stock because we're in a supply shock inflation regime, not demand caused inflation regime. When inflation is caused by a supply shock like oil prices in the Middle East, interest rates the Fed can't really do anything about that. It can't. Raising interest rates won't cause oil prices to come down. They're they're inflated because supply is constricted by blockades in the Strait of Hormuz. So the Federal Reserve is really hogtied. They really can't bring down the inflation level from supply-driven inflation, and that's a real problem. So what are the investment themes for today if you just want to stay in stocks? You got to go for value stocks, and especially small cap value. Focus on low beta, meaning not correlated with the S&P 500. High alpha, uncorrelated assets and investment strategies. What are these type of investments? Catastrophe bonds. They have no correlation with stocks because basically these bonds are based on weather catastrophes, other types of catastrophes that really happen based on their own schedule and have nothing to do with whether stocks are cheap or expensive. Managed futures, where you're playing momentum and trend following, and hedge funds, which go both long and short. The artificial intelligence boom is helping a lot of companies, especially the picks and shovels companies like semiconductor suppliers, Micron, Broadcom, all those type of stocks, but it's hurting the hyperscaler companies, Meta, Amazon. They're getting hurt because they have to incur incredible investment costs getting all of this artificial intelligence developed, and it's a big drain on their cash flow, and profits are way out in the future, and those stocks are getting punished because investors are worried that they're overspending for this AI build out. So focus on the picks and shovel semiconductor companies, and this includes utilities. Electric utilities are a big part of the artificial intelligence boom because artificial intelligence requires massive amounts of energy. And utilities are obviously electricity producers, so they have a tremendous backlog of orders for their power, and that will be true for many years to come. Data center real estate companies, which provide the housing for data center computers, also have a very good runway of growth in the future, and even some space-based solar power which is really way out there. But a lot of people think that the electric utilities on Earth will not be sufficient to power all of the artificial intelligence computations that will be needed, and that will have to go out into space to augment our electricity generating capacity. So here are just some sample ETF portfolios, non-option based, based on uncorrelated assets. I'm not going to go into every one of these investments, but they include things like foreign stocks, precious metals like gold, catastrophe bonds. ILS is catastrophe bond, managed futures, trend following, DBMF, multi-strategy hedge fund, small caps in the US, and of course cash is king. It's good to have a powder reserve for when there is a market correction, and you can buy cheap stocks when they get cheaper. I don't really recommend bonds right now because, as I said, bonds are not a good diversifier with the supply shock inflation. Bonds are not going to help you out much. Given this allocation, I think you could expect an annual return of about 8%, which is a lot better than the 0% that a lot of the doomsayers are saying is going to happen over the next 10 years because of the market overvaluation. But you can even do better, and I think this is where options come in. Even if you don't want to go all in on options, and I don't think anyone recommends putting 100% of your portfolio in options, right? Although the way I do options, it is much safer than what you might be imagining. But I think it is fair, even for conservative investors, to maybe have a 10% option sleeve, right? Where 90% of your portfolio is in traditional investments, fixed income, stocks, but you have 10% in an options-based strategy like options for income. And as I said, my average return from options for income typically is around 30% annualized. That is not every year, obviously. It's an average. Some years are better, some years are worse. But if you had a 10% sleeve in option strategy like options for income, that would give you an income boost of about 3%, right? 10% of your portfolio times 30% average returns would be a 3% performance boost. But of course, replacing 10% of your portfolio with OFI means you're replacing a portion of your portfolio that was generating some interest. So it's not like you get a full 3% boost from this switch, but I calculate you get about a 2.4% extra boost because you get a 3% boost from OFI, but you're losing an 0.6% return boost from the 10% that I am replacing with the OFI. So you take the 3% from OFI, subtract out the 0.6% from the replaced investments, and you get an added return of 2.4%. Now, 2.4% might not sound like much, but adding 2.4% to the 8% that you get just from an ETF only portfolio makes a huge difference over time. 10.4% annualized through compounding is way better than just 8.0%. And this table shows you that. If you have a starting portfolio of $100,000 at 8% return after 10 years, you would have $215,000. But if you had an option sleeve that boosted your annualized return by 2.4%, that 215 would actually be about 53,000 higher. at 268. And if you go out 30 years with this added return from options, your nest egg would grow almost double, from $1 million at an 8% return to $2 million at a 10.4% return. So the key takeaway is adding just 2.4% extra per year to your portfolio would increase your nest egg by 25% after 10 years, 55% after 20 years, and nearly double your portfolio after 30 years. Now, there's a thing called loss gain asymmetry, which makes position sizing crucial to success. And I think I take position sizing very seriously in my options for income product. And I think it's one of the biggest mistakes traders make, more than entry points, more than exit points, more than any technical indicators. It's position sizing, because not every trade is going to work out. And if your position sizing isn't appropriate, that one mistake can wipe you out. As you can see, if you have moderate losses, it doesn't take much to gain it back and break even, right? A 10% loss only requires an 11% gain to break even. But if you don't have proper position size and you bet too much on a particular trade and you lose 50%, it's going to take you 100% to break even, which is extremely difficult, right? Don't be in the position where any one trade or any two trades can lose 50% of your portfolio, because it's going to be almost impossible to make it back. If you lose 90%, you'd have to make 900% return. It just shows you that the important thing in trading is not so much how much you gain, but it's how much you lose on the inevitable trades that don't work out. And as long as you keep your losses modest, you are okay, and you can make it back, okay? Even if you have the greatest trading system in the world, if you bet too much on the one or two trades that don't work out, you're going to go bust. So you want to have a positive profit expectancy in trading, right? Risk reward by itself doesn't matter in isolation. Probability of success doesn't matter in isolation. It's the combination of these two that matters, because it equals profit expectancy. Risk reward times probability of success is profit expectancy. So if you have only a 30% probability of making a $500 profit and a 70% probability of losing, that's still okay if the gain from the gain when you win is larger than the loss when you lose. I mean, most people think, oh, if I have a trading system that only wins 30% of the time, that means I'm losing 70% of the time. That can't be a winning strategy. And that's wrong. It can be a winning strategy if the asymmetry between the profit per trade and the loss per trade is large enough. Similarly, if you win on 95% of your trades, that does not guarantee that your system will be a profit machine, because again, it depends on the disparity between the average profit per winning trade and the average loss per losing trade. If you only lose 5% of the time, but when you do lose that 5% of the time, you get a massive loss, you're still going to have a negative profit expectancy and you will not make money. So keep in mind, you need to keep both risk reward and probability of success in mind at the same time. And this is where we get to the idea of average. Well, you say, well, the average return is 30%. That's true. But does that mean every trade is up 30%? No, it doesn't. Some of the trades lose money. So if you bet everything on a trade because the average is 30%, you are going to go bust. And this is a great little image explaining that, where the average depth of a pond might be 3 feet. But if you step in the wrong place, you can drown, because any particular spot in that pond can be deadly. And that's how trading is as well. Commodities trader Richard Dennis, founder of the Turtle Experiment, did not focus on prediction. He focused on exposure. Position sizing was his most important criteria. He wanted to keep the risk per trade small. Size was adjusted to volatility. The more volatility a trade, the smaller the position size. Drawdowns were expected. Survival was engineered. Position sizing was his edge, not his ability to pick winners. It was position sizing. If you can still fail if your sizing accelerates drawdown beyond recovery math, even if you have a robust system. And I recommend you read a book by one of the turtles, which was Richard Dennis's experimental group of novices who he was able to teach his system to. Curtis Faith was one of Richard Dennis's best students, and he wrote a book called Way of the Turtle, which explains Richard Dennis's trading system and why it was so successful. And this book is, I think, required reading for any trader, and it talks all about position sizing and how that is the primary focus of any successful trading system. Van Tharp is another guy who talks a lot about position sizing. I think he's no longer with us, but he wrote a book called, I can't remember, Trade Your Way to Financial Freedom, I think was the title of the book. And he gave a great example of why position sizing is so important. He said, we've done many simulated games in which everyone gets the same trades. At the end of the simulation, 100 different people will have 100 different final equities, with the exception of those who go bankrupt. And after 50 trades, we've seen final balances that range from bankrupt to $13 million. Yet everyone started with the same $100,000 and everyone got the same trades. Why is there such a dispersion in profitability when everyone got the same trades and started with the same amount of money? It's because they had different position sizes. Those who bet too much on any particular trade went bankrupt. Those who kept their position sizes small and survivable made a lot of money, $13 million on one extreme example. So the conclusion is positive expectancy plus proper position sizing is the key to success. You want to be the casino. Roulette pays odds of 35 to 1, even though the odds of winning are only 37 to 1. Casinos don't mind losing $35 on several bets because they know over the long term of millions of bets, the odds generate a positive expectancy of 5.26 cents per $1 bet. So that's what we want to do. We want to be the casino with the odds in our favor. Now, there's a great book called Unexpected Returns and Probable Outcomes from an author named Ed Easterling. He was the founder of Crestmont Research. He lived most of his life in Texas, but then when he got rich, he decided to move to Oregon and live in a forest because he loves trees. So you can become very eccentric later in life if you are successful in what you do. And Ed Easterling was definitely successful. And one of the most important chapters in his book, Unexpected Returns, is row, not sail. And what he argues in this book is that traditional buy and hold relative return strategies rely on the direction of the markets. They enjoy gains when they occur, suffer losses when markets decline. But you don't want to rely on buy and hold index funds when the market is 160% overvalued, as I showed earlier. Now is too risky a time to just rely on index funds. You need to have a skill-based tactical strategies, seeking absolute returns regardless of market direction. And that is exactly what options provide you with, as long as you trade options correctly, as I do in Options for Income. And this is a great quote of his. When the wind is blowing, we can let out the sails and enjoy the ride. That's when the market is undervalued and cheap and it's just going to go up, right? That is not the case today. When the wind stops blowing, you can sit there and wait for the wind to come again, or you can get out the oars and start rowing. Well, we are definitely in the part of the market cycle where the wind has stopped blowing. With that, the type of overvaluation we are currently experiencing, you cannot just rely on buy and hold investing. Options are the oars that will allow us to generate profits even though the wind is not in our favor. Even if the wind is a headwind going against us, right? That would be similar to stocks earning a negative return. Options will allow us to make a positive return. So the benefits of options are they allow you to obtain only the exposure you want. I like to say that in chemistry terms, call and put options are the atoms that make up a stock molecule. Buying the entire molecule, which is stock, is very expensive and wasteful, especially when stocks are overvalued. Options allow you to limit your capital risk to only those portions of a stock price movement that you want, and for only the period of time you think is necessary. I like to think of a stock as having three components: the roots and trunk, solid as a rock, based on cash, tangible assets. Then the middle section, which is the branches and buds, it's the growth area. That's number two, is where I like to participate on the long side. I like to participate on the short side when we're dealing with roots and trunks. And number three, sky above the branches, I also like to bet against that. Speculation based on where the beanstalk could grow above its fair value based on things like takeover rumors or unrealistic earnings projections. These type of options that are out of the money, far above the current stock price, are fully time value, which time value is a measure of just speculation of what could happen in the future. So when you separate a stock into these three sections, I like to sell options in number one, I like to sell options in number three, and I like to buy options in the middle here, where it's reasonable that you could actually profit. Okay, so here, as I say, the root portion of a stock, which is likely not going to decay or lose value, that's where I like to sell put options, because people are betting on catastrophe on a solid company at a very low price. I'd rather sell that insurance to people who are being hysterical to the downside, right? So I like to sell out of the money put options. I like to buy current in the money call options near the current stock price, because that's where most likely movement is going to occur, especially if you know how to value stocks and can buy it when it's slightly undervalued on an individual stock basis. And I also like to sell low probability greed. That means out of the money call options at strike prices way above the current stock price. And if you do this, I think you're going to come out ahead. So what is my edge in options for income? I like to sell options and harvest decaying time value. Time value always decays and reaches zero at expiration. It is a certain and unalterable force of nature. So I ask you, do you want a certain and unalterable force of nature with you by selling a decaying asset, or do you want this inexorable force of nature against you by purchasing a decaying asset? I argue that selling options is better than buying options in most cases, because you've got this inexorable. Secondly, I was a CFA charter holder for several years. I went to business school. You've seen my educational background. I know how to value stocks. I know how to do discounted cash flow analysis, DCF. I also know how to use relative valuation measures, comparing PE ratios and things like that. And I only like to place bullish to neutral option trades on fundamentally undervalued stocks. Yes, the market as a whole is overvalued, but there are individual stocks that are undervalued or fairly valued, and I know how to find them. So what I like to do in options for income is basically sell a 5-point option spread, put option spread. For example, for $1.25 credit, if I sell it for $1.25 credit, that means that I have risk of $3.75. What you do is you take the credit you receive, subtract it from the difference in the spread strikes, and in this case I said it's a 5-point spread, so that's 5 points of risk minus the $1.25 credit you get for opening the position, and you have risk of $3.75. Then to calculate the potential return, you take the credit you've received, divide it by the risk of loss if you're wrong, and that is your rate of return potential. And so 125 divided by 375 is 33.3% return, which is right around the 30% average that I have generated in options for income over time. Now, this is a risk reward of 3 to 1. Some people say, I don't like that. I don't like risking 3 to make 1. But as I said earlier, you can't just look at risk reward. You've got to look at probability of success, okay? So if the probability of success is greater than 75%, your expectancy will be a positive return, right? So 3 to 1 risk reward means that you need a probability of profit of 75% to break even. My winning percentage on my trades is in the low 90s, right? So 90% or better probability of success is way better than the 75% break even that mathematics says would cause break even with a 3 to 1 risk reward. So that's my edge, is that my probability of success is greater than the risk reward would suggest if I was just flipping a coin. Okay, so I'm perfectly fine with a 3 to 1 risk reward ratio because my win rate is much higher than 75%. So as I said, time value surcharge is the magic behind the options for income system. We are selling time value which decays to zero every single time. Time value always decays and reaches zero at expiration. And so by having this in our favor, we make money. Now, there are 2 ways to maximize time value. One is to sell options right near where the stock price is. That's considered at the money. And as you can see from this chart, time value, which is the stuff that decays to zero, is highest at the money. So I typically like to sell options at the money. So if the stock is trading at 50, I sell the 50 put, the strike right at the stock price. That gives me the maximum amount of time value to decay to zero. So now, sometimes I'll go a little out of the money just because I want to have a little cushion so the stock could actually decline without hurting my position. So even if I go out to the 45 strike and not right at the 50 stock price, it's still the greatest majority of the time value left to decay. And secondly, I don't like to sell options that are too far out into the future, because if you look at time value decay, it is not a linear line. It is a waterfall effect where most of the actual time value speeds up and decays in the last 30 days, 30 to 60 days. I think actually this study and the sweet spot for selling time value decay is right around 45 days, which is right in the middle of 30 and 60. So most of the trades and options for income that I sell or I open up are in the 2-month area. Okay, 2 months is 60 days or so. And so I'm getting most of the time value right when it starts to decay at an accelerated pace. You know, how do I pick the right stocks in addition to looking at valuation, which, you know, in the short term cannot always work out because it's a long-term valuation is a long-term measure of performance. I also like to use stock seasonality, which is a shorter-term quantitative method for finding those stocks likely to rise or at least not fall a lot. Seasonality refers to particular time frames during the calendar year when a company's stock price is influenced by recurring forces that produce a consistent price direction, either bullish or bearish. It's just a fact that some stocks tend to go up consistently at certain times in the year. For example, consumer-related stocks outperform typically in the summer months. Manufacturing and production stocks outperform in the winter months. Seasonal tendencies can be based on weather events, spending surges, new product announcements. You're never really sure exactly why stocks perform in a certain way during a time of the year. You can guess, but the fact is they do, and it's, you know, that's all that matters, right? You don't have to have a perfect theory for why things happen as long as you observe that they do and you take advantage of it. Now, what's great about Options for Income is that we have this tool free of charge for you. It's called the Seasonality Navigator, and as this shows you, you can type in any stock symbol and you will immediately get the last 10 years of seasonality data from a certain start date. Here, I'm using a start date of February 17th, 2026. And then you see from that start date, how has the stock performed over the past 10 years to each of the next 6 options expiration dates. So this would be, so right here, it says 60, that means 60% positive. So if you're looking at ASML, which is a semiconductor equipment manufacturer, which is one of those picks and shovels for AI I was talking about earlier, which is a good stock to own. Between February 17th and March options expiration over the past 10 years, it's risen 6 out of 10 years. Not great. It's slightly better than 50-50. But I like 80% or greater. So what you can do is you can put in like every stock ticker in the S&P 500, 500 stock tickers, and then you can sort. Just click on any expiration date and it'll automatically sort all of these stocks to see which ones have performed best between February 17th and June options expiration. And as you can see, ASML, although it has done only mediocre between February and March, has done outstanding between February 17th and June options expiration. So this is a way to find a stock that has done 9 out of 10 years higher. If I was going to enter an option trade starting on February 17th, I would look at ASML going out to June expiration, because I know that in the last 10 years, it's risen 9 out of those 10 years. This is totally separate from valuation analysis. If I also think ASML is undervalued, all the better. I'll have undervaluation and the seasonality in my favor. And it would be a great trade to sell one of my OFI option spreads, and we could make money, right? And what's great about this tool is it's free to you. I use it for my trades, but you can also use it for your own trades. A lot of people in my service use this tool to find their own trades, and it's just it's an added benefit. I think we could actually, sell this tool, seasonality tool, by itself for a lot of money. But if you subscribe to OFI, you get it for free. And here you see the magnitude for ASML for each year in the 9 of 10 that it's gained. So you don't only see that it's gained 9 out of 10 years, but you see that in a lot of those years, it's gained double-digit percentages. 1, 2, 3, 4, 5, 6, 7 out of the 9 gaining years, it rose by double-digit percentages. That's another great thing that we learned from Seasonality Navigator. So I think I've basically almost run out of time. There's a lot more on the slides that I hope you can read later. But I just want to tell you, well, I'll give you these 2 trade ideas I came up with. First, where is the first one? Yeah, American Tower. I'm not recommending this, but it's the type of trade I would recommend if I did more research on its fundamental valuation. American Tower is currently trading around 179.40. It's got a 10-year seasonality of 90% into July expiration. So a trade you could do would be to sell the 170, 165 put spread. If you sell the 170 for $4.30, buy the 165 for $3. You get a net credit of $1.30. The potential rate of return, $1.30 over 370 is 35.1%, which is right in my wheelhouse in the 30% range. Yeah, I mean, it makes a lot of sense to do a trade like this, although I haven't done the fundamental valuation. And again, this will make maximum profit at a price of 170 or higher. With the stock at 179.40, you know what that means? That means American Tower could actually decline by $9.40 between May 7th and July 17th expiration, and you would still make 35.1%. We're doing this on a stock that has risen 9 out of 10 years, but just in case it did fall and it fell by $9.40, you would still make money on this trade. That is just an incredibly good risk-reward proposition, I would say. So it's just a great trade, and this is the type of trade I recommend every week in options for income. And then iron condors are another great strategy, but I don't have time to talk about it. Here's a trade that you could do at CBOE Global Markets. You could sell a June 320, 310 put spread, also sell a June 360, 370 call spread. You get a net credit of 285 on a 10-point spread, and you would have a potential rate of return of 39.9%. Another great trade. So I've given you two trades that make sense. I'm not recommending them, but you've got American Tower July put spread and a CBOE June Iron Condor as potential trades. Okay, so today only a special active traders playbook offer for options for income is a great deal, if I say so myself. The regular price for OFI is $1,995 per year, but we have an active traders playbook special today only. If you subscribe today, you can get options for income for 30 days. That's at least 4 weeks of trade recommendations, 2 trades a week. That's at least 8 trade recommendations in the first 30 days for only $30. That is an amazing deal. And if you like it after 30 days, it will automatically renew at a more reasonable price of $99.95 for every subsequent month. But even at $99.95, it's a discount off of the regular $19.95 per year price. Please see the link below for details to sign up. This is the best deal we've ever offered. $30 for 30 days is just amazingly cheap. And a great investment on your part, I must say so myself. And what you get with an OFI membership, at least 2 new trades per week. All trades are continuously monitored, historical 90% win rate, and I provide adjustment trades if necessary until the trade closes profitably. We have an active community discussion board where I answer questions on a daily basis. We have that seasonality navigator tool I mentioned earlier that is free of charge. Comes with a subscription. You can use it to understand the trades I recommend. You can use it for your own trades. It is an amazing tool and definitely worth the subscription price by itself. We also have a 6-step video training series. So if you're a complete novice in trading options, I walk you step by step through the basics of option trading, and you can lean over my shoulder and learn my technique. I would say the majority of options for income subscribers started out as novices, and now they are experienced veterans, and we have a great time in the discussion board, and we're all making money together. Lastly, we have a free monthly live options training. If you don't want to just look at a video training series that's taped, you want to actually have a live options training with a live trader. My associate Derek Myers has monthly options training that helps you understand my services, not just options for income, but other services as well. And it is a great tool. Derek's a great guy. He's my right-hand man, and we do our trading together, and it's really, really fun. So there's a lot you get from your membership. So again, please see the link below for details and sign up now. Thank you very much. It's been my pleasure. I hope you got value out of my presentation. And back to you, David.
All right. Thanks, Jim. Thank you for being here.
Thank you.
I'm going to post your link in the chat for everyone again. So, yeah, this was Jim's first time with us here on Timing Research. So great presentation, and happy to have you here.
Thank you, David. I hope to see you again soon, and everyone else.
You're welcome back whenever.
Thank you.
Awesome.
Bye.
All right. Thanks, Jim. Okay. So yeah, be sure to hit Jim's link there and check that out. And next up is Sonny Harris. Sonny, are you there?
Here we go. There's that. And start my video. You mean my presentation?
Oh, well, I turned off your camera when you logged in, but you can turn it back on if you want. Not required.
I see. No, I don't want to turn it back on.
Okay.
All right. So let's see. How do I share my
You-
screen? More, share, and share.
Okay, it's loading. Okay.
You
There
see
is.
it?
Yeah.
All right. Fantastic. We're going to do a little systematic trading today. I'm Sonny Harris. And my website's moneymentor.com. And my passion is in helping new traders, traders with a little bit of experience, but not a lot, people who want to learn. So people who have not yet become wildly successful. And I say that because I've done a couple of wildly successful years and I want you to be able to do them too. For instance, right now in my live trading room, we're up 170%. We've had 4 losing trades this year. So, it's a good thing to learn from those who are doing it. I'm also, the talk is for people who have not traded much and want to learn, and folks who want to improve their trading results. So it's for beginners and intermediates of both types. Many people call me and say they're digging themselves into a hole and that they've lost all their money and now could I help them? I hear that a lot. Past performance is not a predictor of future results. You're going to see that all over the place. All investing involves risk of loss, and individual investments may vary. The examples provided herein may not be representative of typical results. So I'm going to go through these. This is the most important. Never risk more than you can afford to lose. Keep that in mind. If you're extended out on the edge and you don't have any room to lose money, you'll for sure lose money. I have my full disclosures and details on my website. You just click on disclosures and there it'll be. And this talk is for educational purposes only. I will be, and this is the full disclaimer, I will be putting this, a PDF of this talk, the slides, on my website so that you can see them under appearances. You can see them afterward. Okay. Many folks have started their trading and investing portfolios by picking stocks or using options. That's where a lot of people start. But not all of us know how to pick the right stocks. So I'm going to use some of my proprietary indicators for this talk and show you how I pick stocks. My proprietary indicator is called Sunny Bands, and I trade everything with it. I trade my futures portfolio, stocks, crypto, gold, everything. So I am a professional trader. I've been trading for over 45 years. I trade futures and stocks and crypto, but I don't trade options. Sorry, Jim. Because I'm going to tell you a little bit about myself, but first I'm going to show you how I trade. This is a trade. Let's see if I can get the pictures of us out of the way. This is this week, and this is the Dow since July of last year. And you can see we went up, 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 and then we had a good 9% down, and we're back up again. This is a daily chart of the Dow. This is a quip from a fellow named Aaron. He says, you can use Sunny Bands for options on QQQ. When it goes purple, I go. It's a sure bet. Price crosses above the lower outer band sometimes. I wait for a couple of bars within the lower outer band. I catch it on Friday on options expiration, sell puts, and it's a sure thing. I did it on Tesla too. So this is a guy who, I don't trade options, as I said, but Aaron likes to trade options and he uses Sunny Bands for it. When I show you what Sunny Bands is, you'll understand what he means when he says when it goes purple. Don said, nice bands. This morning I did a couple of quick MES buys and sells. Then I bought into an upward moving ES signaled by the DMA histogram, followed it to the top, Sunny Band, closed, sold short at the top, followed it to the bottom. All these are Sunny Bands. A $4,000 account, which is what I had moved into the futures account, returned about $2,000. Doesn't get any better than that. That's pretty good. Here's one more. I made $5,772 on the first day of my free trial of Sunny Bands. It told me exactly where the turns were, even with the high volatility today. You're one of the very few people that allows test drives. It's nothing short of amazing. So again, I'm a professional trader. I've been a professional trader since 1981, through the 41% crash of 1987, the 38% crash of 2000, the 52% crash of 2007 to 2008, as well as the 38% COVID crash. And whatever's next, there always will be a next one. I trade the S&P 500 futures contract on 5 and 15-minute charts. I have two charts. I'm going to show you my screen that I use, but I trade 5 and 15-minute charts, and I've been doing it for 45 years. I have long-term stock holdings, which is a week or more, and a little bit of cryptocurrencies. Today, I'm going to show you how I trade short and long-term charts using sunny bands and my dynamic moving averages. Systematically, I trade systematically. I don't guess. I don't have an opinion. I just follow what sunny bands are telling me to do. I was rated #1 trader twice with 365.5% profit, and the next year 178% profit using sunny bands and my DMA, dynamic moving average. And right there is it's all wrinkled, but there it is, right at the top. And if you speed read down this column, you'll see nobody else even comes close. I grew up dirt poor in Appalachia. Then I got 3 degrees in mathematics, and after I retired, I got an AA in photography. I've been programming for 56 years, 45 years trading. I was a systems programmer for Lockheed. And then I was a founder of a little company called ISCO, which became the world's leader in computer graphics software. And we did Harvard Graphics. And I retired when I was 30. I gave my money to money managers, and they lost $75,000 in 3 weeks. So I decided to take all the money back. I said, I can do that poorly on my own. I've been I love to read. So I've read 746 books so far on trading. I didn't enter a single trade the first year of watching the market. I just watched and learned the rhythm, drew my own charts by hand, because in 1981, they didn't have computer software for trading. And I published a monthly magazine for 8 years called Trader's Catalog and Resource Guide. I've written best-selling books, Trading 101, Trading 102, Electronic Day Trading 101, Getting Started in Trading, and TradeStation Made Easy. Oh, and Easy Language 9.x with Murray Ruggiero. Then I think it's a year and a half ago, I published a 2-volume book called The Definitive Guide to TradeStation's Easy Language and OOEL Programming with my friend Sam Tennis, who was the person who created Easy Language in the first place. Sam's no longer with us, but he was brilliant, I tell you. I've written articles for all the major magazines in this arena. There we go, and more. And here are the covers of my books, so you can recognize them. There's TradeStation Made Easy, using Easy Language 9.x. On a side note, I wrote a book with Linda Blair, the actress, called Going Vegan. And there's one of the 2-volume OOEL programming books, and there's the other one. Okay, this is probably the most important slide in the whole deck. How to make a six-figure income. Let's say $120,000 a year. That's 6 figures. So if you divide that by 12 months, you get $10,000 a month. So for your goal, $120,000 a year as a goal seems astronomical. It's like, how am I ever going to make that? But if you divide it by 12 months, you get $10,000 a month. Now that seems more possible. 10,000 divided by 20 trading days a month is $500 a day. That's a lot more possible. And that's just 5 trades at $100 each. That's pretty easy to do. So if you make $500 a day, 5 trades at $100 each, you're going to make a 6-figure income if you can keep that up. And there's usually between 1,000 and 3,500 per day potential in the S&P by going both long and short, just one contract. So you see, it's possible. Anybody can do it. You just have to have a good plan. And then you need to ask yourself, are you a trader or an investor? An investor buys and holds for the long term. A trader gets in and out, goes long and short, hoping to get short-term profit. Now, I'm both. I'm holding, what am I holding right now? I've got 25.90 profit in a few shares of Dell today. And I trade them in 2 different portfolios. I trade my stocks in one portfolio and my futures in a different one. So I'm going to break it down and show you how I trade. This next picture looks complex, but it's really not. Color coding keys me into action. This is my live trading room. Trade along with Sunny, TAWS. This is the screen we'll be watching. Okay, that's what it looks like. So I've got the yellow chart is always my 5-minute chart, no matter what screen I put it on. The green chart, the green background, is my 15-minute chart. 15 minutes are always green to me. Then I've got the Dow down here behind the yellow chart. And over here I have a 1-minute NASDAQ, and it's white, always white. Oops. This in the background with the black background is the matrix. It's where I make my trades. I just click and trade, and it's really easy. We get buy, sell, exit. It goes really fast, and it shows you exactly where you are. So I love trading with the matrix. You can see here, it's talking about color coding. You can see back here, the candles are green and magenta all the way over here, and then it turns blue and red. So blue and red are my daytime bars, and I make them blue instead of green because sunny bands are green. And I don't like the interference. I want to be able to see what the price is doing. So magenta and green is the overnight session. That's color keys. Color keys me into my decision making. Now, this golden purple line that goes through the center is the dynamic moving average, DMA. And from that stems the sunny bands, which are green and blue. This blue one is the inner band, and the green one is the outer band. So we've got an upper outer band, upper inner band, and then down here we have the lower inner band and the lower outer band. And I'll teach you my trading rules for how I trade that in just a minute. Now this colorful thing is my dynamic moving average histogram. The histogram is gold and above the 0 line when gold is on top in the DMA. So I can look real quick and see that gold's on top. When it turns red, that tells me that I'm losing momentum. It's getting ready to be a short trade. And then we have a little bit below the 0 line, and it comes back up again. Gold above, red is selling. Likewise, over here on the left, or kind of in the center of the chart, actually, we've got purple and green bars, and it's below the 0 line, telling me that purple is on top, so we're overall bearish. And when it turns green, it tells me that we're losing momentum in this short trade. I have 3 moving averages on the NASDAQ. I should have pulled that over a little bit so you can see this less than symbol and the greater than symbol. They tell me what the value or well, for instance here, this is the 200 moving average. So it says less than 200. And then the gold one is the 55 moving average, and it says greater than 55. So we know price is greater than the 55 moving average. The blue one is the 21 moving average. Now, most people use 20, 50, and 200, but I wanted them to be just a little bit different from what everybody's watching. Not enough to make a huge difference, but enough that I can sneak in when other people aren't looking. So those are the three moving averages that I use on the 1 minute NASDAQ. Dynamic moving average looks like this when it's pulled out by itself. So you can see the gold line and the purple line. The black line running through the middle is the average of the averages. So you can see exactly where the center of that is. And you can see it better out here when the bands are far apart. So you can see the midline, the gold line, and the purple line. And this is what it looks like on a chart. Now you can add sunny bands. So that's the same chart, gold and purple, far apart over here. And now we have price action in the middle of the sunny bands. And there's the dynamic moving average histogram again on the bottom. And I use both of these when I'm trading. I have both of these things on my charts. I like blue grids in the background because it looks like graph paper and it's sort of subtle. And the charts, the sunny bands stand out more. Let's talk about buy and hold versus trading. If you buy over here at the left, see where it says buy? You buy there and just hold, and you're still holding up through here. You have to go weather all of this drawdown, but that's buy and hold. So you buy at the left edge, hold it to the right edge. It's the same chart. And then this is trading. I just used a moving average crossover, and you can see here we trade. So that's what you do when you're a trader as opposed to an investor, which is the buy and hold. Now let's look at how much money you could make doing that. Not yet. This is yesterday's E-mini. And I couldn't very well do today's because it's not done yet. So you can see we have the magenta and green bars for the overnight session, blue and red for the current day session or yesterday's day session. And then again, when the close comes, they turn green and magenta. This is a little indicator called PHW, which stands for potential hourly wage. I wanted to know when I first started trading, how much money is to be made there? Would I be better off working at McDonald's for 16 bucks an hour or trading? So I got to know how much is my hourly wage when I'm trading. So potential hourly wage. Can you make more by trading than by working for an hourly wage is the question I ask myself. We've got a question in the chat. Do I hold positions overnight? Not on my futures trades. I don't hold overnight. But on my stock trades, yes, I definitely hold overnight. I hold for weeks to months. So we want to know with the potential hourly wage, can you make more by trading than by working for an hourly wage? And these dots are the ideal turning points. We're going to see them. So there's no way that you're going to get all the dots. You're not going to be able to trade that perfectly. So I take the ideal and then take 60% of that. And that's what I consider to be good. That's my goal. And see, the yellow dots appear at the perfect turning points. You can see these are the trades if you were going to just trade the yellow dots. Some people ask me, can I trade with that? Will that call out the trading signals? And I'm afraid, no, it doesn't. It doesn't. The yellow dots don't come in until after they've been made. So you see down here, we have a yellow dot. And now somewhere up here, we're going to get another yellow dot, but it doesn't show up until after the fact. But I do have it print out some values here. But buy and hold would be $9,245 on this chart. The ideal, and we have to multiply by $50 a point. No, this is the Dow, sorry. So the ideal is 116,000 and a half. The PHW is 60% of that, so it's 69,915. There were 31 trades on this chart, and the date span was 5/6/24 to 5/6/26, so 2 years. So in 2 years, you could make 69 grand if you traded these yellow dots. That to me is a good hourly wage. So buy and hold the Dow Jones. If you buy at the beginning of the chart and sell at the end, it's really just 2778 if you buy and hold. But if we trade, instead of buy and hold, trading the highs and lows with PHW, taking 60% of the ideal, so we're making 80,675. That's quite a difference. But how do you know when the yellow dots are going to appear? How do you know that in 1982 you should buy Apple at 44 cents, I think it was, and hold it for 44 years? How do you know that? Well, for me, I look at my Sunny Bands and the histogram and my PHW indicator, and those three things together tell me whether I should be buying or selling and how long I should hold for. That's how I know. Here again, long-term chart. This is Ethereum. Buy back here, sell over here. And as a buy and hold trader, we miss all of this through here. We don't, it's just noise. We just don't trade that. We just ignore it. So buy here and sell lower would be a buy and hold. So you lose $1,500 if you buy and hold, but you make $906,000 if you trade it. And that was on a daily chart. So imagine what you could do on an intraday chart. Here's Apple. This is this daily chart again. Got the PHW dots on it. Oh, also PHW puts, you see this 266.95 and 277.84. It puts the value of each of these dots, the price when the dot appeared. That way, if you want to figure out how to, what this move is right here, it's 277 minus 266. So you can calculate individual trades off of it. This works on any symbol and on any time frame. This is Microsoft with yellow dots again. And I forgot to pull this thing over. In order to see it, you have to grab it and put it over here. But you can tell that if you buy and hold over here on the left, if you buy right here and you sell right down here, you're losing money. But there are good trades in there. If you want to buy and sell and buy and sell, you can make a lot of good trades going short on Microsoft. This is YKK26. It's a futures contract. This is soybeans. And you can tell that you can trade soybeans with Sunny Bands. It doesn't matter what you're trading. Everything moves up and down. And as long as it's moving up and down, we can get some trades out of it. Here's Apple on a 15-minute chart. And we can see we've got a buy over here, and a sell up here, short here, long here, short here, long here. This one, PHW is $35.71 a share. So 100 shares is $3,500. There were ideally 10 trades on this chart. And this is from 4/23/26 to current. So it's only a few days, and there's $5,900 in there. The lowest time frame that Sunny Bands works on, I've tried it on tick charts. I haven't gone any lower than that. It also works on Rinko charts, and TradeStation has it up to monthly charts. So I've tried everything from ticks up to monthly, and it works just fine. Any time frame, any symbol. And here we have Apple on a weekly chart. That was a 15-minute, and now you can see what a weekly chart looks. We've still got plenty of room to buy and sell, buy and sell. Ideally, we would make 1,115 per share. $669 is what we're probably going to get because that's the PHW. 27 trades, and it goes from 2016 to 2026. So that's 10 years worth of trades. And see it, if you don't know what this is, if this apple were off of here, and if you didn't know what time frame it was, you wouldn't be able to tell because they all go up, they all go down, and they all go sideways. So in the same amount of time, 47 cents in Apple in 1981, current price of 287. So an investor made 399%. That's pretty good. Since 1981, that's 45 years. The trader, however, made 635% profit. And the day trader made 1,296% profit. So that's why I'm both a trader and investor. I'm a trader on short-term charts, and I'm an investor on stocks. So I trade the S&P 500. Anybody wants me to teach you how to do that, give me a call. I'm happy to do that. Oh, and you see right here on every slide, I've got my phone number. I talked to a guy this morning who said, oh, that's intimidating. I don't want to call and bother you. Well, if I minded being bothered, I wouldn't put my phone number on every slide and on the top of my website. And it's my cell phone. It's not an answering service. It's my cell phone, and you just call me and we'll talk. So is this possible? Well, yes and no. You can't catch all the moves. That will never happen. And according to my research, you can only capture about 60% of the move. That's what I use for PHW. But an investor must sit through long periods of scary negative markets. And believe me, they can get scary. There's a system that I teach. When I teach classes, there's a system I start out with. It's 100% correct. What it does is it buys at the left-hand edge and it trades every time there's a move, but it holds on through all the down periods. This is something I learned from Larry Williams. So anybody that wants that, give me a call or send me a text to my cell phone and I'll send you the perfect system. But it's for TradeStation. So if you have TradeStation, I'll be happy to send you the code for that. So the investor has to sit through long periods of scary negative markets while the trader gets to go back and forth. You can go short as a trader. Let's look at the Dow Jones again. It's something we're all familiar with, and it's reported daily on the news. And we all relate to the numbers. That's why I use the Dow for examples like this, because you know when it says the Dow's down 300 points today, you know what that means. You have a feel for it. Today well, funny, I should say that it's down 343 right now. When the report is that the Dow's down 343 points, we all know what that means. In the last few weeks, it's been doing really well. It's recovered 11% from its lows of 1, 2, 3, 4, 5, 6, 7, about 10 days ago. It's gained 1,100 points. And now the Dow's only down 1% from its high. I think it's going to go higher. On a weekly basis, here's the same idea. Sunny bands, charts, red and blue lines, red and blue candles. And you would never know that this was a weekly chart if I didn't tell you. So ideally on the weekly chart, we make 169 grand, 101 on PHW, 27 trades, and it goes from 5/6/2016 to current. There's a question, does it work for TradingView and MT5? No. Sunny Bands is complex, and TradingView and MT5 don't have a complex enough programming system in them. So I'm sorry, I have these for NinjaTrader, Metastock, Multi-Charts, and TradeStation. They all have robust programming languages. My preference is TradeStation. I've been using TradeStation since 1986, which is when it first came out. I bought it and I've held on to it ever since. This is the Dow Jones on a daily chart. You can see we get ideally 116,000, PHW 69.9, so almost 70,000, 31 trades from 2024 to 2026. Oh, and see the buy and hold BH? You can, yeah, as I told you earlier, I do color coding so I can tell things at a glance. It's green, telling me that it's positive. If it were red, it would be negative. And you can see the values of each yellow dot printed on the right near the dot. So that's what the daily Dow looks like. Look here how it got short up here and just went down, down, down all the way to the bottom of that move. Here it is on a 5-minute chart. So you can see it works on any time frame, any symbol. Now in just 6 days, it made 26.93. 26.93 is the PHW. So $2,600 in 6 days is pretty good. The symbol YM stands for the Dow futures contract, so you can see what the futures contract looks like. This is a daily chart of the YM, which is Dow futures chart. Let's look. So let's look at the standard moving averages for a minute. They're quoted in Barron's Investors Business Daily and the Wall Street Journal and on the news, on the television. They usually use a 20-day, a 50-day, and a 200-day moving average. And then I'm going to get to my bullish bearish after that. So here are the 3 averages put on a chart. Now this is something that I programmed. So the blue line you can see is the 21 moving average, and it's the same color as the line itself. Gold line's 55 moving average, and the dark red one is 200. It says greater than, so I know price is above that average. Greater than 55, it's above that average. And greater than 21, so price is above that average as well. This is available on my website. All you have to do is buy it, and it's yours, and it's cheap. I use 21 rather than 50, 20, 55 rather than 50, and I do use the 200 because it puts me just a tiny little bit different from everybody else that's trading the averages they see on the news. I'm going to show you some simple moving averages, not at 9 and 18, which is what the standard input is for a simple moving average formula. Fast average of 9, slow average of 18. So you can see here I've got arrows where the crossovers are. Standard way to trade moving averages is to go short when the blue crosses over the gold and to go long when the blue crosses above the gold. So we've got short, long, short, long. Oh, there's supposed to be a short arrow right here and then long. So there are the arrows. And this is the Dow futures contract on a daily basis. You can see these are, and it's a 9 and 18. It tells us that price is above those two. And that's what a standard moving average trading system would look like. And this is the DMA and its trades. You can see there are far fewer trades with my dynamic moving average. Sell, buy. And that's if all you were doing was trading the DMA. Now, I don't recommend trading the DMA, although when I made the 365% that year that I was on the pink paper as number 1, I was just using the dynamic moving average because by that time I had not yet created sunny bands. So I was just using the crossovers of the DMA itself. So it's good. It's just not as good as the sunny bands rules. So we're going to look at sunny bands and the DMA. Now, the cool thing about sunny bands is that the DMA calculates its own inputs dynamically with every tick of the market. Every tick of the market, it changes the inputs from 9 and 18, maybe 10 and 30, 10 and 13, 10 and 20, 10 and 15, 9, and it just goes back and forth, changing the lengths dynamically. Sunny bands are ATRs, average true ranges, from the DMA. So sunny bands recalculates with every tick of the market. Now you can see sunny band. Here's the DMA, the gold and purple. You can see where the buy and sell signals are. And these are sunny bands. Now, with sunny bands, I would get these trades even faster. Let's go over here. I'd go long right down here. 1, 2, short right here. Long down here. 1, 2, short there. Stops at the DMA and have to go long again and short again. So every time we get to the outer band, and sometimes when we don't quite get to the outer band, we change positions. And you hear me going 1, 2, that's because I look for the second corresponding bar to confirm. Is sunny bands like Bollinger Bands? In a word, no. It's definitely not. Bollinger Bands is calculated from a simple moving average, whereas I'm using a dynamic moving average. And he's got standard deviation bands on his simple moving average. Simple moving averages have horrible whipsaw to them. So I don't know. Whipsaw is what I figured out in the early days of my trading, was the one thing that caused me to lose money, because I could get trends over and over. I could call the trend, but then the whipsaw would kill me and take all my profit away. So I'm going to show you Bollinger Bands. Oh, we've got a bad background on that slide. And Bollinger Bands didn't show up. Well, I'll put it in there before I put the PDF on my website, so you can look at it. So the first thing I put on charts are attractors. I coined this term to describe all kinds of support and resistance, including moving averages, where price tends to refer to the mean. Next thing I put on a chart is my sunny bands. An attractor is, to me, I call it an attractor if I put a horizontal line across the preponderance of price activity. So there's lots and lots of reversals and it hits the line over and over. That's an attractor. And then I put sunny bands, which is based on the dynamic moving average, the gold and purple lines. And then I put the DMA histogram. And these are the rules. This is on my website. Anybody that wants to go there and get this is called Sunny Bands Rules. And these are the rules I use in my own trading. And they're for educational purposes only. I do not give advice. Level 1, there are 3 levels of rules. Level 1 is when I've had red candles coming down like this and hit the bottom band, we get a blue candle, that's a setup, and another blue candle, that's a signal. And then I go long. And then right through here, you can see that the DMA is flat. That tells me to do nothing, so we wait. And it continues on its way. So I enter long on when red candles have been moving downward and touch the lower outer band, and then turn blue and move back inside the lower outer band if price confirms. And by that, I mean that the second candle confirms the first candle. So we've got a blue one going up and another blue one going up. I enter short when blue candles have been going up and touch the upper outer band and turn red and move back inside the upper outer band. And then I go short. That's level 1 rules. Level 2 rules, if the DMA is flat, or I say here the midline is flat, that is, visually you can look at this and see that it's flat. It's not moving up or down. And then I don't, quote, expect price to move very far beyond the midline. So here you can see it hits it, bounces off, hits it again, bounces off. Chances are it'll hit it another time and then choose a direction either up or down. It often acts as a barrier to further movement. So you can see how this is a barrier. Can't get above it, can't get above it. And level 3 rules say if you've got a good trend, stay with it. So if gold is on top, and you see purple's on top over here, if gold is on top and we're moving up and we're staying above that gold line, I wait until the gold line is penetrated before I get out of that trade. See how this movement right here ends the trade. So here's how I choose stocks. I don't short stocks. I buy and hold and then sell. I wait for the sell signal to take profits. This chart tells me which are above the 21, 50, and 200 moving averages and whether my DMA is bullish or bearish and what the potential profit is. So this is on radar screen on TradeStation. And you can see I've sorted it by the PHW. So the highest ME, is that LI stock, is the highest PHW. So there's the most trading profit in here. The buy and hold is 1,066, but the PHW trading profit's 34,000. So these are all PHW stocks or values on the stocks. And I've sorted them again by highest to lowest. And this shows me the DMA for radar screen. You can see here, this is gold with 2 lines up that says that this stock is bullish and moving up. The next stock down has an up and then a down. So it's green bearish, which means green means that purple's on top and it's moving down. Here we have one that's purple with 2 lines down. So that one's solidly bearish. So you learn to read these colors when you have this radar screen version, and it tells you at a glance which way we're moving. Here's a bullish one, two moving up. Another bullish one, 2 lines moving up. Another bullish one, 2 lines moving up. And that's Tesla. So this is a nice radar screen to give you a quick overview of everything. So I look at the 3 moving averages first. I'm looking for stocks that are above all 3 moving averages. And I'm screening for high performers. So when we find stocks showing all green cells, these are still bullish. And I don't think I have the scanner results in here. I don't. I'll have to put that in before I put the PDF. Here's my current projection for what's going to happen in the market. Here's the low back. When was that? 2020. So we had a low right there. And I think that we're going to move slowly up, up, up. And this Fibonacci projection right here is at 58,000. So I think we're going to hit 58,000. I think we're going to come up here, hit this line, go back down and hit the line and go back down and hit the line again. So that's my long-term projection. I do think that's going to take about a year to get up there, but I do think it will get up there. So we'll come back to this. We'll come back to this projection in a year and take a look and see if it made it. So I think we're going to go on up to 58,000. It's going to stumble back and forth along the way, and it's going to take about a year to get there. And that's all there is to it. I had a new client say to me yesterday, that's it? That's all the rules? You can trade this. And so she's already making money watching sunny bands. So I look at the attractors, I study the histogram and the sunny bands, and that's it. 3 rules, level 1, 2, and 3. And I trade the E-mini on, this says 1 minute and 5 minute. I trade 5 minute and 15 minute now. And I trade 3 to 5 times a day. With equities, I buy and hold for weeks to months to years. Well, I have a YouTube channel. If you want to get some help, we've got a real client learning to use sunny bands. Here's a 99-second overview of the live trading room. Here's the definitive guide to TradeStation's easy language and OEL programming. And here's a live demo. If you want to see how I trade sunny bands, you can watch. This isn't very long. It's just maybe half an hour, 20 minutes. Here's Learning TradeStation, number 1. And so I've got quite a few videos here on YouTube. And I always say education is not expensive. Lack of education is. Here's my new website. This is the home screen right here, and then you can scroll down and see everything else. TimingResearch.com. The products that I was just talking about were all programmed by me and developed for use in my own trading. I didn't develop these things to sell to you. I sell to you as, well, because I like to see other people succeed. And I'm using them so well in my own trading, I'd like for you to be able to succeed as well. Question is, does it work on Forex? Yep, sure does. Works on any symbol, any time frame. So Forex symbols are just fine. And I'll show you exactly how I use them. When you buy my products, I spend 2 Zoom sessions with you showing you exactly how I use them so you can get used to it and get off to a running start. And I don't hold anything back. A lot of people will tell you sort of how they trade. They'll give you the basic rules, but then they'll keep all the secrets to themselves. I don't do that. I don't hold anything back. I train you to use them for free, and I'm always available by phone or email. As I said, phone number is, it's not on that one, 760. Let me put it in here. 760-908-3070. That's in California. I live in San Diego, so I'm on the West Coast time zone. And my website is moneymentor.com. So, and don't be afraid to call me, please. I don't get very many phone calls. People just don't really bother me. Oh, I do have bundle discounts available as well. If you want to buy 3 or 4 things, you get one discount. If you want to buy 5 or 6 things, you get a bigger discount. So I've got up to 40% off available, depending on how many of the indicators you purchased and which ones they are. On Money Mentor, I have a 4-day strategy trading forum. You can download that and look at it. So strategy trading, 4 days of learning. I think these are all I think Sam and I did these together. So this is Sam Tennis, along with me, giving these slide presentation. A 4-day technical analysis forum, where we go over all the basics of technical analysis. And then we did a 5-day easy language forum. I have that available for $79.95 for download. And all are available on moneymentor.com. I offer education and consulting, easy language programming services. If you need something programmed in easy language and you don't know how to do it, I can either teach you how to do it or I can do it for you. I do offer mentoring services. And I have a complete bookstore. You just browse and click under books. And I do a distance learning course if you want to learn by correspondence. And of course, the indicators I use myself in my own trading. Daily live trading room. Oh, I didn't tell you about this yet. At 7:30 Pacific time every morning, I trade live in front of an audience. So you can see how I trade. You can see whether I'm making money or not. And if you want to get ideas from it to how you place your own trades, you're free to do that. It's called Trade Along with Sunny, TAWS, 7:30 to 8:30 every morning. And I do have a free Substack that I publish where I give an analysis of today's market and what I think is coming for tomorrow. Bundle offers give up to 30% off. Actually, they give up to 40% off if you want to go get a whole lot of stuff at once. A number of people do that. I've got one guy who started out at $50,000. He bought everything, every indicator I have, and now he's up to $4.5 million. If you want a free 7-day trial, let me know. Email me or call me, and I'll give you a 7-day trial. Again, it's for TradeStation, Multi-Charts, MetaStock, or NinjaTrader. Free 7-day trial. Or you could text Sunny Bands to me, and we'll start the free trial. Or text free trial to me, anything you want to. Just let me know what you want. So the slides are going to be posted on Money Mentor. If you sign up for free membership, the moneymentor.com/membership, then you get lots of free stuff. These are going to be on the membership page. Just go to moneymentor.com and click on membership to sign up. All right. Do we have any more questions? Let's take time to ask and see if we can get any questions answered. I'm going to give you just a few minutes to come up with a question. No such thing as a stupid question. All questions are good questions. Come on, somebody's got another question. Guess not. All right, so then we'll finish up. Thank you, David, for hosting the event. I always enjoy talking with you. And thank you for your attendance to the audience. I appreciate you joining me. I'd love to visit, so please give me a call. There's the number again and the website. And here's my information. Right on time, David. Thank you.
All right. Thanks, Sonny.
Thank you.
Great presentation as always. So, thank you for
Thank
being
you
here.
very much.
All right. Yeah, check out Sonny's site there. And all right, we have 2 more live presentations to go for this event. This last day of the Active Traders Playbook event, and AJ Brown is here. AJ, can you hear me?
Totally can hear you.
Okay, awesome.
How do you
are
like this beard, buddy?
Wow, that's really coming in.
Yeah, thank you.
Did that
I'm
just
just
grow out of your face, AJ?
Oh, I know, right? I've been growing this and it doesn't make sense, does it, Sonny? Because it's summertime. I should be this should be a winter beard, but I've never had one this big. It's so soft and my daughter just loves rubbing her face in it.
How funny. Well, you look
Oh,
good in it, AJ.
thank you. What a great presentation. I caught the end of it. That was very good.
Thank you very much.
All right, I just
All right.
put my cell phone on do not disturb so nobody messes with me while I'm talking to you guys.
Okay, great. All right, Sonny, I'm going to turn your screen share off, and AJ, you should be able to share your screen now.
Okay,
Thank you,
here we
David.
go.
Thanks, Sonny.
All right.
All right, while AJ is getting set up, I got a couple links for you here. If you haven't seen this yet, Jeff Tompkins is doing a 0DTE presentation tonight at 7 p.m. Eastern Time, so it'll be after this event is over. And he has a PDF to go along with that. So hit that link I just put in there. Check that out. And if you haven't seen this yet, you can add all timing research events to your Google Calendar now and get updates that way. So hit that link. Okay, AJ, I see your presentation now.
Yeah.
So,
Excellent. Let me do this too really quick. Ah, yes, yes. Excellent. Guys, are you ready or do you need to hit the record button or anything like that, or can I just get to it?
yeah, hold on just a second here. I'm just
Okay.
double checking everything. Make sure we're good. Okay, so I'm going to start recording again in just a second, and then you can start your presentation. And sorry, hold on one more second. Okay, I am recording again now.
Hey, everybody. This is AJ Brown with Trading Trainer. And when David asked me to be part of this event, he was talking a lot about mindset and strategies. And so I want to talk to you. I don't have as much to like pitch about myself, but of course, at the end, I'll tell you a little bit of how you could work with me further if you want to. But what I wanted to spend today on is talking about a trade that I like to put on in the background of doing kind of my options premium selling, doing any sort of my directional plays. If we just are buttoning up with earnings season, so I've been doing a lot of earnings plays, but this particular trade helps me deal with a lot of the volatility, right? Because the market right now is really being driven. A lot of times our patterns, especially if you're a technical trader, your patterns are based on the idea that investors are, you know, paying homage to tested levels of support and resistance, right? That's really what it comes down to, trading those reversals, maybe using leading, lagging indicators, all that good stuff, applying the right option strategy once you've got the pattern figured out. But truth be told, and I call them the puppet masters, the powers that be are changing the rules of the game, whether it's discussion of tariffs or discussion of trade wars or discussion of skirmishes in the Middle East. When those things are changing, people maybe don't pay attention to lines of support and resistance. Our technical indicators start giving us false positives, and they start paying attention to what the talking heads say on TV and what, social media post came out, usually on a Sunday evening when we've all had a beautiful weekend is when something surprising comes out. So I wanted to kind of address that because I put this trade that I'll be talking about today on in the background of my portfolio, and I have it on there pretty much every time I get a chance, and it looks like that time is rolling out in the next week or two. So let's talk about it. I got a little presentation, but a lot of this is going to be on my charting software. So just hang tight, buckle your seatbelt, and we'll get right to it. I call this presentation How to Turn Market Fear into Predictable Income. And I'm going to be talking about what I call my dual vertical VIX play. So let's kind of do a speaking of mindset. I've been doing this. I've known David since Hammer was a hatchet. I've been doing this since 2003, teaching other traders how to, profit using options. And so I went through, when I knew this was going to be a presentation on mindset, I kind of went through some of the things that I've heard folks say when they're out there. Some of the things, I don't actually have a real strategy. I keep Frankensteining ideas from presenters and hoping they add up to an edge. I'm chasing alerts and guru calls because I don't trust myself to read a chart. I keep breaking my own rules, or I never really had rules to begin with. I size too big when I'm desperate to make back losses, and I size too small when I need to commit. I don't know how to pick candidates. I'm basically guessing. See, these are things that, when I work with folks, this is what I want to guide them to work past, right? Every time I try something new, it fails and I don't stick with anything long enough to master it. But the truth is when you learn something, it's not like a switch. It's not like when people come to me, I have a red and a blue pill and I can just mail it to them, snail mail. And if they take it, they're automatically a successful trader, right? Or that some folks have come to me and they're like, now, if I do your $10,000 one-on-one coaching package or even your $25,000 one, you must have a switch with my name on it, an electrical switch in your office that you can switch, and I'll just become a super duper investor. And what it does, it's an iterative process. I teach you the way that I look at the markets, the trades, how to read patterns, and then how to pick the right option strategies to profit best from those patterns, right? I show you the framework. I give you the framework, but then you have to practice it until it becomes second nature. Kind of like I have a 4-year-old. If you can believe it, I'm 53 years old and I have a 4-year-old. What am I thinking? Well, the good thing is when she is old enough, I changed her diapers. She'll be old enough to change my diapers. It's kind of like an insurance policy. But the scoop is I watch her learning how to do things like tie her shoes with actual bow ties instead of Velcro. And at first, it's like, it's like wow, you got to be very conscious and present and figure it all out. But before you know it, and you guys probably know this too, you'd probably tie your shoes and you don't think anything of it. And if I asked you about it an hour later, you wouldn't even remember you did it because you do it on cruise control because you've practiced it successfully so many times that now you can do it. Well, that's the same thing with a lot of these experience builders with seeing patterns and trading them profitably, right? But I keep getting these other things. I don't know how to plan a trade. I'm entering without knowing my exits. I don't understand risk. I think I'm managing, but I'm probably not. I mean, I could go on and on. I jumped from one program to the next trying to fix mistakes I don't understand. Does any of this resonate with you? Because again, having some guided discovery in this area is how you get past this. It's not going back to your old habits. It's learning something new and then putting it into practice. Practice it with paper trading so it's risk-free until it becomes second nature. I had somebody say, I'm always afraid I'll give back my gains because I don't know how to manage winners. Whoa. And sometimes they actually get personal, like I'm terrified I'm going to blow up my portfolio again, or maybe I'm just not smart enough to learn this. When I hear this, my heart breaks, right? What if I'm not meant to be a trader at all? What if I'm the kind of person who always sabotage? I mean, sometimes people get really introspective. What if I'm a dreamer pretending to be a doer? What if I'm the only one here who still doesn't understand the basics, right? So again, this is the mindset that, you can have these little voices come in and talk to you, or you can just, start to pick up a framework that somebody else has had success with, model it, in a safe environment, do some paper trading, get it until it's not where you're like, doing that. I remember back to the first time I learned how to drive a car, right? And you have this list that they gave you at driver's ed, make sure the fuel is on, make sure the ignition's on, the car's in neutral, you turn on the engine, you adjust the choke. I might be dating myself because I don't think cars have chokes anymore. But what I'm saying is now, I mean, I'll go drive 20 miles I'm outside of Washington, D.C. I'll go drive to the center of D.C. and drive back. You can ask me what my drive was like, and I won't remember unless something like there was an accident or something. I won't remember because I do it in the back of my head. That's where all of a sudden the success comes in, is when you practice. Not just practice makes perfect, but practicing the right framework. Perfect practice makes perfect. Practicing something that doesn't work for you creates a bad habit, and that's even harder to break than practicing it right in the first time. So this is how we can kind of tweak our mindset. Oh, I got pages of these. When I heard this was about mindset. Okay, so this is the truth, right? Especially right now, there's a lot of uncertainty in the markets, and there's a lot of uncertainty in the world, right? But if you play it right, if you pay attention to the patterns that are repeatable, right? Even you'd be surprised, even in this like time of like changing rules, will we be seeing the debt quantitative easing? Will they be tightening? All of this good stuff that keeps changing the rules of the game. If you can pick up on the repeatable pattern, then you can play it right, if not for months, for years to come, right? Because you got to remember, in the markets, money's not created or destroyed. Despite, Kramer going on there and saying trillions of dollars evaporated today in the markets, markets are where money moves from one hand to the other. So the key is to always put yourself on the right side of that equation. So with that said, I got to give you a little disclaimer. Now, you can get all the legalese stuff on my website at TimingResearch.com. I've got all sorts of disclosures and stuff. But the scoop is I'm going to be talking to you about stuff. And I've been watching the markets literally for 35 years. I've been following them religiously and trading them for 35 years. So if you're just starting out, or you're getting into options or the type of trading that I do, you're just not going to be as good at me, right? Even some of my long-term time program participants that are still with me following what I do from 2004, 2005, you're not going to do as good at them, and you just get resolved at that, right? because I'm kind of the goat at this, right? At being a disciplined options trader. And I got that nickname from my peers. I think behind my back they don't call me disciplined. I think they call me lazy because I'm an end of day trader, right? I got stuff to do during the day. Whether it's following my own hobbies or playing with my 4-year-old or whatever it is. So I like to come in after she's asleep, which is usually 9:30 in the evening, and I like to do my analysis and prepare my trading bots for the next day. And then I'm not going to see them until the subsequent day where I see whether or not trades got made or not, right? So I think they call me the most laziest options trader. I like to think of myself as efficiency. I like to, in as little time and with as little white knuckling, like I hate going to bed wondering if I just made a bad move. So I like to set up these type of positions with defined risk, defined reward, and be set through the night, sleep nice, have a fun day, and then do my trading in as minimum time, minimum effort as possible. I've been eating, drinking, and breathing this stuff since 1997, teaching it since 2003. So, okay, let's talk about the VIX, right? What is this VIX thing, right? I can show you. I've got it right here up on my Thinkorswim trading platform. Let's see, there it is. There's the VIX right there. And there's some definite lines on this VIX. So if I show you a chart and I go back to 1986, right? And I draw from January 1st, 1986. That's the first day here. And I go all the way to the present with what we call a linear regression line. That's just a statistical nerd term for a mathematically calculated best fit trend line. You'll notice that dotted line is very much horizontal. And that's because the VIX is a measurement of, how can I make this as simple as possible? Fear versus confidence, right? The VIX is actually reverse engineered, right? You take all the options out there and you derive out of the option price how many days till expiration, and you derive out what the effect is of the underlying stock on that option. And what you're left with is basically the buying and selling pressure, right? So you got to remember, what are these options classically used for by, the masses of big money traders out there? They use them as hedges. So if there's buying pressure, if they want to buy a whole bunch of options in the short term, it means that they think that there's a risky event and they want to hedge their position, right? Because big traders, a lot of times these fund traders, they're like oil tankers, and that's just perfect timing, right, with what's going on in the Strait of Hormuz. They're slow movers. If First of all, if they were even able to, a lot of these are brokerage firms, and they have to have a certain number of stock shares, so they can't even liquidate if they wanted to. But these people have to move very slowly with the buying and sell. So what they do instead, when they see something in the future that might cause their stock price to get unruly and go against them, they'll hedge it with options, and that causes a demand on the options. That causes the option price to go up. And so when you filter out all of the known variables from the option price, you get left with this idea of, the buying pressure is high, people are afraid, or the buying pressure is very low, there's more supply than demand, and now they're very confident. So if you take a look here, the fear and confidence wind up kind of leveling themselves out over time. Again, this is from 1986, so we're talking about 40-something years. This levels itself out over time and it goes sideways, right? That's kind of the benefit. But now you'll also see, I'm going to bring us, you can, it's neat. If you look at this closely, you can see what happened in the 1987. Some of you might remember that, when, the tax code changed drastically and everybody lost their shelters, and Black Friday, that was huge, right? 1987. Then this is the S&L crisis in the early 90s. Here's the whole dot-com boom and bust right here. Here's the 2008 financial crisis. Here's COVID right here. Here's kind of the tariff and the trading stuff going on as we bring ourselves. So I'm going to bring it back now from an overall chart. Let me bring you back to a 6-month chart. Let's talk about it in the more recent. So the scoop is roughly at about, so this best fit trend line is currently ending at about $19, $18.90, around there. At $26, we have this threshold where the fear goes from being unfounded to founded, right? So option traders often think in the terms of insurance, right? If you think about insurance, you think about your car insurance, your health insurance, those companies make so much money. Why? Because they like to sell you something that you'll never use, right? That's their whole profit model. Car insurance people sell you, and they don't want you to get into an accident. Health insurance people sell you health insurance. It's for peace of mind, right? It's for that unfounded fear. When you start to get above $26 in the VIX, we have historically found that there's something out there that, you're buying homeowners insurance because you've had, there's hurricanes and there's a hurricane off the shore coming towards your house, right? That's a founded fear, right? If we go back, let's look at the last 2 years, right? Over here, we've got, tariff, the announcement of 1 million tariffs on all of our trading partners, right? That caused a lot of fear, right? You can look at all of these different events. I'm trying to remember what was happening at the end of the Biden administration where we had this spike around the July, August. But suffice it to say, you can trace these fearful events. And it also, this is where the statistician and such, engineer, science-minded math people, the people that we associate who would think they would be better at trading, this is where they actually lose out to those people who are more into like psychology and sociology. What's really neat about looking at this picture is when we start to get to the confidence side, the lower side, it's human nature that we don't get that confident, right? We're always on alert for something. It's built into our DNA from back when we had to, sit behind the rock waiting for the woolly mammoth to come by, and then we had to run and be full of adrenaline and knock that woolly mammoth out. So we never get too confident. You don't see spikes in confidence like you see the spikes in fear, right? We're wired to go off the hook when things get, seem. I'm going to say seem because perception is everything. When things seem to go off the hook, we like to buy insurance and we like to protect ourselves, but we're very leery of letting go of that. So you'll notice as I look back over the last 2 years, we only get so confident, and that's after usually a lot of time of calm has gone by, and our confidence I've only seen the confidence scale on the VIX go down like into single digits. Like I'm thinking maybe twice or three times since I've been watching the market since the mid 90s, right? We don't get that confident. But when something happens and the proverbial poop hits the fan, I mean, we go off the rails with our fear. So that, when I show these charts of the VIX to psychologists, they're like, yeah, that's everything we learn. Like if I, again, go back and show you from the beginning of time, again, we don't ever see the VIX really get well below that $12 mark. And when it does, it kind of just, ruminates down there. But man, when it goes above 26, it spikes. I mean, it spikes up to 160. On the 2008 financial crisis, it spiked to 90. You get what I'm saying here, right? So that's kind of a neat kind of correlation with how humans are wired. So, okay, that's the pattern. The pattern is we never get that confident, but we do go off the rails when there's something that we perceive as fearful. Okay, so let's keep going with the presentation now that I've kind of built my explanation of what's going on with the VIX. Hold on one second. There we go. Let's just cover this. VIX measures implied volatility. It represents the market expectation of volatility over the next 30 days. Fear index because it rises when the market's anxiety grows. Low VIX levels signal confidence and complacency. High levels signal fear and uncertainty. Okay. All right. Let's talk about fear versus confidence. Markets are driven by human emotion. Fear moves faster than confidence. Fearful markets cause investors to seek protection, driving up option prices, which therefore drives up the VIX. Confidence builds slowly, so the VIX rarely drops as sharply as it spikes. This asymmetry creates this opportunity that I think we can trade reliably. In fact, I've been trading this for like the last 10 years. Volatility tends to rise faster than it falls. Okay, let me get past this. Let me ask you guys in the chat. Do you guys want me to tell you a little bit about my background? I guess the better question is, how many of you guys, just with a little message in the chat, do you guys even know who I am? Trading Trainers AJ Brown. I'll just do a couple of quick slides on this, just so you know. I founded a company called Trading Trainer. We already talked about being labeled the world's most disciplined option trader. Been doing this since 1997. Started Trading Trainer in 2002 with a newsletter. That newsletter went viral. I created an ebook and a home study course that you find on the shelves of many successful option traders. I've been, and I'm like, oh my God, that looks familiar. But when it all started out, I want you to know that I was a learner just like most of you. I studied engineering, mechanical engineering, and electrical engineering. I have degrees in both and a master's in something called automatic control. Supposedly, I know how full self-driving and automatic, uh, uh, fly-by-wire, uh, um, flight controls, that fly planes automatically. Supposedly, I know how that stuff works. I also have a strong background in commercial business investing from working for HP for years. And in the last 15 years, I've really focused on learning how to be the best teacher I can be, especially for adults. Adults learn differently than school kids do. So I've learned this thing called accelerated learning methods, which I try to teach so that people don't have to go through the trial and error process that I went through from 1997 to about 2001, losing a whole bunch in the process of learning. Right? In fact, here it is. I lost big. In 1997, I spent $27,000. That's a lot compared to today's dollars on seminars. It's a good thing I was single and living with a bunch of guys in Silicon Valley working my high-paying job at Hewlett Packard because I had money to, if it was now with all my responsibilities with mortgages and with, little ones running around, I wouldn't be able to do that. I spent $27,000 on seminars that first year, but even worse, in making stupid trades, trying to follow those folks. And maybe you guys can resonate with this. Trying to follow their advice, I wound up giving 80. That was more than all three of my degrees from universities put together. But for me, it was another degree. And in addition, I learned, at least back in the time, who was legit and who was actually not the best teacher. They were actually in the business of selling teaching and not actually being a trader. So, yeah, I lost a lot of money. That was just the first year. So here after all the years of unsuccess and then becoming super successful, here's what I distilled it down, and you might want to take some notes here. Number one, stop chasing shiny objects, right? In other words, settle on a type of investing and learn it well. And yes, there's some things that will resonate with you, but there's also some things that fit your lifestyle, right? I played around with day trading or trading things like Forex, which were in the middle of the night, and that didn't jive with my lifestyle, especially when I had a full-time job. So I really resonated towards being an end of day trader, right? And also I resonated towards options because I like the idea of being able not to just profit when something moves up in price or down in price, but options have 27 different strategies where you can profit on pretty much anything from like time passing by to uncertainty to, so options give you a big tool chest. Yes, you have to learn how each tool works, but that, little bit of added complexity gives me unlimited flexibility. If I can identify the pattern, I can almost assuredly find a way to trade that particular pattern. So that's what resonated with me. Find what resonates not only with you, but also what fits your lifestyle, and not your dream lifestyle, but your lifestyle right now. and then just learn it, because there's going to be people like me and all the folks that you've heard who will want you to learn from them. But if they're not teaching what's, on point for you, it's not worth your time. It's easy to get, caught up in our messages, but focus on what you need and then just master it, right? That's number one. Number two, hire a mentor who is currently doing what you want to be doing, right? Not just somebody who has done it in the past or somebody who knows about it but's not doing it. And also find out somebody who knows how to teach. It's called learning by guided discovery. Versus learning from trial and error, right? Trial and error is great. I mean, it gives you lessons, but it's usually quite expensive and time consuming. The scoop is, right? The scoop is I hired somebody in 2004 to teach me a different option trading strategy. And I saw their bank statements. I saw all of it. I knew how successful they were, but for some reason they couldn't teach and I couldn't learn from them. And so if you go with somebody who's doing it, but they can't convey their information to you, then it's a wash. So make sure you do your culling process, find a mentor who's good at teaching, right? Third, I want you to join an investment group. This is what I did. This is what put me over the top, is working with somebody. In HP, when, like, for instance, Epson would make a printer that was like the bomb, right? We would buy that printer, we would take it all apart, figure out how it made it work, and we would improve like one thing and then build a new printer, and then we would sell that new printer, right? So it's called leveraging with pride. They're already trying to teach my 4-year-old not to cheat in school and not to look over each other's shoulders. But in real life, that's how we improve and get better, is we leverage with pride, right? So I actually have to then say to my daughter, actually, if you can look over the shoulder of somebody, find out the answer, and then figure out how to do it even better, that makes you, superstars. So don't worry about what they're telling you. So I know that's kind of a weird thought, but leveraging with pride. So being in an investment group, you can actually be like, oh, hey, John's got this great trade on ticker RIOT, right? The crypto company. Maybe I should figure out what he's doing and do it too, right? If you're in your own little silo all by yourself, you're not going to get any fresh trading ideas. So get an investment group, look over each other's shoulder, leverage with pride, and last but not least, surround yourself with like-minded investors, right? Because there's going to be a lot of folks, especially in the options world, who think of the few cases that not even affected them, but affected their friends, where they're like, oh, that person did a trade and they lost everything because they didn't understand risk management. They didn't even understand the strategy they were trading. They lost everything. And so options must be risky, right? And they're going to plant that seed in your head. And every time you have a losing trade, you're going to be like, you know what? This person who has no business being in my head told me that options were risky. So the scoop is if you can surround yourself with like-minded investors, they're going to celebrate your wins with you, but also pick you up when you have a losing trade and say, hey, I had a trade just like that. Don't worry about it. You'll build yourself back up. And if they're in your group, that's even better. They'll hold you accountable to make sure you keep showing up, because that's what it is. It's about building when I go back to that whole thing about learning how to drive. My first couple of years being a new driver, being a teenage boy, right? I must have gotten in 4 fender benders. I could have stopped driving then, right? But I kept going at it, and look, now I haven't gotten a ticket or an accident in 35 years. So there you go, right? You just have to keep doing it. So that's how I finally figured it out, after years of spending a lot of money and trying to do it on my own. This is exactly how I cracked the code. I think you could benefit by doing the same thing. Last but not least about me, and then we'll get back to the whole VIX thing. I want you guys to know about the foundation I started back in 2003. I started Trading Trainer, which was a for-profit company, teaching people, and having them pay me to teach them. And then I would take that money and I would teach underserved kids how to do the same thing, right? And I started with these 9 kids. One of them is a professor at DU, Denver University. All of them, I gave them some money. I gave them $2,000 each. And I was like, I'm going to have to write this off. I'm never going to see that $18,000. They all paid me back, right? And we had to do this at the public library. We only got, because the public library just got this new thing called DSL back in 2003. They only gave us 30 minutes on the computer. So we had to prepare everything in advance. And then we only had 30 minutes to do all of our trading. They all got their own computers. They all got their own. They're all doing very well. I've been running this every year. We did have to take a couple of years off during the COVID, but we're back at it. I've partnered actually with the CBOE. So now instead of working in the, kind of bad neighborhoods of Denver, we're even in the worst neighborhoods of Chicago. So just so you know, if you're ever part of my program and you're, learning how to trade options, the amount you put into the program is actually going to help some of my my underserved kids learn how to get themselves out of the rat race. If you ever want to learn more about me or get some of the freebies that I got, just write down this web address, links.tt, that stands for Trading Trainer, links.tt4.me. You go there and I've got all sorts of freebies. I've got a podcast that's going on 5 years now. We're almost at episode 250. That goes on every Friday morning, and the replays are on YouTube. So you could join that. You could join some free workshops, whatever floats your boat. Okay, let's talk how to trade those VIX patterns, shall we? All right, so the core idea, we pair 2 bull vertical spreads. One's a debit and one's a credit on the VIX. We enter them simultaneously, and I've kind of tweaked that a little bit. I actually leg into them. So I'll get one, and I have my automated bot place my one trade. Usually it's the bottom one. And I do the debit one first, because the debit one sort of covers the credit one, but you could do them in reverse. It depends on if you have a margin trading account or not. It doesn't really matter to me. They cancel each other out. So I let my bot trade the first one, and when the trade actually goes through, I get signaled, and so I'll take a moment from whatever I'm doing, and I'll look for the corresponding, if the bot placed the debit trade, I'll look for the corresponding credit spread and go ahead and put that on there too. Expiration is typically 2 to 5 weeks out, and that aligns with the volatility cycle. The goal is to offset costs between spreads. Somebody asked, what is your bot and can I get one? I just program, they're called conditional trades. Tasty Trade does them, Thinkorswim does them. We're working on a software at our at Trading Trainer that allows you to program these bots, and then there's a handful of brokers that have signed up, including Interactive Brokers, TradeStation, some of those brokers that allow us to push the trade. Now, it won't do the trade. It pushes the trade into your brokerage software, and your brokerage software then messages you on the phone and says, hey, there's a trade set up, and you can go in and approve it or tweak it. So we're working on something. I expect that might be ready, in the fall. But these are things conditional. It's just conditional trades. So a lot of these platforms allow you to program if then, if this is happening, then place this market order or place this good till canceled, limit order, whatever you want to do. So I'm just using conditional trade. I call them my bots, but I'm just programming a conditional trade. Great question. The idea is to offset the cost between the two spreads. So if I take on a debit of 80 cents, I then want to get a credit of 80 cents on the companion trade. If I take on a debit of 20 cents, I want to do 20 cents. So you want to balance it out. And it's usually around the 70 to 85 cent zone is where you wind up getting these spreads. And that's on a dollar spread. So the VIX trades at $1. Pay attention if you haven't traded VIX options before, they don't expire on the usual Fridays. They expire on Wednesdays. And there's rules about not trading it on the last day before expiration. So you've got to get it figured in. But the way with this particular strategy works is we put it on and then we basically forget it. Okay. what happened? So I like to use a free tool, by the way. You can't get a paid version. I'll just show it up here. I haven't actually, I've been, I get it in my mind to go look up the people behind this tool. It's called Option Strat. And I just found it. It's actually one of my students turned me on to it about 2 years ago. But you can simulate all sorts of option strategies with Option Strat using real-time and historical pricing. And the amount you can do for free, if you're into options, is pretty exciting. So Option Strat, a cool thing. So you can model this. So let's think about this. Maybe it's easier to see not on the tool, but on my screenshot here. And I'll pull up my magic marker. I got to pay attention to the time because I get so excited about this stuff. I won't leave myself enough time to talk to you about, getting involved. So imagine that the VIX, you overlay that whole VIX chart. Here's that kind of mean reversion or mean line, that linear regression line in the VIX, spikes up this direction, but then it comes down and it's only so confident, and then it spikes whenever anything happens, and then it comes down and it kind of hangs out, and then it's confident. So if you can imagine the VIX trading, this way, and this being your strategy, you can kind of see what we're doing here. So the idea is that most of the time you put this trade on, like 75%, 80% of the time, it's going to break even at the end. They're going to cancel each other out. And when we do the trade, we actually like to maybe put a few pennies on the credit side. So if I take on a debit of 80 cents, I'd love to get a credit of like 82, 83 cents. The last trade I did when this set up in December, that's exactly what I did. I got the debit for about 81 cents and I got the credit for like 86 cents. So if it breaks even, you wind up with that spread. It covers your commissions, and depending on the number of contracts you did, you might get like $100, $200. You take your significant out, your significant other out for date night, like I do, right? I'm like, hey, this is the break-even VIX trade. But what has been happening a lot more, especially since the new administration, it's not new anymore. It's a year and a half into it. When these surprises come and it causes the VIX to spike, all of a sudden your trade that you pretty much, when all was said and done and the trade is over, you put zero into because they canceled out, goes to profiting to max profit. And this often correlates with a lot of your other trades in your portfolio, going against you. So I typically over the last years have put about 5 to 10% of my portfolio into this trade whenever it sets up. Lately, I've been putting a little bit more because the world's a little bit topsy-turvy right now. And so these events where the VIX is spiking have been more and more frequently. And so I've been putting a little bit more, but just know that the steady state of this trade is that it's just going to break even. It's going to cancel out at the end of its expiration, right? All right, let's keep talking about this a little bit more because I know I'm going over some of your people's heads. Okay. For those of you that still think options are risky, just remember, in my mind, it's more about having the flexibility. So if you're just a stock trader or a commodity trader, you make money if you buy low and sell high. You got one strategy, so you have to look for those low and high. If you're able to short, well, then you can make money if you sell to open and then buy to close at a lower price. That's great. You've got two strategies. But now with options, I have the ability to make money when the market when the stock or the equity goes sideways. I have the ability to make money when time passes by. I can use the fact that options are wasting assets. I can make money on fear. I can make money on confidence. There's 27 different ways to make money with different option strategies and choosing the different strike prices and expiration dates. In my mind, options are the opposite of risky. They actually open up the door. So, okay, let's talk about the timing of the entry. So we look for signs of a market bottom, right, in the VIX. So when the VIX is close to support, right now I'm waiting for the VIX to always drop down to around 14 or 15, right? I would love to put on like a 13.5, 14.5 bottom vertical spread, or a 14 to 15. I always like the dollar spreads. You could go 50 cents, but in my mind, it makes sense to go dollar spread. And remember, you put it at this level because the VIX doesn't like to go, we don't like to become that confident. There are times, when things were calmer, where I would wait for it to be even lower. So I'd want the VIX to be trading even lower. Right now, that's about $14 to $15. So right now, if we look at the VIX chart, the VIX closed today at $17.08. So I wanted to get down a little bit lower. That's why I'm saying this is setting up. It's been crazy. You know why it's been crazy. There's been, things happening in the world that have been causing investors to be on edge, but they're getting a little bit calm. So we're getting poised to place this trade on. We want the VIX to come down a little bit further. And then here's the once it's down in that range, I like to look for this particular indicator to pop. And this is an end of day signal for me. So I watch the fast MACD. The fast MACD, the traditional MACD is on a 1226.9 for all the moving averages. The fast MACD, and I didn't come up with this. This is from the Appel father and son team, Marvin and Gerald, 619.3, right? It's for looking at things kind of on a faster moving pace, and I find that this gives me the bottom signals the best. So I actually have a indicator that I programmed, or you could just use the one off the shelf and reprogram it. So if I apply this, let me turn off some of the other ones. Here it is, MACD 1619.3 right here. Boom. And my indicator just shows me when I've got arrows. So I got an arrow, but again, I'm not down at the price I want it to be. So I want it to be down at the 1450, 1415 range, and then give me that signal. All right. That's the signal I use. So again, if I get that signal end of day, I'll program it in for the next day to be a trading. I'm going to trade an option. I'm going to look to put that debit spread on. I'm going to look to go anywhere from, a debit of 75 to 90 cents. And I'm going to set that to be traded conditionally on the next day, right? If I come back or I get that notification that the trade fills, that all the rules that I put in were met and the trade get put out there and it fills and I get a notification, then I'm going to find a credit spread that has just about the same amount of credit, if not a couple cents more, so that it's better than break even. And I'm going to look at what those strike prices are. So I'm going to play with the options and I'm going to move it up and down until I find that perfect price. And then I'm just going to place that trade. And now I've got that pattern. Let's see. Let's go back. And then this is the picture I'm looking for. So once I've got these in place, now I am set. So if again, this is just an example. This is where I put on it looks like in this case, I put on a 14.5, 15.5. This was the trade I did in December. So I put on a 14.5, 15.5. And then as soon as I did, I saw how much that debited my account. So I started playing with the strike prices of the credit spread. And I found one that would give me an equal credit, if not a couple extra pennies. And that was here at the 2021. And then sure enough, if you look at what happened December and January, we popped up right when my expiration was about to happen. And I was able to get the full profit instead of break even. And that's been happening a lot with these trades. Usually, like I said, if you end up at the end of expiration and you go 2 to 5 weeks out, the VIX is traded weekly. If you go 2 to 5 weeks out and you expire, in that zone between 1550 in this case and 20, then it winds up being a break-even trade. And that's what you expect. You don't expect it to just always profit. That's not what this trade is. This trade is a hedging trade that will protect the rest of your portfolio if the proverbial poop hits the fan. And of course, people say, well, what if it goes down? Well, the idea is that, again, if it goes down, it means that all of a sudden, out of nowhere, everybody in the world became confident. And that's the case that's not really happening right now, right? So that's the hypothesis. I've been trading this very successfully. I've never had this trade go below that low debit spread, but I've had that trade go to break even often, which is, again, what I would expect and what you would expect. But lately, I have had this trade totally. Let's see if I can get us back to our slide set. Sorry, folks. Got a lot of windows open. How about this one? Yeah, there we go. All right, let's move ourselves on. Summary. Did I say this? Volatility is inherently mean reverting, but spikes sharply in crisis. Fear reactions create short-term mispricing in option premiums. Our structure captures these short-lived surges while minimizing cost exposure. This makes the trade an efficient portfolio hedge, not a speculative bet. So, summary. This VIX thing, it's a measure of market fear versus confidence. Our proprietary VIX hedge uses a dual vertical setup to exploit this volatility behavior. Strategic timing is with the fast MACD confirmation at a channel bottom. It enhances your edge and consistency, provides a built-in safeguard. Especially, a lot of my traders are premium sellers. That means we like to sell options, not necessarily buy them. And it provides safeguards. So, the next signal when it comes, here's what you're going to do. This is assuming you come and play around with us. You come to the workshop, because at each one of our weekly workshops where I go over trades, I always, in the first 5 minutes, talk about the VIX trade. And if it's present, I talk about the strike prices I'm going to trade for the vertical spreads and what I'm setting up with my conditional orders. Get my specific timing signals. It's just going to be a variation of the fast MACD with subsequent day follow through, right? If you want, before you place the trade, everybody who works with me sends me the trades, and I review them, and I turn them around and say yay or nay, or I point out anything you might be missing. Trade review, that's part of the program. And then you place the conditional contingent trade, and then you rinse and repeat every time the pattern materializes, which we think it's going to materialize over the next couple of days, maybe next week. So I got about a few minutes here. How would you like to never miss a pick, not just in the VIX trade, but with options trading in general? Minimize the amount of time you spend away from your loved ones and have support whenever you need it. Because that's what it's all about, isn't it? It's all about what? Saving time, creating clarity, and getting results, right? So I'm going to take a couple moments to tell you a little bit about my materials, my training and tools, just to see if they might be a fit for you. Who we like to have part of our program is someone who doesn't want to pay for a multiple data subscriptions to all sorts of different services, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things. So we usually cater to folks like me who either has a career, a passion, a day job. You love your retirement, and therefore you don't want to be spending all day indoors looking at computer screens. They want to spend more time doing other things, but they don't want to do this alone. They want step-by-step instructions. I put one more thing that's not on here. You kind of, if you're going to do this, you have to have some computer literacy, right? You got to be able, like we had somebody who actually signed up and signed up for one of our hands-on, like done for you coaching programs where we handhold you through everything. They actually paid us close to $25K just recently. And I found out that they couldn't even read their email. They didn't know how to use the computer. I gave them their $25K back, and I said, listen, you can have access to the materials, and you can join our workshops. That's fine. But I don't want to take your money if you don't even know how to, let alone use the trading platform. you don't know the basic ways around the computer. So I would add this to you. This is also for somebody that, has some computer literacy and a lot more than just signing into a Zoom meeting. So, that's important if you're going to try to take this on for yourself. Okay. Um, uh, yeah, Charlene's a great case. I have a minute here. Charlene came to us. I love teachers, by the way. I think they're the most underrated profession here in the States, at least, right? And she had been working almost 30 years. She got sick. She wrote this in her email, but, and you can see what time she sent me this email, 2 a.m. She got cancer, right? And she stuck with it, with the chemo and the immunotherapy and all of that, but it makes you weak. And finally, she got too weak to be able to like walk up to the chalkboard and all. And so they basically ordered her out of the classroom. She hadn't qualified for full retirement yet, but she thought that she was a goner. And so she was peaceful about it. She's like, I'm done anyway, so whatever. And then she had a recovery. But then this is the only country where you recover from something as life-threatening as that, and then you're in debt, right? She had no livable retirement coming in. She also wasn't, recuperated enough to try to go back to work. She wasn't able to collect from things like Social Security for 10 years. She got interested in the stock market. She met up with me. We started to use the different trading, mostly premium selling. She's also one of our VIX traders now. She reads the daily table, finds the stock she's interested in, follows the strategy, and she made 14% on a trade, just spending about 15 minutes reading about the company, following the chart, and then just waiting for expiration. So we like those trades, those kind of just set and forget, let time decay work for you, right? Anyway, if you are, I should say, when you're part of our program, if you choose to work with us, you're going to do an onboarding call. That's part of our program. And then you're going to go to the screener. You're going to pick symbols that are in your price range. We have a weekly workshop where everybody submits the symbols they're interested in. You're going to submit the symbol that you think works for you. And Coach Jay and I, we just had a call this afternoon right before this one. And so we had like 7 symbols that people brought to us. There was about 40 people on the call. And we went through all 7 symbols and we talked about why this one works, why this one doesn't work. You get to hear our experience. That helps you, it's learned by doing, right? We take the symbol that we like the best and we put it into one of our worksheets that comes up with trade plans for you. If we didn't do the symbol that you're interested in, you could do it on your own. Plug it in the worksheet, get a trade plan out of it. Send us the trade for review before you actually either paper trade it or real money trade it, so we can, shoot holes in what your hypothesis is, and then trade the trade, paper trade if you're, and that's what you're going to do in the first 7 days, right? We want you to get on again, learn while you earn, right? Okay, rinse and repeat often. So what is all this worth to you, right? You've got video tutorials. As soon as you're part of the program, we've got video tutorials up the wazoo. Monthly live classes and all the replays going back to 2010. We have screeners. That's very helpful. Planning tools. Weekly live workshops every Thursday and all of their replays, so you don't have to be there live. We even have like an AI thing now that joins the workshop as well, so you can chat with the AI after the fact and ask it questions, so you don't have to sit there and watch the video, which I know when I watch video workshops, it makes me pass out cold, right? Everybody learns differently, but I don't ask me to watch a replay because I don't have time. I'll read the transcript, or even better, let the AI make summary notes, and then let me chat. What did AJ mean when he was like going on a rant about this, right? So weekly workshops and their replays, the trade reviews, unlimited trade reviews. So what is that all worth to you, right? Now, I like folks to work with me for a minimum of 6 months. And then if they want to, they can go month to month, or if they, I would think that 6 months you could have it, but I have people that have been with me literally for decades now. And the reason is because they're like, I love your workshops. Every time you take me into the workshop, you wind up, not only scrutinizing my trades, but you also give us a trade every week. Why would I ever leave you? And I'm like, good point. I also offer a double your money back guarantee. So work with me for 6 months. If you're not showing a profit on your trades, I'll give you twice your money back. Whatever you pay for my program, I'll give you twice it back. That's how sure I am that this. Now, you can't go off and do your own thing. You got to follow my framework. But if you're doing it and you're not showing profitable trades, even in your paper trading log, then, that's on me. I also have my coaches, part of that high-end program, but I give you one free session. So you talk to them about where you are now and where you want to be in 6 months, and they'll help you navigate, what you should do, plan out what you should do for the next 6 months. So the bonus strategy session. And I'm going to give you also a trading audit session. This is with me directly. We're going to do a screen sharing session. You're going to show me the trades that you've been doing and the systems you've been following. I probably have experience in what you're doing. I've been doing this a long time. So I'll identify what's working and not working and tell you how to fix it. We'll just talk over your existing trading. Because if you're on this call, you probably are looking for an edge, right? So at least I can help you, right? So that's part of it too. So what's all this bonus? The double your money back guarantee, the strategy session, the trader audit, what is all that worth to you? Because if you go on my website, 6 months is $597. It's a flat fee, 6 months of access, no other charges. Of course, at the end, I'm going to give you an opportunity if you want to continue, but it's a flat fee, right? For you guys on this Synergy Traders session, I'm going to drop the price by $100. Yep, just for being on this session. So here's how you take advantage of that. You go to optioninvesting.org/synergy. If you have your mobile phone, you can point it right at the screen and scan the QR code there. And let's just, I'm not always sure that my team sets this up right. So let's go here to optioninvesting.org/synergy. And you can see the order form for $597. And then there's this place for a promo code. So the promo code is 100, capital D, capital I, capital S, capital C. And if I click apply, it drops the price to $497. So that's how you get the bonus on today. You have to put in that promo code, and then you can pay however you want to pay. And then you're working with me for 6 months, and we'll be going over the VIX trade, and we'll be going over a whole bunch of other options trade. And that is my offer. I hope you guys learned something today. Check out my free links that I gave you in the middle of the presentation. And, just all those thoughts, those negative thoughts, whether they're negative thoughts about what you're trying to do, or if you're even one of those, masochistic people who starts to turn it in, am I not good enough? You are. It's just a matter of sticking to it and, practicing with paper money until you see the patterns and you apply the right trading strategies to them. It's all about staying focused, right? And committing. And there you go. That's my presentation. Thank you, David. I always like this. What's the usual? I got one question. What is your bot? I already answered that. What's the usual spread between the long and the short leg? So I like a dollar spread on the two verticals, and then it depends. It depends. So you're going to place that lower debit spread. It's usually going to be just, if you can target around that 14, 15, the lower you can get, the better. But, if you go too low where you're getting that bottom, it's going to shoot up in price. So the ideal price for paying on the debit spread, 75 cents to a max of 90. I like to get it around 80 cents, 85 cents for the debit. Get that debit spread established, and then just look for the corresponding credit. Don't worry about any set number of spread. Look for where you can get that exact amount that you spent on the debit back on the credit. And then, like I said, if you can, offset the credit slightly, get a little bit like 3 pennies, 4 pennies per share on the credit. You'll be, even in the worst case scenario, you'll pay for your commissions. You'll get, like, depending on the number of contracts, $100 check. So you can go and, take your significant other out for date night or something. So that's all the questions I see. Thank you, David.
All right. Thanks, AG. Great having you here.
Always.
Yeah. So, all right. Be sure to hit that link for AJ and check out his offer. And thank you for being here.
Always.
All
You're the
right,
man
so
with the plan.
great having you here. All right, so yeah, according to our original schedule, AJ was going to be closing out the day for us, but we have one more great educator here. Harry Boxer is going to share his thoughts about the market with us to close out the day. And Harry, are you there?
I am indeed.
Hey.
Can you hear me?
Yeah, sounds good.
Okay, good.
And I'm going to post AJ's link in there one more time to his main site, his offer. So be sure to check that out. And Harry, you should be able to share your screen and get set up.
Let's do that.
Oh, while Harry's getting set up, just a reminder, in case you did not hear this earlier, Jeff Tompkins has an important zero DTE presentation tonight and a PDF that you can get instant access to right now about his zero DTE strategy. I just put that link in the chat. If you haven't seen that yet, be sure to check that out as well. Okay, Harry, I see your
Can you
charts
see
now.
my charts?
Yeah, AGL. Yeah.
Yeah, okay. Let me know when you want me to start.
Okay, I'm just double checking my setup. Everything looks good. So I'm going to start my recording, and then you can start your presentation. So I am recording again now.
Okay. Hello again, everybody. It's Harry Boxer, the Technical Trader. And David, before we start, I just want to put up my I don't see the share screen here. Where is it? I wanted to put up, oh, there it is. Share my website. You should be seeing that momentarily.
Oh, okay. Okay.
Is it up?
Yeah. Yeah.
Okay, great. All right. We can get going. Folks, I'm Harry Boxer, the Technical Trader. I've been doing this for over 5 decades, and we have a website called the techtrader.com. It's one of the first trading rooms ever established on the internet back from 2001. And I've been doing this for 25 years, but double that in terms of total experience, including several years on Wall Street as chief technical analyst for 3 different firms. Way back in 2000 in particular is when I started to realize that technical trading works on old time frames, and that why risk overnight stuff, particularly when you have a volatile market like we had in 2000. So I decided to focus on intraday stock patterns using 1 minute time frames. And you can see the chart that I'll show you the chart in a moment of some of the, I'm going to give you some examples from today's trading and how we do things. But I just wanted you to know quickly that you can join for free on my site for a 2-week free trial. Just sign up, no credit card necessary, and come join me for a couple of weeks, and you'll see what we do at TimingResearch.com. Anyway, that's my quick spiel. There is something else I want to share, and let me get to that screen. There it is. Okay. All right, let's start off by saying that today's topic is going to be preparation, focus, and discipline. I think that 3 keys for successful trading, particularly day trading, is to do 3 things. First of all, prepare properly, focus on what you're doing, and have discipline on your trades. And we'll get to that in a moment separately. But to me, those are the key 3 things, the 3 keys on successful day trading. I approach day trading as a disciplined process built on preparation, pattern recognition, and execution, rather than impulse or opinions or emotion. Each morning begins with identifying stocks that are actively moving pre-market. Those stocks that are showing strong price and volume expansion, because I believe opportunity comes from momentum, not just randomness. And by building a focused watch list in advance, I eliminate noise and concentrate only on the best candidates, even in the pre-market before we're even open. Be surprised at my site how many people make a lot of money even before 9:30 Eastern when the market opens up. We've already made several trades. One of the things I wanted to show you, and I'm going to switch again here, Dave, is I want to switch over to my site, which I don't see on the board. There it is. Okay. When you come into the room every morning, this is what you'll see. On the left is the trading room. On the right is where I post my charts. I don't have them up right now, but that's usually where you'll see my charts. And, I'm doing constant, nonstop updates, live webinars where I come on, show you the charts, show you the patterns as they're developing, and not only in pre-market, but post, I do a pre-market, several updates. I do updates every 20, 30 minutes, sometimes later, sometimes more often, depending on what's necessary from the market. But you'll see me going over the charts, drawing my lines and my trend lines and support and resistance levels. And when I give you a trade, I not only tell you what to buy, I tell you what the support, resistance, and targets are, and where to exit and what the stops are as well. So you should be able to make money on my site, because not only am I giving you the ideas, I'm telling you what to buy, where to buy, where to sell them, where to buy them, and where the support and resistance is. So if you pay attention and you're disciplined and focused and you prepare properly, I do the preparation for you. That's the beauty of my site. I get up, I'm in the on the West Coast, and I get up at 3:30 in the morning. I'm literally on my site by 3:45 in the morning. And I'm literally talking to my people and showing them charts pre-market until the market opens, and even after the market opens. But the reason I wanted to show you my trading room is because on the left, you'll see something that you see 4:08 a.m. in the morning, my early watch list. I went over it, hundreds of charts between the time I got on and between the time I posted this. And then I give you a list of what we call my watch list. These 15 or so stocks I felt had pre-market patterns that were promising enough to post them as watch lists, so that you can get them on your computer and you can post them on your list, and you can get them on your list so that you can follow along with me. A little later in the day, you'll notice that there is something called a focus list. Well, I will cull that list down to a list where I think is much more reasonable, and it is right there. I had about a dozen stocks or so on the list this morning, and by the time the market opened, I put out several buy alerts, which is in the top part of the room. Here you'll see the buy alerts. Datadog. Let's go over that real quick. AGL, those first two were phenomenal trades that day for today, just for today. Let's go over that again. I'm going to switch charts again and share my TC2000 charts. And we'll start off with DDOG. And I'm going to show you why and what happened. Well, first of all, when you go back, it's easy to look at it from where we gave it to you, right back in here. Now, Datadog exploded on a very, very strong earnings report. I told all my people, let's wait for the first pullback. And we got down about 174. I entered a buy on Datadog with several targets. If you look, those targets were 184, 188.90, and above. I wanted to show you how that progressed. You'll see it didn't do anything for a little bit, and then took off from the wedge or coil and broke out. From the flag and kept going, and then spiked. Get this, folks. 196, 97, 98. So we gave it to you 174, and within less than 2 hours of 198, 24 points. Now, that doesn't happen every day, but it's a beautiful trade, and we took the trade. For the rest of the day, here's what happened with it. You could have stuck with it if you wanted to, but it came down, went sideways, and coiled all day. So there was no reason to be back in the stock because it never broke back above this line that I call your resistance line. Now, several of us were watching for it, but it never happened. So the bottom line is that it was an excellent 24-point trade, and it took only about, I would say, 90 minutes. AGL, another example from my focus list this morning. And the reason I had a focus on it is because of the pop and the coil. Now, these are all 1-minute patterns, folks. I came in this morning, stock had popped and done this. I decided not to wait for a pullback because I felt like even if there was one, it wasn't going to be much more than anything shallow. So we bought it around the 40.5 3/4 range. And here's what happened the rest of the day. Before the market even opened, it went to 43 and change. It then went sideways, formed a flag. Continued to firm up. Even before the market opened, the stock moved to 44. And it backed off again, got real quiet ahead of the opening. Check out the opening. Right there. It popped to 48. Now we're in the stock here at 40 3/4. We already have almost 7 points in it, or more than that. But that wasn't where we stopped. My targets were raised at that time to, I think it was 53, and then 58, and then the final target was 64. But let me show you how this thing progressed over the day. Now, obviously, we don't see these trades every day, but today happened to be a good day for trading, despite the fact that the market wasn't that great today, was it? It was in downtrend most of the day. But we had stocks trending. That's what the thing about trading, day trading, is that it doesn't matter what the market's doing. There's always stocks running. Take a look at this. Rising channel, kept making new highs, and finally it got just under 64. The high was 63.87. I mean, within pennies of my target. But from where? From 40 to 63, another 23, 24 point. There were two stocks we had today that went up 24 points in one day, all based on technical analysis, all based. I knew that both of these had good reports, earnings reports, or whatever the news was. Just so you know, I'm a technical analyst. I follow patterns. Do I pay attention to news and earnings only when it affects the stock that day? Or if I'm swinging something, obviously I want to know more about it too. But today when I saw the spike up, and not only spike up, this is a gap. Go back and show it to you one more time. Yesterday it closed at 27.81, and this morning pre-market it opened at 37.10, $10. And within a couple of minutes, it was 41. It was up 14, 15 points pre-market, like right after the market just started trading. And of course, I'm not there that early. I'm not. So I usually wait to see what patterns develop. I look for coils, flags, consolidation, continuation patterns that are telling me the stock is digesting the gains and is ready for more. And that's what we saw with this stock and the prior one as well. Look at that beautiful bull coil right there. And this is called a bull coil because what happens is the tops narrow, they get lower, the bottoms get higher. And right there, it's called the apex. Usually you want low volume at the apex or hardly trading. But notice that during this period, the unbalanced volume was not coming down. It was actually firming up a little bit. It should tell me the stock was being accumulated. And there was more powerful buyers and sellers on this stock at that point. And that's, in addition to the pattern itself, looking at the underlying indicators and technicals, you can gauge whether or not it's ready to go. It sure did, didn't it? Now, you see at the end of the day, it definitely went sideways. But on the day, net, this stock had a monster session. And it was up 116% on only 3.8 million shares. 60.31 close, up 32.46. Fabulous move. And that was just another example would be ATRA. Now, the stock popped early. Let's go back and take a look at it. And started to form what we call a falling channel or a flag, a falling flag, whatever you call this. It doesn't matter what you call it. It's what it does after. I told everybody if it gets to 760 and breaks that declining tops line and the volume weighted average price or VWAP, the started line right there. As soon as it went through that, I think I said 770. I said look for 770 and a breakout, and we had targets on that. I think it was at 8.5, 9.25, and 10. If I said depending on volume, of course. Now take a look at this. Pop breakout with volume, no less. So that tells me it's going higher, not just a spike up. Now, sometimes it'll get up to the prior high here and stall or consolidate or back off. Let's see if it did that. It did indeed, didn't it? Which created a triple top. I told my people to hang on and raise your stops to preserve your profits and or your position. I think it was 7.5 is where I said raise your stops to. Or we had it there, I kept it there. So look at that, held it right there. That looked like a little bear flag. I was very concerned about it, but the volume was very low. We had that low volume ebb I talk about that you want to see before stock moves. Boom, bang. About 10.5. And the channel top in a 1, 2, 3, 4, 5 wave LA wave move. Most of us sold it in the 10 range, getting in at 770. Not a bad trade, eh? Here's what it did the rest of the day. And then at the end of the day, it broke out just before the close. It got up to 1245. I had a 12.5 target, pretty close. And the reason I had 12.5 target, I drew my lines across the top on a parallel channel. It came right to about 12.5. I got right to it, and then it collapsed. Luckily, most of my traders who were in it got out at 12 and above. We had a lot of good trades today, but I wanted to really focus on those in particular, stocks that tend to want to really trend. And a pre-market pattern on AAON, same thing. But the stock was so damn strong, I couldn't even get a pullback entry opportunity. Instead, I told my people, even though I never gave them a formal buy on this, I said, this is a very, very strong pattern. And with a rising flag, should it break out of it, we can make a quick trade on it. Well, it went from 127 to 144, 17 points, and it didn't take a half an hour. Then it consolidated, even went higher to 149 or so before you can see how it whittled away towards the end of the day there. But that's the kind of stuff we look at every day at TimingResearch.com, and the kind of charts that I want to be trading each and every day. RXT was another example. Now, when a stock pops like that and drops like that, you want to be careful. But if it should pop right back and take out the high, that's where I put a trade on it. When it broke for 3, my target was 350 and 390, maybe 4. 2 hours later, it was 462 from 3. And that's a 50% move in multiple waves up. 1, 2, 3, 4, 5 waves. So on the 5th wave, we always tell people, I want you to sell the 5th wave. Anybody who was fortunate enough to hold it to 462 made a huge day trade on that one, 2 percentage-wise. So those are just 3 or 4 examples of stocks that we traded today. And yes, there's always ones that don't work too. Those are the ones that worked, of course. So, my decisions are driven primarily by technical patterns. As you know, I look for formations such as flags, wedges, and breakouts that repeat in all time frames. I use them to time my entries with precision. And rather than anticipating a move, which I tell people never anticipate, wait for the confirmation, specifically a price volume surge that pops across a resistance level. In the case here, take a look at this. Here, we have a wedge pattern. If you didn't buy it here when it broke out, and you saw this little coil near the VWAP, notice how low the volume was? The volume picked up here, the stock popped, it was a buy right there at about 350. And of course, less than an hour later, it was 460. So if you didn't catch the full move, you should have caught 75 cents on the dollar on it right there. And so part of what you get from my site is constant live webinars where I go over these charts as they're progressing during the day. I show you the patterns. I tell you what it may occur depending on, what kind of movement we get, what kind of volume we get. In this case, it popped to resistance and pulled back again, testing the moving averages one more time along with the volume weighted average price, and then popped yet again. You could have literally traded this once, twice, 3 times during the day. Excuse me. So, what the watch list does, what I create the watch list, what that does, it eliminates the noise and we can concentrate only on the best candidates. Yeah, nothing's going to work all the time. So we get breakdowns and stocks are stopped out. We had a stock this morning that I said, you better, this is too volatile. Check this out. You're not going to believe this one. Oh, that was yesterday. I'm sorry. This stock yesterday popped up, gapped up, and I said, we're putting a stop right there underneath 180 if it breaks down. The damn thing went to 8 cents. I don't know what happened or why, but it got completely destroyed. And so obviously the stop saved everybody in the room. And I told everybody, thank God for stops, because sometimes there's a guy in my room that's been with me for 20 years, and his favorite expression is, the best trade I ever made was a well-placed stop, because preservation of capital is the key in trading. You can't let a stock go down and buy more. Don't average down, always average up. Why do you average up? Because if a stock's breaking out and trending higher and breaks through a key resistance level, you should add more. Instead of selling it, you should add more until it hits your target or rolls over and takes out support and or your stops. And rather than anticipating the moves, I always want to wait for that move. I always tell them, wait for a pullback and then wait for a confirmation. Like, for example, in the case of AAON today, where there was very little, no pullback here at all. Confirmation was a breakout above that rising flag. Rising flags are very powerful pattern. When you see them, and they're not too common, they usually extend. Another stock we traded today was HIMX, and here's why. They exploded, and I watched it implode, but I also watched it bounce and create a wedge. And I said, if they take this level out right there, it's a buy. So we went long at about 15 and a quarter, and it was 16 and 3/4 or $1.50 within, let's call it within an hour. If you didn't sell it near that prior high because resistance was there, you got this pullback. Here's what the pullback told me: that it was a double support level, trend line, and lateral price support. And man, when it held there, look what it did. Reversed from 1489 in minutes with an explosive move to 1773. Then had a rising wedge, which I thought was very potentially positive, but I raised my stop to right about there at 17. And you can see it's now 15.75. So you saved yourself some angst by stopping out at the proper place. I'm pretty good at targets. I'm very good at stops. And I think that in the room, I prepare you so properly that if you come in, even on a free trial, you'll probably be able to make enough money to cover 1 year subscription. Oh, and by the way, part 2 of this webinar is going to be, I'm going to analyze any stock that you want. And so if you want to put out symbols for me to look at for a little later on, if I have time, whatever time I do have, I'll be able to do that for you. Okay, let's move on. I want to talk about once you're in a trade, what's the key? The key is how to manage the trade. Management becomes a priority. Basically, I think most people don't know when to sell something once they have it. And I always hear, and I hear this all the time, I had a great stock and I sold it too early. Why'd you sell it? Well, I had a nice profit and I didn't want to give it up. Why not put a stop in? Well, where do I put the stop? Under key support levels and under key moving averages and trend lines. So intraday, for example, in this case, once you're in a trade like HIMAX and it breaks out here, you immediately raise your stop to there. And when it pops and pulls back and starts to move again, you raise your stop to there. And when it spikes up and pulls back and starts to move again, you raise your stop to there. So that when it rolled over here, you're stopped out. But you're protected at a profitable level. That's the key to trading. You cannot trade actively markets, especially day trading or swing trading, even for me, in my way of thinking, without properly placed stops. And this theory about 8%, 10%, 15%, there's no such thing as nothing logical tells me to put a percentage stop in. And I once had a very, very close, very successful guy in trading, really knew what he was doing, but he had the weirdest stopping point. I said, why do you use 8% stops? And I said, over the years, I figured I don't want to lose more than 8% in any trade. So he would, once they got in profitable mode, he would look where 8% was and he would put a stop there. And, sometimes it worked, but a lot of times it didn't. And you got stopped out for no reason and the stock kept going up. My way of thinking is what I just told you. Stop below the prior pullback low. If a stock's trending, it makes 1, 2, 3, 4, 5, 4 or 5 higher lows. It's in a trend. Milk the trend. Continue to milk the trend and make sure you get as much out of it as you can. No one's buying at the low and no one's selling at the high. One time in my 50 some odd year career did I sell a stock at the all-time high. Why? Because I put it in market at opening because it was halted. So it was at 15, it opened at 18. Trading was halted, and from there went straight down. But I got out at the opening at 18, never saw that price again. So my point being is sometimes you get lucky and you sell a stock at the all-time high where you buy it at the all-time low, but that's so rare. I just want a big chunk in the middle, a big piece in the middle. For example, from there to there on any stock. In the case of Datadog, stop there. It kept going until finally here's where it broke. But by that time, we were long gone because of the multiple waves up and because it reached our targets. The other thing you can do is if you draw a trend channel and the market takes out the channel, you might have been stopped right there. For me, the actual support level was right about there. You notice that it wasn't broken until hours later. I don't want to sit with a stock for hours when I can be in something else that's moving. So once you're in a trade, again, trade management is the key. I define for you support, resistance, targets, and stops in advance. And as the trade develops, I adjust them. I will change my trend lines. I will move the targets. I will tell you to raise your stop. Or I will say, target number 1 has been met, sell half your position here and raise your stop to here. Okay, here's your new targets. If a stock goes to the second target, I continue to monitor the trade and tell you where you may want to raise your stop to. The point being is that as long as the stock's trending, you should stay in the trade until it either goes against you and you're stopped out, or it reaches your target zone, target levels, and you're taking it out. I believe in 1/3, 1/3, 1/3. I like stocks in the 5 to 25 range because I can buy 5 or 10,000 shares and sell a couple of thousand at a time at each target, or at each level, and then keep raising my stops. And so many times I've had 3 different targets. The first 2 were met. The third one wasn't. The stock came down, broke support, but even that I was stopped out at a profitable level. And the combination of the 2 profitable trades and the one where I was stopped created a really strong trade for me that day. And you can always go back in. That's the one thing psychologically people don't do. Once they're out of a stock, once they're stopped, or once they sold the stock, it's amazing the human psychology that won't allow you to buy that again, especially if you lost money on the trade. I can't tell you how many times I saw a stock pop, pull back below my stop, and then immediately go back up and break out. And I went back in. Very few people do that. Very few. It's human psychology. Once a stock goes against you, you rarely buy it again that same day. And it may be minutes later. Okay. The other thing is that most people don't do is they anticipate, and I tell you, anticipating will kill you. For example, and I'm going to give you a lousy example, but EZGO, that stock that got crushed, at what point was this a buy? You know, you think it's, oh, look how oversold it is. Let's buy it. Look how oversold it is. Look how oversold it. Once the stock goes against you, you don't want to be in that stock until it breaks, turns around, breaks the trend, breaks at least one prior high, and shows you that the trend has turned, especially if there's heavy volume. If you get a heavy volume surge on a snapback that breaks the resistance, that's your go signal. Again, my decisions are driven primarily by technical patterns, period. Once I establish why a stock is running up, I look at the pre-market earnings or the biotech FDA approval or whatever the good news is, a contract, whatever it might be. Then I know that the stock is going to have some sponsorship that day because there's a lot of interest in it. And you often will see a stock 10, 15, 20 times normal volume. If you go to TC2000 here, you'll see something called post buzz. During the day, it's called volume buzz. And that tells me at any one time, in the case of RXT, for example, it's trading 900% more volume than average in after hours. But in the morning, pre-market, when that stock is trading 500, 5,000, 10,000% more volume than average, and the average is over our last 100 days, then it tells me that something has shifted of a positive nature, and there's a lot of sponsorship and volume coming into it. Once the trend is established and the stock takes off, once that occurs, you want to stay in the trade. Just continue to manage it properly. How do you manage it? Well, make sure you know where your support, resistance, targets, and stops are in advance. By the way, on the subject of stops, I will tell you right now, I don't care how good a trader you think you are, human psychology will let you change your mind if you don't put a stop in. I want a hard stop entered. I want you to have that stop not in mind, but entered with your broker. It's just too easy to change your mind when a stock's going against you or for you, especially when they break. Oh, it's not. The easy thing to say is, oh, it just broke support by a few cents. I'm going to hold on to it. And then it's another few cents. And then it's another few cents. And you're stopped out, and the stock just keeps going down. And what do? You buy more, which is really dumb. Okay? When you have a stock that's declining, you only buy more when it turns around with big volume. Then the downtrend or the down channel intraday, reverses and goes to the plus side. So the key is managing your trade and adjusting as the trade develops. You must continue to continually raise your stops and change your trend lines and your support levels and keep moving them up and down when need be. Know where your VWAP is, volume weighted average price, because a lot of traders pay attention to it. Know where your I use 10, 20, and 50-day moving averages, and 10, 20, and 50 period moving averages, because obviously intraday charts, it's not 50 days, it's 50 minutes. It's another really good example of a stock that this morning popped and had a rising flag. You see that rising flag? You don't see them too often, but I just mentioned to you that when you see it, and often, very often, is a precursor to a bigger move. Here it goes from 668, and within a half an hour it was 817 for $1.50. If you held it, because it didn't break support, because support was right there, right? That's where you put your stop, right there. Came down to the VWAP and bounced and made a higher high. You had a choice at that point whether you wanted to sell it or not. Or you held it and you were finally stopped out there, which is really a bad trade. I always tell everybody, when you hit a target, sell a third, sell a third, sell a third. or sell a third, and put your stop under there. So that even if it broke down there, you'd be protected with a either nominal profit on the third tranche or a break even or slight loss. But the bottom line is the total trade for you is a profitable one. That's the most important part. Okay, so one of the methods I use is scaling in and scaling out. I don't understand human psychology. Well, I understand it, but I'm not clear why people don't understand it. If you make a decision to buy something and you want to put $10,000 into it, why do you have to put it all in at once? What if you're wrong? What if you're right and you had a third of the stock? Would that be so bad? And if it broke out over the prior, for example, say you bought it here on the breakout above this high, above there, and then it came down and broke out again. You may have bought more here, but you wouldn't have been hurt because you weren't stopped out, and the stock eventually went from about 750 to 836. So you didn't get hurt. But the point being is, I always average up and I scale out a third, a third, a third. For me, that's the best way to do it. You have 10,000 shares, sell 3,500, 3,500, 3,000, and be out of it in tranches. Or, have stops on each third and continue to go with it until it's either sold or you're stopped out. Trade management is more important, almost more important or as important as what stock you pick. Because even a bad stock, if you manage it properly, will give you either a small profit or a small loss. The key is never take a big loss. Ever, ever, never, ever take a big loss. You have to protect your capital so you can trade another day. Too many people get blown out quickly and they're out of the market. If you don't know what you're doing, it's easy. You come into my room, I do all the preparation for you. I tell you what the focus list is, what stocks we're watching, which ones are buy alerts. I issue buy alerts with stops and targets and everything. I make life easy for you. Again, just come join me for 2 weeks for free. No, not even a credit card. Just come on down. Okay. Again, scaling in and scaling out allows me to reduce risk and participate in an upside. And I'm constantly emphasizing cutting losses quickly while letting strong trades run. Too many people do just the opposite. They sell their profits, they hold on to their losses. The losses get bigger. It means human psychology is. And the other thing that I never, ever understood, the stock is 8 and it drops to 7. And when it gets back to 8, you're immediately selling it. I want to break even. Are you trading to break even? You're not trading to break even. You're trading to make money. So if a stock went from 8 to 7 and you didn't get stopped out and it moved back to 8, why not hold it for 9 or 10 if it's going to move, especially if there's volume? Now, if it got back to 8 and it acted on low volume and it didn't act well, you could always kick it out either at a break even or a small loss. I'm okay with that. Or raise your stops or tighten your stops to a point where if it goes down, then you protect it. And if it doesn't, let's just keep riding the pony. Okay, I think that most traders struggle not because they lack opportunity, because they lack discipline. The number one thing about it is it's so hard to be disciplined because here's the problem with stock trading. It's called human emotions. I'm a big believer that the trend is your friend. The trend will tell you what to do. Don't anticipate, wait for it. Don't get emotional. My brother-in-law passed away at a young age, but it was a great trader. Always said to me, it takes a cast iron stomach and testicles of steel. You got to have the kind of emotional discipline, and it's hard to get, especially if you're type A person like me. It took me 20 years of struggling with the market, making money, but not as much as I could or should have, because I wasn't as disciplined and I was too emotional. You'll notice that the best golfers in the world, other than maybe Tiger Woods and John Daly, are pretty low-key, mellow kind of guys, and they are focused and they're disciplined and they don't get too crazy. There's other people like Phil Mickelson who gets emotional too, and Jordan Spieth, for example. But the bottom line is most golfers, I would say 95% of golfers who are really, really good, have discipline and know how to control their emotions on a golf course. Well, you got to do the same thing in the trading day. You come in every morning, you get excited, stocks are exploding out of the gate, and you jump on stuff. You're jumping on stuff, and you're not even sure why. You get excited, and once you're in the stock, you see a stock go up 3 or 4 points, and it goes down a quarter, and you get excited, you get nervous and sell it. Every stock, there's no such thing as a stock that goes vertical nonstop all day until the end of the trading session. Excuse me. There's going to be stops along the way, and there's going to be consolidations. Any chart I showed you today, for example, let's go back to them. AGL, choppy all day, but on the way up, though, right? ATRA, I mean, very choppy, very. RXT, anything I show you here has got a pattern of running up and pulling back and consolidating and coiling, et cetera, et cetera. So there's nothing perfect out there. Datadog was a beauty today. We loved that one early on. 24 points there and 24 points there on AGL. Yeah, that was a good day. So again, discipline. First of all, preparation in the morning. And I do all of the prep for you. So all you got to do is be disciplined and focused. And look, the beauty of my room is you can send me a private message anytime or just put a message in the room itself and I'll answer you at all times. Nobody's questions go unanswered. One thing I'll ask you is don't ask me a question while I'm talking on an update because it's disruptive. Okay. Success comes from staying focused, following the trading rules, removing emotion from decision making. I know that's the tough one, but you got to learn how this is. Stocks are like a bus. Every 10 minutes, another one comes along. I'm serious. That's one of my favorite expressions. There's always the next idea, the next idea, the next idea. And the other thing is never, ever, ever lament or pat yourself on the back about a trade. Do I think you should keep a trading log? Absolutely. Every trade you have, before you put it in, enter a log at, I'm buying 1,000 shares at $5 a share. Here's my target, 550 and 6. My stop is 470, so that you know all of that and have it in writing in front of you. Not just because you'll have the ability to manage a trade, but learn from your trade. At the end of the day, review all your trades, especially the losing ones. Know what you did wrong and why. You'll know when you look at it. You'll say, yeah, this is a mistake. Or that was the right kind of move, and I got to do more of that and less of that. I think the number one thing that people don't realize is that a trading log is your biggest educational tool that you can self-educate yourself. Now, I'm pretty good at teaching people technical trading and technical patterns, but there's nothing like learning it yourself. They say that 2 months in my site is like 2 years in a classroom because I'm constantly educating people on the patterns. I'm correcting them when they use the wrong terminology or when they interpret something as something else other than what it is. Not that I'm the expert, but I've read every major book on trading there is. And I know most of the big traders in the world, and I've talked with them and interviewed a couple of them. I think what I do is as good as anybody out there, and invite everybody to come join me. Success comes from staying focused, following the rules, and over time, consistency. Applying these principles will transform your trading from a guessing game into a structured, repeatable process that every day you can come in. And that's another thing people are always asking me, well, how many trades should I be in at a time? You only need to have one trade a day. But I tell people that if you have a large portfolio with 100, 200, 300,000, yeah, you want to put in 40 or 50 grand per trade, then 3 or 4 stocks at one time, that's difficult if you're a pro and you've been doing this for a while. That's not hard. But I always recommend, excuse me, never more than 2 or 3 trades in a day. You don't need to have more than that. If you do it right, if you have enough stock, you're not trading 100, 200 shares. If you're trading some volume and you're making some cash because you've got a 50 cents, a $1.50 on 5,000 shares. You're making 7, 8, 10 grand per trade. And that's what we strive for at the site. Where a lot of my people are making $500,000 to $1 million a year trading. They're retired from their jobs. And they're just doing that. I have people with me over 20 years. One gal came in who's still with me 3 weeks when I started after the site in July of 2001, and she's still here. Amazing, huh? So I don't have, that's about it for me. I just wanted to give you my take on the process, the proper process for you every day in terms of preparation, how to prepare, focus, what you should focus on, and being disciplined and following the rules, which include the stops and the targets and the scaling in and scaling out, and that kind of disciplined focused trading. So, folks, if you have any symbols, because we do have about looks like about 15 minutes. If you have any stocks in particular, David, I don't see that the chat. Where would that be? Let's see.
You have to find the Zoom menu and
Oh yeah. Hang on. Zoom screen. Chat, is that on top? Team? No, there's a team chat. Is that it? Doesn't look like it.
No.
That's weird. I'm not seeing it.
Do you want me to just read some out for you?
Yeah, that'd be good.
WRBY.
Had a good day today, I think, from what I remember. Yeah. Warby Parker. Now, take a look at, first of all, I'll look at a long-term chart. I see a basic breakout of the real choppiness. I go to a daily. Talk about choppy. Now, this stock was one of my favorites in here when it was running, but I really liked it when it broke out of the base up here. Problem is, it came down, it came up, it came down, it came up. It's very choppy in here. But here's the good part. There's some key overhead support right in the zone. One of the things I look for is when a stock has been in a choppy pattern, but it breaks out of the pattern. This is a channel. It's a 1, 2, 3, 4, 5-wave decline, Elliott wave, basic decline, basic Elliott wave analysis. Then pulls up to resistance and backs off, makes a higher low, and breaks out. I would say that if it gets above 30, and today's high was 28.95, then maybe you have a shot at retesting the 31 range. But more importantly, longer term, this could be a $35 to $45 type stock. As you can see, back in 21, it traded all the way up in the almost $60 range. It wouldn't shock me if his stock made a move into the low to mid 30s and then mid to high 40s eventually. And the on-balance volume looks pretty good. I would like better volume than this, but this was a good day for it in terms of total movement. Let's look at intraday again one more time. Yeah, so it started. This is the kind of stock that I normally would have day traded. Here's why. Pre-market pop, and that's a bull flag. And then it broke out, and that broke out right when the market opened, I'm assuming. Indeed, 929, 930. So this was a trade right there for a day trade. It then had an ascending bull wedge, broke out and went up. And the rest of the day, like many stocks, consolidated. So looking at a 15-minute chart, you'll see the breakout and the wedge. I like that look. Again, if it gets over 29, then 30 3/4, 31 is your first target, followed by 33, 34. The measure move, which is something I use a lot, 21 to 29, 8 points, tells me that from the pullback low, if you add 8 points, that's 34. My targets are 31 and 34 on a swing trade for Warby. Any other symbols?
No, there's a question. Do you ever use options on higher price stocks?
Well, I don't, but people in my room do, and especially on my swing trades. I'm hearing that some people are making a fortune. Most of my swing trades will do very well. Some of them go up 30, 50, even 100% or even more. I had one stock last year that was up 800 or 900%. And if you bought any of the options, you know how much money you would have made. But I don't use options during the day. I'm too focused on what I'm doing. And you know the old expression, if it ain't broke, don't fix it. Well, I'm not an options expert. There are people in my room who are, but for the most part, I'd have to say I don't do any options whatsoever. But you're more than welcome to do options on my trades, particularly my swing trades. They really have done very, very well.
All
That's
right.
the only
SKYQ.
KYQ.
SKYQ.
Oh, I know it well. Sky Quarry, yeah. I don't like this chart, and there's no reason to buy it. And the reason I say that is simply this. When you're in a downtrend, you tell me how long this downtrend is going to last or where it stops. Does it look like it could rally from here? Yeah, and that's because of the gap. A stock will go up, test the gap, probably not fill it right away, and bounce. Do I like it? I'll tell you what. How about this one? SKYX. Check out this chart. I believe this stock going to double or triple from here, and I mean quickly, after a multi-month down channel. And by the way, the stock was David, I believe I put this out as a pick for on one of your seminars at $1.07, and it went to 330, tripled in a beautiful 5-wave LA move. And now it's back down to that support level and breaking back out again. I believe it's going back to 3.25. This time it may be 4 or even 5. By the way, this is a $120 million company revenue-wise and growing. Very interesting stock called SkyX Platforms. You look at the volume and the breakaway gap, I think this stock is imminently going to make a run. And PS is a personal position of mine. But SkyQ, just to go back to it for a moment, again, is there really a reason to buy the stock? I will tell you this, because there's always pros and cons. The pros, look at the underlying green bars and the old on-balance volume line making new highs. Very unusual. The stock is being accumulated on the pullback. But my counsel to you would be the following. If it takes out today's high, that's 530, and it does it with energy, then I would look for a swing trade to 7, and then maybe 8.25 or half. Eventually, it could be a $10, $11 stock again. And this is oil and gas? Yeah. I think oil and gas stocks, I'm not surprised to see this at all based on what I'm seeing with the price of oil. You know, price of oil went from 114 to 90, a $14 drop in, 3 days, based on the fact that it sure looks like Straits of Hormuz, one way or another, is going to open up. All right, anyway, any other symbols?
How about NBR?
That's another oil and gas, I believe. Yep, neighbors. Well, this is a beautiful stock, and it has been for a long time. I also like, in this group, by the way, APA. That was a stock I picked down in the $20 range and went up to 45. But NBR, well, here's the downside. There's a lot of resistance up here. If it breaks through, you may see 130.40. But for me, any stock that's had this kind of run, if you're in it, stick with it with a stop. Where? I look at prior highs as support, and this bar here, 94. 92.5 to 94 is a support level. Below that, you have 85, 86. You have the trend line at 50-day. So, I mean, the ideal scenario is it holds here and moves back up to the next target, which is 110. Eventually, 135.38 may be doable if the market continues strong for oil. But if it doesn't, this is a vulnerable stock, in my opinion. It doesn't look bad technically. I'm not seeing any technical deterioration. There's really no reason to sell it until and if it breaks important levels. Any other symbols?
How about CLS?
Oh boy, Celestica. What a chart. Check this out, folks. One of the more incredible stocks. Just since in 3 years, it's gone from 10 to 400 and change. So let's just say 40-fold in 3 years, 40-fold. It did it in a 1, 2, 3, 4, 5-wave LA wave move, It formed a consolidation and broke out again. There's no reason to assume the stock can't be $500, $600, $700. Problem is, you do not want to see it roll over and take out $350. That's where I'd stop it. That's 30 points from here. But it's that kind of stock that can do that in one day. Do I love this chart? Yeah, what's not to like? And it can continue to go up, but I'm really wary of a lot of these stocks. You take SanDisk, SNDK, for example. Check this out. Only in August of last year, the stock was 37. And here it is, 1,300. 1, 2, 3, 4, 5 waves up. Do I want to buy the stock now? No, but if I'm in it, I'm holding it until it breaks down. I'd have to say I'd put my stop right there at about 1,048. There's moving average and trend line there. But my target is, believe it or not, $2,000. Unbelievable. Any other symbols?
How about one of my favorites, Palantir, PLTR?
This stock has gone nowhere. At one time, I had this on my short list, and I'll tell you why. Left shoulder, head, right shoulder. There's your neckline. It broke it, and it had a rising wedge right to the neckline. This is where we went short at 155. Within a month, it was 122. So we got 33 points on it. But notice this high and this pullback low and this pullback low. This is a key support level. Palantir is neither bullish or bearish, except I'd have to say, just based on one quick look, it's a bearish pattern. 1, 2, 3, 4. Excuse me. This is either wave 4, and it's going lower, and if it breaks down, it could be a $100 stock again. What I would look for is this to be a left shoulder, head, right shoulder, and for the stock to break out over resistance. I'm not buying any stock that looks like this until I see volume over 150, 55. That's where I buy. I'd rather pay up 20 points and know that it's going, another 50 to 100 more points. But I actually like playing PLTU, the ETF. It's a double bull ETF. This one has dropped from 128. You ready for this? To 30, 100 points. It's still below the declining tops line. Until it breaks back out, I'm not buying Palantir either way. Either one. That's my take.
All right.
Is that it?
How about DEC, DECK?
Decker is outdoor. Yeah. Well, the only thing I can say about DEC is that it may be forming some sort of monstrous 1.5 year long left shoulder, head, right shoulder, but it's not quite the right formation. The bottom line is, here again, there are so many bullish trends that I just showed you. Why buy a stock that looks like this? It's all over the place. It's up, it's down, it's back up, it's back down, it's back up again. I mean, it's very volatile, and in essence, it's still in the downtrend. Why? Because you have declining tops and declining bottoms. So until and if it gets over there, I would say over 115, you can buy it with both fists. But even then, you got a triple top at about 122. So again, I need to see better action. Look at the underlying technicals and volume. Flat as a doornail. It's not telling me anything. As a matter of fact, it just ran up to the moving average and VWAP, and if it fails here, and it did reverse negatively today, this stock could be back down in the 90 to 93 range. You got to be really careful with this one. That's my take on Decker. It's not as, there's so many beautiful charts out there. This is not one of them. Any more?
No, no more symbols yet.
Okay.
Last chance. Anyone have any more symbols for Harry?
Well, I could leave you with a couple charts.
Oh, GEV. I'm familiar with that one.
Yeah, it's General Electric. Well, what's to say about this stock? In 2 years, it's gone from 125 to $1,200. So basically tenfold. And also did it in massive Elliott wave 1, 2, 3, 4, 5 waves. So everyone, look, this is one of the reasons why I'm concerned about the market. Do I think the market's top? No. We're making new highs every day. But when the market does top, a stock like this that's gone from 129 to, look, by the time the market tops, this could be 1,500, 1,450 to 1,500. Another 400 points would not shock me. What you got to do is keep raising your stops, like we talked about during the session today. Where would you stop this one? Probably under 980, thereabout. I'm not going to be. Today was not a good day for it, by the way. Down 69 points or 6%. Has this one topped? I can't say it has. If it breaks down here and then goes below this zone, it might have topped. Problem is, anticipating a top, we would maybe thought here was the top or here was the top. The bottom line is keep raising your stops until the stock breaks on you. Now, today could have been the beginning of a much bigger down move. 69 points is nothing to sneeze. Excuse me, 73 points, nothing to sneeze at. 1,046 after hours still dropping. Take a look. They must have had earnings or something. Anyway, the stock today dropped from 1121 to 1040. Lost 80 points top to bottom. The overall chart pattern, it shows that it's at support. It doesn't hold here. Secondary support is about 60 points below here. Be careful with this one. It's way, way, way overbought and extended, and in a fifth wave, which might be a 1, 2, 3, 4, 5. So we call this Elliott wave fifth of the fifth. When you get 5 waves within a fifth wave, it's time to sell. The odds, the risk reward is too much for me on the stock like that. I don't care how good a company it is. Look at the run on it's had. The stock goes up, what did it go from 120, went up tenfold, 1,000% in 2 years. So we're coming to the top of the hour. Anybody else with a final question? Or is that it, Dave?
Oh, one more. IBKR.
The broker. Interactive. Well, here's another one. Big move. 13 to 83. Here's a weekly chart. Is it overbought? You betcha. Did it have a bad day today? Yeah. Is it top? You can't say that. What do you want to do with a stock like this? Know where your trend lines are? I would say at the top of the channel means we're overbought and extended. Unbalanced volume line. Look, the stock makes a higher high on lower OBV, a negative divergence. Underlying technicals are not showing me anything volume-wise, maybe a little bump here. But, anytime I see a stock like this, my tendency is to want to sell it. I guess that's it, right, Dave?
Yeah, that's all. So thank you.
My pleasure. And don't forget, folks, if you go to thetechtrader.com, you can join me for free for 2 weeks. Just click on the join for free button. No credit card necessary. Just come in and see what we're doing for free for 2 weeks and join the party and have fun every morning and make some money. This is HB Sun, otherwise known as HB, Harry Boxer, the technical trader. Dave, once again, thanks for having me, and appreciate being here. I'll look forward to doing it again. Bye, everybody.
Thanks, Harry.
Okay.
All right, so that was Harry Boxer of thetechtrader.com to close out the day and close out the whole event for us. So yeah, I am working on the archive. I have so the full final archive page will be at the link that I just put in the chat. All of yesterday's and Tuesday's. Also, let's see. Also, the live CryptoCat says, I didn't see Sunny Harris in the list. Is she okay? She was on just a couple hours ago. Yeah, she was on the 3 p.m. spot today. Yeah, if you, let me see. Okay, this last link that I just put in is the full archive for today, the unedited archive. So you can just scroll back a couple hours, and you can find Sunny in there. And then at the full day archive, of course, her individual presentation will be there as soon as I can get it processed. And okay. Day 3. Okay. All right. All the archive, or all the room links are now switched over to, or all the room links for today are now switched over to the full feed. So if you received an email, you can just click on the email and it'll go to the full feed for today. And then as soon as the full archive is complete, all of the links will redirect to the full archive page. So, yeah, and then if you're new to Timing Research, I've been hosting events on here for, what is it, 12 years almost. So the full 12-year history of all Timing Research shows and events and everything are permanently archived on Timing Research and the Timing Research YouTube. So someone asked when the next event is. Let me pull up my list here, and I am working on a system that will be better for you to see live when future events are. So I'll have that ready soon. But you can put this on your calendar. Oh, also, well, I'm going to say that here. One of the ways to get updates on future events is add the official Timing Research calendar to your Google Calendar. And that way you can see in real time when I add stuff, add events. But the next big one like this, big 3-day one, will be July 7th, 8th, and 9th. And that topic will be favorite indicators. So again, it'll be up to 30 presentations over 3 days. All some of the same people as this event, but other people as well. I always try to have a few new people on every event, and I just invite great people and just let them share whatever they think is important related to the topic. So also, if you I also have so this series, this event was called our Synergy Trader series. But I also do the Analyze Your Trade series. Those are 1-day events, and the whole event is very similar to what Harry was doing with just looking at charts requested by the audience. So those are no presentation, no agenda, just answer questions and look at symbols requested by you all, the audience. So the next one of those will be 2 weeks from today, May 21st. And then June 11th after that, and then July 23rd. So add those to your calendar as well, or just add the Timing Research calendar to your Google Calendar and you'll get that. All right, someone says, yeah, good work, David. Some stellar presenters. Yeah, we had a great lineup this event. A lot of our recurring favorites were able to join us, and then a few people who haven't been able to in over a year, and Jim Fink, who's a new first time presenter with Timing Research. So yeah, I used to have an exact count, but I think I'm up to over 300 educators who have appeared on at least one Timing Research event over the 12 years, and always trying to add more people. So if you have a trading educator that you really like, that hasn't appeared on a Timing Research event, or you think hasn't appeared, feel free to send me a message. You can reply to any Timing Research email, or go to TimingResearch.com/contact, or hit the contact page on the top of or contact link at the top of the page on TimingResearch.com. Also, if you're not sure if someone has been on or not, there's a search bar on Timing Research, and you can search and find anyone from any of the past archives. Let's see. Also very important. Jeff Tompkins has a event tonight in less than an hour, 7 p.m. Eastern time, about 0DT options, and he also has a PDF about his strategy that you can get instant access to. I just posted it in the chat. If you haven't seen that yet, check that out. I think that'll be interesting. Okay. All right. I think that's it for today, unless anyone else has any questions. All right. So, yeah, I'll give you another few seconds here to hit that link. And again, if you want to bookmark this, also if you just go to TimingResearch.com, the individual posts for the individual days will link to, or the first two are already linked to the full archive, and then day 3 will in a few minutes as well. So let's see. Actually, I'm going to go ahead and change. So on the full day archive, you can see there's links in there to the individual day unedited YouTube links. So I'm just going to go ahead and change all the archive links to the full archive page. So okay, that's done now. So any link that you received, whether by email or text or Telegram or whatever, will all redirect to the main archive page right now. And for the individual recordings, all of day 1 and day 2 are in there, and then all of today's will be added in there as soon as I can get them posted. So I've been able to develop some techniques with ChatGPT and various AI tools to help me process the archives faster. So that's been fun. So all right. Crypto says, thank you so much, David, for all your hard work. You're welcome. Yeah. Yeah, putting these together it takes months of work to get one of these set up, and so it's always good to see them come together, and I'm glad you all enjoyed it. So All right, that's it for the Active Traders Playbook. Be sure to catch up on the archive. If you missed any of the sessions, and again, I'll just say this real fast. You can be sure to join us on May 7th, 8th, or I'm sorry, July 7th, 8th, and 9th for our next big one, favorite indicators. And actually, let me go ahead and post this one last thing. Yeah, so the Google Calendar, you can get updates that way. Telegram, another good way to get updates. Substack as well. And of course, the original full YouTube archive where everything is saved. So, all right.